Not construe any such information or other material as legal, tax, investment, or financial or other advice. Nothing contained on here constitutes a solicitation, recommendations, or endorsements, or offers by Draper, Goren, Holm or any third-party service provider to buy or sell any securities or other financial instruments whatsoever. Welcome to day 2 of the 8th edition of LA Blockchain Summit. Today is Regulated Securities Day. I hope you all enjoyed yesterday, and a huge thank you to all of our speakers. And today, here's what is in store. Today, you'll experience a number of panel discussions on such topics as digital asset management, tokenization, and custodianship. And here to kick things off for the day is Opportunity Hub's Rodney, Sampson, and Draper, Goren, Holm's Alon, Goren.
Hey, good morning.
Hey, good morning, man. Congratulations.
Thank you, everyone, for your participation. Yesterday was a huge day, probably our biggest day yet, and I think today can be even bigger. So I'm so excited to be joined by Rodney, who is a longtime friend, longtime partner in from the crowdfunding days, and also a venture partner at Draper, Goren, Holm. Rodney, welcome and good morning.
Good morning to you. It's good to see you, and of course, well done, great job. I know you got to get through the rest of the conference, but it looks amazing, and I'm excited to be on the team.
Hey, thank you. So I thought it would be fun for us to have this kind of two-way conversation, fireside chat, because there's so many things to talk about, right? But I think a fun thing for everyone who maybe doesn't know you and doesn't know me that well is to start off one. Please introduce yourself, and then let's jump into kind of the background that brought us here, right? And sort of the why crypto conversation, because with yesterday we talked a lot about DeFi and NFTs and all these things, and today is a lot of regulatory talk, and I think that the regulation or lack thereof, or a bunch of different reasons, are probably why we both ended up where we are today. But first, why don't you give your background?
Sure. So I've been building companies for over 20 years now. I actually started back in 2000 as a co-founder of a startup that was building streaming technology software. And we were doing that in Atlanta. That company was acquired in 2010. I, did a rinse repeat a few times, 4 companies, 2 incredibly big failures, and then 2 exits, And so after that was really looking for more definitive purpose on how, I could not be an outlier from my community in the ecosystem. And me and my wife and I didn't want to just do philanthropy right out the gate. And so we created a social enterprise called Opportunity Hub. And for the last 8 years, we've been building these ecosystems in Atlanta, in Kansas City, now nationwide, and I'm sure we'll be in the metaverse like everyone else will be soon, perhaps. And building something from the ground up is not easy, never easy, of course. And so we've done a lot of amazing work, an amazing team as it relates to the upskilling and job practice that we have in OHub, and then the startup programs and investment side of the house as well. And so in addition, we have a foundation that does a lot of advocacy, a lot of outreach, a lot of early exposure programs as well. And then I'm a GP of 100 Black Angels and Allies. fund, and we're pretty active investors inside of our ecosystem. I'm a senior fellow at the Brookings Institution, and I'm also a visiting distinguished professor at UNC Chapel Hill Kenyon Feigo School of Business. Authored several books, Kingonomics being probably the most well known, which is how we actually met through
Yeah.
George Schofler, right? Yeah.
Yeah, we the fun story for everyone is that Rodney and I met through a mutual friend of ours, Joyce Schaffler, and that same day that we met on a panel for South by Southwest, we also met Josef. So it's pretty crazy to think how many years later. It must be 6 years or so later now, plus probably.
8 years, yeah.
8 years, wow.
Yeah.
So all on the same day, the same place. And I remember that was sort of part of the beginnings of the conversation with Josef, and starting at the time Crowd Invest Summit, and then cut to today in LA Blockchain Summit, because I would meet Josef. I met him at that event, which was a great event, and then we started meeting at crowdfunding events. We'd end up at having a beer together and going, "You live like an hour away from me. Why do we have to fly to Florida or wherever we are right now to have a beer together?" and eventually we went, "Let's start one of these in LA," and then it snowballed into today. So it's so great. We met each other that day, and what's great is I actually brought a friend along with me at the time. And in hindsight, it was one of the greatest things. My friend Shai brought a professional camera. And so we have like the most well-documented first time we met, because we got all these professional pictures of it too, which is just funny. In hindsight, it seems like it was like choreographed. But I remember, we went to that conference, you were launching Kingonomics, and then you launched the Kingonomics conference, which was a really big deal. I got to participate, and that's when I really, got to know you much better too, because I got to meet your network and meet all the people around you. But I would love to get your perspective, and I guess I should give a little background on myself too, but I'd love to get your perspective on where we are today versus back then, right? So we're talking about the Kingonomics conference was then, if we met 8 years ago, it was probably 7 years ago or so now. And a lot of the talk was regulation. A lot of the talk was the Jobs Act and things like that. How do you see the changing landscape?
I guess in hindsight, I think I'll have an overarching response that I've learned in the process. And I won't say I've learned this in the process. I will say that my appreciation for was refined and maybe shaped over the last 8 years, that really paralleled the signing of the Jobs Act, Jumpstart our small business startups Act, and the evolution of that through Reg CF and Reg A, and then how ICOs hit, SEC opinions there. But I will say this, and I believe this to even be globally, is that policy is precedence. And if you are building on the edge, in edge technology, the metaverse, blockchain, crypto, if you are building in the fourth industrial revolution, you should do yourself a favor and make sure you understand how policy is created, and how policy is rolled out, and how policy is enforced, and how policy can impact what you're doing and what you're building, whether it is at the global or national, down to the municipal level. Now, telling a startup founder or a disruptor or industrialist, something like that, may seem a little, kind of, tense, right? Because we believe that, once we have domain expertise on the problem we want to solve, that there's nothing that we cannot, do to actually solve it, especially when you're talking to technologists that literally can build stuff and get it to, get, automated, and it does it, right? So
yeah, well, I mean, I would tell you, you remember this too, but I mean, back when I remember when we first met, and even before that, because pre-Jobs Act, we were all participating in this space, and I was the young techie who was pissed off, right? I started my company, and I didn't realize what I wanted to do was against the rules. I just went, of course, anyone can put up a fundraising campaign, share it with their friends on MySpace back then, and raise money for their company. Right. It would be un-American if you couldn't, right? And that's how I felt. And I went to do it, and all of a sudden, my friends who were lawyers and people who were more well informed than I was came to me and told me, hey, you got to take this down. You can't do that. And I was like, what do you mean? My example project was for a friend of mine who wanted to start a landscaping business and wanted to raise money from his customers so that they could help him buy a new truck and they would own a piece of his company. And I went, like, how could that be illegal? That's insane. It's really was insane to me. And so that's how I started the conversation in the crowdfunding world. And I was so angry, and I didn't believe that the politicians would get things done. But I remember at one of the conferences, the big news that one of our friends told us backstage, kind of thing, and then it became publicly known, was that they were I don't know the exact terminology, but they're reissuing the bill or putting it in front of Congress, and it was rebranded to the Jumpstart Our Business Startups, and it was rebranded as the Jobs Act. And when they told me it was called the Jobs Act, this is post recession times and stuff like that, post 2008. When they told me it was called the Jobs Act, I went, oh my gosh, it's going to happen. And they looked at me and I went, it doesn't matter what's in it to me, right? And from my cynical point of view, I went, it's called the Jobs Act. What politician is going to run next time and have any chance of being reelected if the opposing side could say he voted against the Jobs Act? But
I mean,
yeah.
That was a little ingenious, I mean, I remember advocating for the Jobs Act behind the scenes, and I met Jason, Woody, Paul, all the players, right, in the beginning, David, Will, and at the time politically, Patrick McHenry, the Tea Party was a thing, right, and members of the Tea Party. And so my perspective to folks was like, you're going to have to get consensus across the aisle in order to pass legislation. And so I went to Maxine Waters and asked her to support the legislation and to build coalition. And so it was literally the Tea Party and the Coffee Party coming together because, Maxine was a leader at the time in the Congressional Black Caucus, right? And so it showed that even polarizing ends of the political spectrum. And I remember talking to folks in the White House at the time from, my vantage point of how they were able to get Republicans and Democrats to come together around a narrative, and they actually were negotiating up until the last minute. And because they rebranded it, that's how they got it. They got it through, right? Now, Alon, you said something that I want to address, like from your perspective and vantage point, you were like, hey, it would just be un-American to stop me from achieving the American dream, right? Yeah. Whereas my lived experience and my, parents and families' lived experience, because of history, and I won't go too deep there, but was to be cautious about everything. Because if I wasn't cautious, I may, have a different outcome.
Absolutely. Yeah, there's a long, rich history of that in our country. If I take a step back, it's patently American, right? But from my perspective as the son of immigrants who started their own business, probably because they could have never gotten a job anywhere else anyway, right? But from that perspective, it was, and plus Israelis, when they talk and they do the like this, that's really, you know, how they navigate a lot of life too. So to me, it was like, I'm a techie, I'm online. Why wouldn't I be able to do what my family did? You know, like a lot of, if we look at crypto even, and you know, what we kind of think is maybe normal or the new narrative in sort of Web3 and ownership, and the idea behind like, if we participate in something together, we should own it together and we should govern it together. And if we go back in history, that's kind of how community banks were supposed to be and supposed to start. It was the local communities or the churches or the temples and whatever, and the people getting together, and they would own things together as a community. And, you know, cut to today, you know, it doesn't matter how many years I'm a Wells Fargo customer, they're not going to give me stock in the company or give me a vote or a say in anything that they do. But in crypto, that's normal. And to me, that's how you were supposed to start businesses. You call up your friends and family, you had them rally around you, either by maybe investing, but more likely just hiring you, like being your customer. And that's how we started a business. To me, it was the opposite of what, you know, I was told by my parents, which is work your ass off, you're going to be successful, right? It's just this interesting thing, but you're absolutely right. And, you know, but I give so much credit of what's changed to you and some of our friends, because, you know, even more recently, when they raised the crowdfunding rules and laws to the Reg CF to 5 million, they changed some of the rules and made it a little more lax and a little more usable, for lack of a better term. I didn't think that was going to happen in the time frame that it did either. I guess I'm constantly cynical that the regulators will do the right thing, but to their credit, a couple years ago, no regulators would have shown up at this conference. Today, we're going to have previous regulators, guys like Jay Clayton are going to join us. And we have current regulators like Hester Peirce will be joining us today too. And all sorts of regulated financial institutions and some of the biggest banks in the world. So, you know, it's a testament to change and growth, and hopefully in a positive direction.
You're absolutely right. These are definitely unprecedented times. And, you know, I think about really the collision last year, you know, of, you know, COVID, the culture. You know, I think about what happened to George Floyd and Breonna Taylor, and, you know, Ahmaud Arbery daily. And, you know, I must have had 1,000 conversations last year. And we've seen a lot of, you know, commitments to right past wrongs, or to, you know, help bring everyone everywhere into opportunity. And I think that the opportunity our regulators and financial institutions have is that the themes are there. You know, when you talk about the emancipation of capital, the democratization of capital, right? We've got the hashtags, we've got the themes, and now we just need to think about a more frictionless way forward. And so I would encourage, you know, we talk about this in the ecosystem. You know, Steve Case and I've had these conversations, Brad Feld, I know you all have talked to Tim Draper a lot. You know, their vantage point in terms of the speed and why having less friction is important when building and moving. And so if you look at how America has to move forward to stay globally competitive, you know, some would argue, I was involved with Rokana and others who helped to get the Endless Frontier Act through the Senate as a part of this huge American Innovation and Competitive Act. And they were looking at who, you know, what are the national security issues related globally, and how America being as innovative and competitive as possible was a matter of national security. And I also made the argument that the exclusion of people, because the fourth industrial revolution is moving incredibly fast, right? I think about the number of businesses that closed their doors last year, and the people who lost their jobs. But then I think about venture having its greatest year ever, right?
Yeah.
More funding rounds last year than ever before. And so when you start thinking about how in a crisis, the problem solvers were capitalized to work on stuff. But then from my vantage point, I interact with thousands of problem solvers, technologists, and founders and entrepreneurs that cannot access capital fast enough if you look at the data for a myriad of reasons. So, institutional finance, corporate finance, and also government finance, they have an opportunity to do what the private sector says it wants to do, but has not, and what it should do, but has not done. And now the people are saying, if government won't do, if corporate won't do, if finance won't do, the people were saying we must do. We have to be our own best friend, and we have to make sure that we organize our capital to build the communities that we want to live in the now and in the future. And I think that's where our worlds can collide in a very positive, upward mobile manner.
I love it. I think that, you know, we talked about this a lot yesterday, and people talk about, you know, COVID sort of accelerated and jumped a lot of our sort of the regulated financial world, the more traditional friends and family of ours and extended family and people across the world, whether we know them or not, we're sort of forced to work virtually. And, you know, I feel like I've spoken to the students at OHub a few times, probably more at this point than I have the university that's literally across the street from my house. And that was purely because you and I, we live virtually, right? We live in these worlds, and it's so normal for us to have these kind of conversations. But for the first time ever in the last couple of years, I saw venture capitalist friends, a lot of the banks we're going to have on here, a lot of the regulators we're going to have on here, telling me that they did deals virtually without meeting the company in person, without meeting the founder in person. And I think it's a huge step forward in that promise we've been talking about for so many years of sort of leveling the playing field, or, you know, having this borderless world. But are you seeing that yet as a is that benefiting the opportunity hub and the communities that you know, or the companies that are being built out of it?
It absolutely is. You know, having raised and now invest, you know, capital, and I often say people who invest, we still are entrepreneurs raising, right, from our limited partners, and so we're raising and deploying simultaneously. But having been that founder and that investor really simultaneously, there was once a time that capital, you know, was basically held hostage geographically. And if you couldn't fund getting to multiple meetings to close, you just wouldn't do it. And last year, we literally saw $156 billion in venture capital, all invested virtually, right? And so I think that in itself, you know, removed at least one barrier in terms of being able to connect and think. I mean, I think about the pitch competition we did last year with Steve Case and Morgan Stanley, $2 million invested in Black founders specifically. We would have never been able to do that all virtually. I mean, the technology existed. We could have done it. I mean, look, I mean,
you've been streaming media for a long time.
I was, you know, streaming 21 years. You know, we've always streamed at OHub, but, you know, the very fact that you could run an entire applicant diligence process, selection process, production process, and actually invest in real companies all virtually mentally required a shift. And so I hope we never go back. You know, I think we are going to have to remain in this hybrid accelerated pace. And I think that's where, you know, I think about the infrastructure that's going to be required to maintain that pace so that more people can participate in it. And that's why I get excited about the blockchain. And that's why I get excited about crypto. And that's why I get excited about DeFi. You know, I think I'm not distracted by the memes, you know, the fun stuff. You know, you got to have fun sometimes, right? But at the same time, we got to be focused on solving these huge problems in society and in industry. And, you know, that shift that happened in our ecosystem, which I'll call the startup world, right? The tech startup and venture world, which plays in the same sandboxes like the blockchain and crypto and the AI and the machine learning and the meta. You know, that world is responsible for 60% of net new jobs. And so if you're in a corporate or government space, you know, OHUB is working on a project now with Treasury and Commerce around the state small business credit initiative. It's a $10 billion allocation of capital that goes to states that can be used to fund small businesses. And what I'm trying to get the teams to do is to adapt our narratives in the startup ecosystem, because they want that money to go to venture or towards venture funds that, you know, will then do what VCs do. That they have to adapt the terminologies, but also adapt the understanding. One real simple one, and I'll, you know, kind of, you know, throw it out. In the corporate finance world or the banking world, you know, it's business plans. In our world, it's, you know, pitch decks, you know, executive summaries, right? And it's total addressable market. It's product market fit, right? It's DAIS, diversity, equity, inclusion, solution. It's like the acronyms that we learn in terms of like moving fast and nimble and lean, they don't always translate. But I do think there's wisdom and infrastructure that can be brought to the table, right? Our world may be able to help folks build fast and build quick, but government and corporate finance and institutions can help us maintain it once we've built it, right? I think.
So here's where, you know, we've only got a couple minutes left, and I wanna actually, like, that was a perfect moment, because we have the most incredible opportunity probably, you know, since the internet in the United States right now, and we have a path forward. But if you ask some of my friends in the crypto world and beyond, the uncertain regulatory environment is a major issue, right? So we have, for example, some of the smartest minds in the crypto space, blockchain space here in this country. We have Opportunity Hub and programs like that, and amazing engineers and young people who could take that to the next level. But when I'm getting pitched to startups, I hear somebody with a Midwestern accent. I hear somebody with you know, sounds like they're from Texas, or I hear a California kid that sounds like he's a surfer. And then I ask them, oh, so where are you based? Expecting to hear Texas or the Midwest or Orange County. And they tell me, oh, I'm in Switzerland right now. I'm in Singapore. I'm in Dubai. Do you think, you know, that we, you know, from a regulatory standpoint, the United States might be squandering this huge opportunity by sort of in the world where the playing field is more level? It's also easier for us to just go somewhere else if we need to build something.
Well, I'm going to shock the conference by saying something, you know, from my perspective and vantage point. I know a lot of Black people who have left America because they're just tired of dealing with institutionalized or personalized racism. All right. I said it. Cancel me. I don't care. But my point is, translate that to people who want to build without barriers, people who want their ideas to be appreciated, people who want to innovate in America because their parents are here, their families are here, but they keep running into barriers. I know founders right now that are going to Nigeria and going to Kenya and going to Ghana to build their startups because there's more capital being organized on the continent for African entrepreneurs than capital that's being organized for minority entrepreneurs.
I will say this: we've never had a conversation of should we not invest in that company because they're in another country. We've never had that conversation, and we've made investments now in India, in Israel, in all over Europe. I've talked to actually one African company that I love, but they might actually be too later stage for us. They might be too big for us already, and for us to make that investment. So, but the thing is, what you said is not that controversial to me because, as a punk rocker, at least growing up, all my friends would be like, oh, I'm moving to Canada. I'm moving to Canada. I'm moving to there. I'm moving to there. But nobody put their money where their mouth is until the last couple of years. I'm seeing it now all of a sudden, like it's happening all the time. So, I think it's crazy. I think we're pushing against time. We have a great presentation from Ami coming up, discussing Ownera and FinP2P. Rodney, thank you so much. Give everyone a plug of where to find you or follow you.
Absolutely. I'm at Rodney Sampson or Professor Sampson on most platforms. Let's connect there. And in closing, these are incredible times. I love America. And I want us to be the most competitive, the most innovative, the most opportunity yielding nation on this planet.
I love it. Thank you, thank you, thank you. And thank you everyone for joining us today.
Well, a huge thank you, gentlemen, for kicking off the day. Now we're talking about digitizing the world's largest offline market. And I'm really excited to bring you Ownera's Ami Ben David. Take it away.
So today I'm going to talk to you about private markets. But before I go there, I want to share with you a unified theory of digital financial markets, or really a simple model for making financial markets digital in full. So if you look at financial markets today, our financial markets are built on accounts. You have a bank account, and under the bank account, you might have sub-accounts with each type of use case and assets like currencies and shares and so on. And transacting between those accounts, all the transferring, paying, investing, and so on, that is our financial ecosystem. And it's been built over the last 50 years. I call it, a lot of people in technology know the concept of technology debt. It's a 50-year technology debt, a spaghetti of platforms. I say 50 years because Swift, one of the network, was actually launched about 50 years ago. These are just a lot of networks that try to connect incompatible accounts, trying to trade across all the financial institutions and network and so on. And now we're looking at crypto and we're seeing a new way, a new idea, a digital way of doing things. And the concept that's kind of taking over the institutional market right now is that fixing the old spaghetti is possible, but it's going to take a lot of time. And the market is just leapfrogging straight to digital. Like some countries in the past bypassed landlines and went straight to mobile, we're going straight to digital. So what is the unified theory of digital financial markets? It says something very simple. It says every account will eventually be a digital wallet. Okay, in the same way that the internet, every device has an IP address. Think about every account in any platform, any bank, any exchange that you work with for securities or for commodities or whatever it may be. Think of every account as a digital wallet. And what is a digital wallet? How is it different from the accounts that we know? So first of all, a digital wallet is a cryptographic address. So a ledger can assign value and transact directly on them. So you can have one ledger talking to 10 different addresses, and each one of them sitting on a different bank. And for the ledger it doesn't matter because the ledger can see all of them. And we see this in crypto ledger, and we are going to see this also in tokenized ledgers as well. The second element of why a wallet is better or different than an account is that it can allow an owner or the custodian to transact by simply signing. When they sign with their secret key, there's a mathematical proof of their intent. And put those two things together, and what you get is a world where if all accounts are digital wallets, then all transaction in and between all the assets will be direct and instant. And I think this is worth kind of thinking about a little bit. It means that there are so many transactions today that would go through 10, 15 intermediaries between the destination and the target. So many things that cannot be done because there's no access and no distribution. And I will talk about specific use cases for this in a few seconds, but this is quite big. The transition from accounts to wallet is removing massive layers of intermediary complexity, reconciliation, margins, delays, error, risks, and costs. And that's kind of on the optimization level. But not only that, it enables new markets. It enables new access to markets. It enables new things that we're seeing, for example, in DeFi, all sorts of collateralization, liquidity pools, and a whole new world of things that are only available when you move from accounts to wallets. And it can be done gradually. You don't have to go through, an exercise of kind of doing an operation and trying to fix the entire 50-year-old platform, but you can add wallets actually on the side. Now, what does it mean to financial institutions? Financial institutions today, those that are looking at digital seriously, are starting to understand that the battleground for the future of financial ecosystem is actually in who can deploy the best wallet to the best client and connect them to the best networks. This is what it's about. Because at the end of the day, when transactions on wallets are happening and they're cheaper and they have more features and they're more capable and they can do more things, if a bank is stuck with the old kind of accounts, they will not be able to compete. So the banks that will start and get those clients on wallets will get an advantage. And that's true also for newcomers who come in and, within weeks and months, sometimes take huge market shares and valuation out of old financial institutions. It is also about valuation. The financial institution that will win in this battle will have the valuation significantly, in a different ballpark than those who won't. Now, this is not a pipe dream. This is already starting to happen, and the financial industry is working together, and it is starting with private markets. Now, this is a little bit unintuitive, because you would think that because digital wallets came from crypto, then we start with crypto. But the reality is that a lot of financial institutions and regulators are not yet fully comfortable with deploying crypto in mass. I mean, they're giving access to crypto through securities, but not direct kind of spot trading and so on. This has not arrived yet. Okay, so that's not starting from there. And also public markets, another area we could go to, it's already electronic. So the problem is not that big. But in the private markets, there's no 50 years history. There's no digitization at all. Things are still done in Excel sheet, phone calls. It's a massive industry, much larger than the public markets, with almost no liquidity. So it's an ideal place to experiment with digital. So sometimes innovation goes to the most unlikely places. But what we're seeing today is that most, if not all, major financial institutions will deploy wallets for private markets before they deploy wallets for crypto. So what is the effort? The effort I'm talking about is a group of 70 leading financial institutions, major banks, asset managers, exchanges, major fintech companies and blockchain companies that came together under GDF, which is a nonprofit organization that promotes digital transformation. And we created a group called Private Market Digitization Steering Group, led by my friend and partner, Anthony Woolley. And in that group, we're trying to solve the problem of allowing every wallet to trade with every wallet and every wallet to trade with every ledger across the any underlying distributed or centralized ledger, any settlement currency, any custody, any issuance platform, any regulatory. That's a large task. And to do that, we defined a network, an open source protocol called FinP2P. FinP2P is an open source decentralized protocol. It's not a blockchain, it's a routing protocol that enables instant trading across any asset class and any ledger. And if you want to know how it works, just go to FinP2P on Google and you'll find it's the first reply will be FinP2P, and you can dig into the specifications. Now, how does it work? How can we connect everybody to everybody across the board all the time? So FinP2P, you can think about it as a big pipe in the middle where the nodes in the pipe are financial institutions, okay? And they're connected to each other through nodes, and the nodes are identical. They're all FinP2P nodes. Now, you start connecting to the big pipe every ledger through smaller pipes. So you start with the digital assets, which you connect with a pipe to the big pipe, and you can bring in every digital asset. It can be Ethereum, USDC, but also digital dollar, CBDCs when they come, various stable coin, and even treasury tokens and so on. So any digital asset that could be used for trade or settlement. Then you can bring in any asset that is tokenized on public blockchain. Then you can even go to assets that are tokenized on private blockchains, and you connect also to assets that are on any enabled securities ledger. So now you have pipes connected to the big pipe, and now you start bringing the wallets. So Bob's got a wallet connected through their financial institution, and as you can see, if Bob is wallets number 100, then wallet number 100 will hold some USDC. They will hold some shares in this company and in a token that's going to the moon, and in some other company as well. And in the same way, you also have Alice's FinP2P wallet, and Alice can trade with Bob. They can exchange, they can do borrowing and lending and everything that you want, all on one platform. Now, if you've done that, then you can achieve what I talked about before, which is every transaction instant and direct. We so far released 3 pillars of FinP2P. The 3 pillars include, first, primary distribution, which is the ability to tokenize any asset in the existing world or digital and distribute it for sale for any wallet that sits on the network. The second thing that we launched was secondary liquidity, the ability for people to exchange IOIs, indication of interest, to say what they want to sell or what they want to buy, and have this transact and instantly settle. So this is different from the kind of 50-year-old platforms. In the new world, you can also settle instantly straight to the ledger. And the last one, which is new and super exciting, is collateralization and DeFi. Think about a simple use case where you have, let's say, shares in a company, and the company is not public. You can't sell it. You can't borrow money against it. You just sit on it. But if you have collateralization and DeFi, you can practically go to FinP2P, click a button, get money. The shares are going to be pledged. And then when it's done, you can get your shares back. So those are the 3 pillars. In order to look at what we're going to do now, we looked at what is going to happen in the private market in the coming years. And BlackRock issued a statement recently where they said that they believe the private market will grow in portfolios from 5% to 20%. That's 4x growth. It's a super attractive market right now, and you can't grow 4x without digitization. It's just going to be very difficult to do practically. And what we're going to do in Q1 is we're going to launch FinP2P with several of the banks and asset managers on the FinP2P group. And we did this analysis, and I want to take you through this analysis because it's interesting, I believe, and I'll try to make as much of it in the time that I have. So what you see here are the 3 pillars: the primary distribution, secondary liquidity, and collateralization, and 4 asset classes that we can tokenize and digitize with a platform like FinP2P and digital wallets. In each one of them, we try to understand, is it optimization? Is it a market that works well, but digitization can improve it slightly? Is it transformation? Transformation is 5x to 10x, a market that exists, but it's so inefficient that by digitization, you can get a 10x on this market. And the last one are markets that are blue ocean, completely new markets that were just not available or possible before you digitized the wallets and the networks. A good example is pre-IPO shares, unicorns, if you will, $2.5 trillion market with hundreds of super, exciting companies where, the stat is that the last round from, the value from the last round to IPO is 7 times bigger than the value after the IPO in the first 12 months. This is a very attractive market. And in this market, primary distribution, we put it optimization because today unicorns can raise capital. Yeah, I mean, we can make it more efficient. We can give them more distribution, or if the market goes bare, then people will stand in line to get distribution. But for now, it's optimization. But if you look at secondary trading, in secondary trading market, extremely inefficient market where you can have 100 people on a cap table of a company and 100,000 people want to get in, right? And there's no way for them to trade properly. Trades take 3 months, 15% completion rate. If we move to 100% completion rate in 1 click from wallet to wallet, that's 5x on existing supply and demand before any additional. And then collateralization. The collateralization is, again, the example that I gave before. You're sitting on your shares as a founder. You could actually borrow some money and buy a house without having to sell the shares that you will believe will be worth much more next year, and you don't want to sell them right now. Let's see how much time I have left. I'll cover just one or two more because I think these are interesting. But you can take this kind of value that you get from digitization across the board to pretty much every asset class. So the next one I'm going to talk about is I'm going to switch to institutional real estate. Institutional real estate, that's not a $350 trillion real estate market. Just talking about professionally managed real estate, a $10 trillion market, of which 60 trillion is private. Well, this market has no secondary liquidity. And because it has no secondary liquidity, you can only sell to pension funds and people that don't care about liquidity. They care only about yield. But if you could have liquidity or collateralization, then you can sell to many more people. And you can package products that give 4%, 5% yields in a year in a market where fixed income is negative. You give the bank $100 million, you have to pay them $2 million at the end of the year. So this is a super attractive product that can work really well. Similar market in private equity funds, where the market is $9 trillion, but secondary market is only 90 billion. It is 1% a year, almost extremely inefficient market where digitization and collateralization can at least triple the market, if not more. So I'm going to stop the presentation and just come back to say that I think the move from accounts to digital wallets is at the heart of the digital revolution. And yes, we've learned a lot from crypto. I think that the next panel is actually going to be talking about what have we learned from crypto. So I think it would be a good segue to move to the next segment. But I wanted to share today the kind of the big plan for a unified theory of digital private markets.
Boom. Some great insights to start the day with. Next up is Josef Holm of Draper, Goren, Holm to explore why Dubai, where I'm based and Josef is as well, has become home to such a large contingent of blockchain startups. During the conversation, we also have Ali Madhavji of Blockchain Founders Fund, who will follow with his panel of experts. But first, I'm heading over to Josef.
Hello, everyone. Now I feel a bit bad that we're not talking about what it is that we're learning from crypto or what we've learned from crypto, but nonetheless, very excited to have this discussion about how Dubai has managed to attract blockchain startup in droves. Of course, I am joined by, as already mentioned, Josef Holm, founding partner of Draper, Goren, Holm. I'm also joined by Ralf Glabischnig, founder and board member of CV Labs, Saeed Darmaki, founder at Sheesha Finance, Dr. Marwan Alzarouni, the CEO of the Dubai Blockchain Center, and of course, Fatma Elsafty, blockchain technology product manager at Do. Ladies and gentlemen, thank you so much for joining me today. I know you're all sitting in Dubai, so this is a late night session for you all. So thank you so much for joining.
Thank you, Tracey, and thank you for having us.
Of course. Now, to kick things off and to manage this in an organized fashion, I'm going to throw the first question out there. And I'd like to kick this one out specifically to Ralf Glabischnig. So feel free to add later on, guys, but I would be curious to know what are the key ingredients for a successful and flourishing startup / blockchain ecosystem? Oh, I think we just lost Ralf. So then let me open it up to the entire group.
So Dubai, I think, has long been at the forefront of technology as well as innovation, and also trade and tourism. So it's no different in this case. Crypto and blockchain technology is an emerging technology. It is where the innovation moves at a very fast pace, and we want to be a part of it and actually lead it. And Ralf is back. Good segue.
Perfect, because I think Ralf, you always have a very good answer prepared to this. So let me ask you, what are the key ingredients for a successful and flourishing startup / blockchain ecosystem?
I would say we have maybe 5 key ingredients. The first one may be the solution itself, the density of the solution, the right talent or the right team who will be actually driving this solution to the market, And then if we have the right team and the right solution, then we should have the go-to-market strategy for this startup. And if we have the main three, which is the solution density and the right team or the right talent and the go-to-market strategy, then they are at the level to have the fundraising. So this will be the number 4, and number 5 will be the regulation to govern this startup and allow them to scale and build a sustainable solution. This is in my opinion.
So I think you could group it into essentially capital, talent, and infrastructure. Is that fair to say?
Exactly, and the solution, yeah.
Perfect. If we take that as sort of the main criteria, how does Dubai specifically match up to that criteria today?
Okay, so talent, I believe Dubai is a multicultural environment and it has all the diversity. So based on that, it actually attracts a lot of skill sets. And to find the right talent and right skill sets, it's not difficult comparing with the other countries worldwide. So this is for the finding the right talent. The infrastructure, there are a lot of organization and giant cloud organization providing the infrastructure to the edge, as well as also providing the security controls that required for the governance and the regulation in the country.
Josef, how do you think Dubai matches up on the infrastructure, talent, and capital front? I think unfortunately you might be having some internet connectivity issues. The technology is not smiling upon us today.
The background is great, but the sound is not coming through.
Yeah, let's try with Saeed.
Yeah, I think Dubai has really the best kind of ecosystem and infrastructure at the moment. The crypto community and the blockchain community, especially since COVID, has started to kind of move into Dubai recently. We've seen an explosion in the number of people that are based in Dubai that are focused on crypto and blockchain. As Fatma alluded to, there has been a lot of development in terms of blockchain in general on the infrastructure side. You're seeing a lot of layer 1 blockchain solutions that are coming out. And being a part of Casper Labs, which is a company that built Casper blockchain, and with the focus on enterprise, I think it's been great for us to have a presence in the region, and we're doing a lot of really good stuff here, and we're having a lot of really good conversations. But I think also in terms of funds or ecosystem funds that are coming up that are trying to support startups coming here, especially in terms of capital, which was alluded to, you have the likes of Sheesha Finance, which is incubating and seeding projects on the token side. And then you have one fund which is going to be coming up really soon towards the end of this year, which is CV Centio, which I'm a part of, and CV Labs and CVBC is a part of, and Sanctum Ventures is a part of, which is specifically focused on providing capital to early stage startups, specifically focused on the UAE ecosystem. So if you are a startup that wants to set up here, then you'll have access to capital from professional investors who have a track record of investing and supporting projects at an early stage. So I think, the range of community, regulatory clarity, blockchain infrastructure, ecosystem, incubators, accelerators, government support is all there. The one challenge that I would say is happening at the moment is in terms of setting up a company here that issues a token. At the moment, there's no regulatory clarity on that aspect. And finally, with regards to banking account setups, the central bank hasn't issued clear guidance or regulation around crypto assets and crypto companies. So you'll have to find your banking solution elsewhere. And I think the DMCC Crypto Center, which CV Labs Dubai is managing and supporting, has alternative solutions to address that area. But overall, I think we're in a really, really good position here and a really good time to move your operations here as well.
Absolutely. Now we have a lot of local voices in the group, but we do have an international voice represented. Now we've talked a bit about the essentials, and it seems that Dubai has those quite well covered. But Josef, what exactly sets Dubai apart as a location when pitted against other hubs? Because you guys, of course, are very familiar with sort of the Silicon Valley approach and other international hubs. Why Dubai?
Yeah, I hope you guys can hear me now.
Perfect.
Got crappy Wi-Fi here, so apologies for that. Saeed has covered a lot of it, but one of the biggest differences between California, where I've built the fund with Draper and Alon, Goren, my partners, is just the regulatory friendliness from the government. Like it's not a fully baked system yet. They're still working on several parts of it, but the government is very open to crypto and blockchain technologies. Quite to the contrary of the United States, for example, where you have big elements in the government trying to, fight this and kill it in its tracks and not allow this to succeed, which is one of the reasons why we're here, because we see, I have conversations with portfolio companies and friends every
Oh, Josef, we lost you again there.
Again. I'm starting to get very suspicious of his terrible Wi-Fi connection. I was told Dubai is supposed to be mainly 5G by now.
4G is everywhere at the moment. 5G
Standard.
Dubai is the fastest country after Japan, so it is the second country worldwide.
So I guess Josef just knows how to pick his locations. User error in that case.
Yeah, it is.
In that case, while we wait for Josef to reconnect, I'd be curious. Of course, a lot of you have very close ties to institutions. I'd be curious to know, how have institutions reacted to sort of the growing number of blockchain companies that are flocking to Dubai? Since, let's say, the beginning of 2020.
I can take this one. Then Saeed, you can back me up on it as well. So what we've seen is, first of all, the PR companies started moving here and really covering up the story of Dubai and the narrative that this is becoming very quickly the hub for crypto around the globe, basically. And then soon after, we started seeing events companies moving here. And then from there, of course, the VCs and the boutique investment companies, especially the ones that deal with crypto, started moving here, and having local people also start their own funds and having crypto in their portfolio helped a lot, especially with family offices and the funds around those kind of companies. Saeed?
Yeah, maybe I'll segue onto institutions kind of deploying capital into the technology and into infrastructure and ecosystem. I think the larger family offices and the high net worths are certainly deploying capital into the market currently, especially in the region. The larger institutions, I think, are still kind of wanting to have a lot more regulatory clarity around blockchain technology, especially from the central bank and from ESCA, the onshore regulator. So I think they're just playing a waiting game. It's just a question of when and not if the larger institutions are going to start, really supporting the infrastructure and ecosystem in the region. But I think I'd like to hear from Fatma at Do, because I know Do has a really, really well developed blockchain as a service platform, and they're servicing several UAE government agencies as well. So Fatma, would love to hear more from you about that.
Yeah, definitely, Saeed. So in Do, as you know, Do is a telco organization, one of the biggest organizations in the UAE. And we are from the new business and innovation. We actually support the government and federal across all the customer segments, so federal entities, government, and small and medium business in their digital transformation strategy, where they can actually transform the as-is solution to an awesome to-be scenario or use case on blockchain. So what we have done, as Saeed mentioned, we build a full stack blockchain as a service, where our customers from different segment and different industry, they can leverage the blockchain infrastructure, but not only infrastructure, the other elements as well, IDEs, ready-made features, in order for them just think about the use case they want to leverage, and we will support from the back end on everything.
Yeah, I think
Based on that, yeah,
Fatma, we were one of the first people to actually jump on the
exactly.
Do platform, and I'm very happy to say that you were very supportive, very actually at the forefront of creating backend solutions, so the people who are not familiar with blockchain technology can focus on their project rather than focusing on building the infrastructure, which was very helpful in moving Dubai very quickly within the blockchain space.
Yes, exactly. Thank you, Dr. Marwan.
It's nice to get such positive feedback, no? Now, we've already hit
Yeah,
on...
true.
Exactly. We've already hit on the role that particularly regulation plays in sort of cementing the role of a blockchain hub that is hoping to attract a lot of business. But what lessons can Dubai as a jurisdiction draw from other jurisdictions, both what to do and what not to do?
I think, look, us in Dubai, we don't, jump into new things without studying them. And of course, with everything we did, even with things like e-government and smart cities and things like that, we always look at what others are doing, and we actually, rather than with them, go to them with special, delegations and look at what they're doing and lessons learned from their experiences, and then we try to avoid the mistakes that they made, and then leverage Dubai's strength in actually creating ecosystems that help from all aspects, from the funding, from the ecosystem, from the talent pool, and also from even things that people take for granted, which is infrastructure. You've seen that if the connection is bad, we cannot have a conversation. So all these things that people take for granted are available in Dubai. It's a very safe city to be in. It's a very safe environment to do business in. The judicial system is amazing. It's swift and fast. The regulations are mature. We have, for example, the IFC, British common law, their international court as well. So all of these things, all these elements that are taken for granted by people who live in Dubai are actually a game changer for somebody who sees it for the first time. And I think this is a part of the attraction for Dubai when it comes to even things like crypto. We're not perfect, but we are doing our best to make this a really good, wholesome environment for somebody to go in.
Joseph, let's give it a go. What lessons do you think Dubai can learn from other jurisdictions?
I'm scared. Every time I say something, my Wi-Fi gives up.
You're good. You're good now, bro.
I think one of the big advantages that Dubai has is that it can move very quickly, right? They don't have a Congress, no Senate to deal with. It's a top-down kind of government system that in this case works very well. So if the top of the government gives a directive, then the rest of the government just executes it. They don't argue over it. And I think that's what we see here. They decided that blockchain is good for the country. Crypto is the future, love it or hate it. And it's something that we discussed actually with Ahmed bin Sulaim on our fireside chat yesterday, where he made it very clear, regardless if you're a fan of this or not, it's the future and Dubai wants to be a part of it. And I am very impressed and excited about the way they're implementing it, the speed at which they are doing this. And that's what attracts us as outsiders to bring outside capital and help strengthen and grow the ecosystem here.
No, absolutely. Of course, the blockchain space itself is no stranger to certain tensions. Joseph, you already dropped the SEC name earlier, but often at the end of the day, right, often tensions arise between companies and startups and institutions and governments. So what do both sides of that spectrum need to consider when they interact with each other?
Is this for me?
Anyone in the group, guys.
You've spoken the least, Joseph, so you should take a stab.
Saeed, go ahead. I'm so terrified about my Wi-Fi.
No, I think for me, look, there's two sides when it comes to blockchain and crypto. You have the traditional world, which I was fortunate enough to be a part of when I was working for Abu Dhabi Investment Authority for 9 years before I switched over to the blockchain and crypto space. And obviously, they're more cautious. The more capital and the more wealth somebody has, it's just human nature for them to be more cautious and want to take less risk with that capital. But then you have the new world of crypto and blockchain, where it's mostly actually millennials and the younger generation that have embraced blockchain and understand the value of crypto and what it brings to the table. And they're just, kind of fed up with the kind of centralized approach to everything, and they want a more efficient and decentralized manner of participating and doing business. So I think to be successful, you have to balance both sides. And I think if you can speak the language of the traditional folks, and then also understand the needs and wants of the newer generation and the blockchain people, and just find the right kind of balance and common ground, then I think that's an optimal solution. I don't think you can ignore either side. If you're a project or a business that wants to be successful, then you have to, be kind of open-minded and hear the concerns that both sides have and try to address those. If you're just focused on one side, I think you're definitely missing out, and you're not taking everything into account.
No, absolutely. What are the potential avenues you think for that type of collaboration or just knowledge exchange? What do you think has worked well in other cases?
Yeah, I think in terms of the regulation, especially in terms of regulation, you have the likes of the onshore regulator, ESCA, and they're kind of listening to and taking opinions from the institutions and the traditional people. And then they're also inviting the participants in the actual market, like the real players in the market, like exchanges and the picks and shovels and service providers in the industry, and they're getting their opinions and they're doing working groups, etc. So I think leveraging both sides when it comes to especially making decisions, and especially when it comes to regulation, it's very important to take into account that you're not over-regulating and you're not under-regulating, because if you're over-regulating, you're stifling innovation, and if you're under-regulating, then you kind of not really protecting the consumers and the participants in the market.
It's a delicate balance to strike, I think, absolutely. Now, we've touched on that axis of sort of capital, talent, and infrastructure before. What on that front do you think still needs to be done specifically in Dubai in order to help it unlock its full potential as a blockchain hub?
I think, look, there are certain technologies that
we're losing Dr. Marwan now. Fatma, you want to have a go at it?
Please go ahead.
Yes, so I believe the regulation, the regulation should be actually more adapting the new technologies, the new solutions in order for them to scale, as well as the adaptation of the other niche technologies beyond the blockchain. So blockchain can actually work with a lot of industries and customer segments, but it needs also other technologies to support and complete the solution end to end, like AI, IoT, and so on. So looking to the solution from the overall solution, and we don't actually focus on certain technology or receipt. We need to focus more on the innovation and the market need. So this is in my view.
Yeah,
On the talent
maybe
side,
I'll add to that. Yeah, I'll add to that. That I think at the moment there's brilliant ideas and talent that's coming in from outside. But what I'd love to see is kind of the educational entities trying to encourage the young UAE national talent to actually come through. So one of the reasons why I'm actually very much actively participating in conferences and events and panels like this is to actually show that there are UAE nationals who are embracing the market and embracing the technology and are passionate about what they're doing. And I want to see the younger UAE nationals here in the region and the younger local population to actually see somebody who's taking the risk and who's actually actively involved in this market and taking a lot of risk and trying to educate people. And then that would encourage them to say, you know, like, actually, if Saeed's done it, then why can't I do it? I mean, I started from zero knowledge of blockchain and crypto, and over the last 5 years, I've built that slowly and gradually, and I've leveraged, you know, my network and partners and friends and colleagues who have already been participating in the market. So, you know, my door is always open for anybody who wants to learn about this space. I think Dr. Marwan is a great role model for us as well, for the younger talent. So I really want the UAE nationals here to embrace the technology and learn about it and get some exposure to crypto as well and make the mistakes that we have all made. And I'd love to see that happening here.
At the end of the day, I think on the talent front, there's always room for improvement, right? And the Dubai Blockchain Center is a huge part in making sure that next generation of talent gets educated and has the tools in order to sort of bring on that innovation that's grown locally, which is an essential part. Dr. Marwan, I want to give you the opportunity to respond since we unfortunately lost you tragically earlier.
No problem. So I think education is twofold. So it's one of the things is not only teaching people what the current technology is, but also open their mind of where the puck is going to be. And in this case, you know, looking at the younger generation, we actually do a class. It's a 3-day class for government departments here in Dubai under the Dubai Future Foundation, and we teach them what blockchain technology and cryptocurrency are going to look like in a couple of years, maybe in 5 years, 10 years as well, and have this kind of interactive workshop where they can discuss the ideas of what they think DeFi is going to look like in 5 years or 10 years, what NFTs are going to look like in 5 to 10 years, and what do you think this whole technology is heading towards. It's amazing to see how people, if you provide them with just the basic knowledge, what use cases and ideas they can come up with. And another great idea for Dubai is actually creating spaces where there are collision spaces. One of the spaces is, for example, DMCC Crypto Center. There's another space which is One Central in Dubai, where there are crypto companies, startups from all aspects of life in the same building as Dubai Tourism. So it's an amazing collision space between, you know, creatives, between people who are influencers, technical people, people working with cutting edge stuff like crypto. Collision spaces are very important, and a lot of people don't realize this. When they create hubs for specific technology. The hubs should be around, you know, the idea of making people from different walks of life run into each other and get introduced to each other's, you know, perspective as well. And this is, I think, what Dubai did very nicely with things like Area 2071. Abu Dhabi has done it also with Hub 71, and you know, we've seen more and more places like this popping up in the UAE and across the world as well.
Yeah, maybe Absolutely. I'll point towards the USA as well, and I'll let Josef talk about that. But I think I'm very impressed with all the universities and colleges in the US that are actually providing qualifications and training courses and educational certificates specifically to blockchain. And I think, if I'm not wrong, there is also Draper University. So maybe Josef can talk about that as well, if he's there.
If we have him. we see him, he's with us in spirit. I think unfortunately the audio might be cutting out again.
And I think we are also taking this connectivity for granted. If you look at it physically, we are the furthest 2 points on Earth.
Oh,
Oh goodness, one casually after the other. All right.
Fatma,
Well,
are you
it's
seeing
a
any
valiant, it's a
Fatma, are you
valiant
seeing any
effort.
colleges or universities that are
Yeah,
doing this?
so yeah, true, Saeed. So we have Zaid University and Khalifa University. Both of them actually they're encouraging the students to start doing researches on blockchain and on different technologies. And I myself actually I did a lot of mentorship for the students in Zaid University and Khalifa University. So it is there, and students there, they even in the third year and the fourth year, they know what is the blockchain is and what the benefit of blockchain and the technology and so on. And they actually totally aware of the benefits, but not only benefits, the use cases across different industries. So I wanted to tell you that. So yes, Zayed University and Khalifa University, both universities, they have this initiative, and their students actually they work on researches on blockchain and on also different technologies.
Now we've hit on talent, we've hit on its potential. I'd be quite interested from you guys. Are there any particular areas or industries or topics where you believe that Dubai-based startups or Dubai-based talent could emerge as sort of the next rising star? I know you guys at Sheesha Finance are very heavily involved in the DeFi space. Where do you see, how do you estimate the local, really like the local, the local talent could be rising in that space?
Yeah, I think one of the industries and one of the markets in the UAE and in the region that's always been kind of mature and where there's a lot of capital invested is real estate. So I think greater innovation in the real estate sector and more specifically with tokenization of real estate or fractionalization of real estate assets, I think that would be an area where there would be good scope for innovation, and there is a large market for people to capture that market and digitize that market. So I think where most of the money is and where the biggest market cap is, that's where you'll see the most opportunity, and that's hopefully where you'll see the most innovation.
Joseph, let's kick it out to you. Where do you guys with Draper, Goren, Holm see the most potential?
I'm sorry, I didn't hear the question. I had to refresh the window
No
again.
worries, let's try again. So particularly when it comes to Dubai, are there any particular areas or industries where you are paying particular attention because you think Dubai could emerge as sort of a rising star in this specific field?
I think there is a lot of potential in token launches and regulating token launches and security tokens. That's something where Switzerland has been pretty good, but there isn't really another jurisdiction that really excels at that. So I think that will be one of the big things. But we as a fund, we're use case agnostic. We look at the highly regulated digital assets, security token side of things, and then the highly unregulated DeFi side of things. And I think there is potential in all of those areas for Dubai. As far as we're concerned, as an early stage blockchain fund, we invest in teams with great ideas, and to us it doesn't really matter so much which vertical they're in. So I think there is, and we're so early in this game too, right? So there's a lot of potential in all areas of this industry for Dubai to really excel, as long as they build a framework that's sensible and reliable and not like we talked about yesterday on the fireside chat, like essentially playing Russian roulette with the SEC and never knowing when they will come cracking down on you and what will happen to your startup or from our side to your investment. So I think that Dubai is in a really, really good position to take the lead globally, frankly, to become that hub where startups and capital and investors, have clarity and security and know which framework to operate in to be successful. And again, then it doesn't really matter the precise vertical.
I'm curious to hear Fatma's thoughts on NFT as a use case, and if Do is looking into that or utilizing that.
Yes, Saeed, but I cannot disclose this information, to be honest. So,
It's just us and 20,000 people on the live
Yeah,
stream.
you're fine.
exactly.
No, it doesn't have to do. It doesn't have to be what Do is doing, but what Do is seeing in the market around NFTs, maybe.
So we see actually great demand in the NFT, and maybe that's why we are working on certain use cases, but I will not disclose them as well.
Either way,
That's
the
good
fact
enough.
that you guys
Good
are
for me.
actively involved in it must mean you see some potential. So we'll take that. We'll take that.
I think Dr. Marwan has been doing some really good stuff with NFTs, specifically around cars. So that'd be good to hear about.
Yes, so we're creating a number of things. We're experimenting still within NFTs. So for the cars, we're doing cars that are in real life wrapped with art, digital art, as well as augmented reality, virtual reality, as well as moments associated with these cars. In addition to that, we're doing NFTs for real life items as well, whether it is agriculture or fisheries, or even labeling different types of unique merchandise. Is an amazing use case for NFTs. And one of the use cases that have actually moved to Dubai is called ice caps, where you actually can buy real life diamonds on the OpenSea platform. So, and there's also a platform called Galaxy of Arts that has already been established in Dubai, and Dubai World Trade Center Authority is another NFT platform created by French people who moved to Dubai, called Jumi as well. And they're doing purely digital art with frames and that you can display in your house. So there's a lot of them also popping up every day, especially around gaming and the metaverse. And I think Dubai is slowly becoming the hub for not only crypto and NFTs, but also esports and gaming.
At the end of the day, there are a lot of, let's say, industries, right, where Dubai already excels: commodities, luxury goods. Where do you see, or how do you see that potentially linking into the different possibilities that blockchain presents?
I'll give an example. So in a couple of weeks, we have Dubai Watch Week, which is taking place in the IFC. And within that conference, in the Watch Week, we actually have a special session on NFTs and how they are associated with luxury goods. There are already companies that are looking into that, especially for collectibles. So as you collect, real watches, people are now collecting, Nike shoes in the metaverse. They're collecting special watches and special items, luxury items within the metaverse. So when you buy a real life item, you also get the metaverse equivalent of that item. So, and a lot of other, utility based. So you're getting discounts and exclusivity to buy certain luxury items like bags or goods, and get first in line and some, drops, whether it is in the virtual world or in real life as well.
Yeah, no, absolutely. Now we've talked about sort of Dubai's role as a hub, how it's growing into that role. I'd be curious to know, how specifically can or should Dubai interact with other blockchain hubs? At the end of the day, this is all part of one global network, right? Decentralization means that we are positioned in a very global industry. So how does Dubai factor into the greater global picture? Josef, I know you already mentioned that you think it will emerge as an absolute leader. I think everyone in this group agrees, but what will that interaction look like in the future of that role?
But it's not a binary world, right? So there will be others as well, and I think that in particular, CV Labs at the DMCC is doing a great job of building two ecosystems that support each other. And at the end of the day, I think it's all about collaboration. That's what we are very big on as a fund, as a venture studio. Also me personally, right? I think that there's Dubai alone can't succeed. Switzerland alone can't succeed. It's one tide floats all boats or raises all boats, and that's kind of like how I look at it. So the more collaborations there are between countries, between ecosystems, all working towards the same goal, the better we'll all be off, right? It's very, very simple. This is a global world. We all live on one planet, and if we don't pursue our shared interests and help each other out, no one is going to succeed. So it's very straightforward in my opinion.
I totally
Dr.
agree.
Marwan?
I think Malta has been very helpful to us here in Dubai as well as Singapore in coming up with regulations around both cryptocurrencies as well as gaming. So we are not in a vacuum. We're not in an island. I think we are very well connected and very well, very friendly with other countries that actually help us in moving this industry forward. And I think everybody plays a role and everybody adds to this rather than compete.
It's friendly competition, right? There is certainly competition, but it's also collaboration, and that's in the end what's going to work.
Yes, exactly.
Saeed, how do you think Dubai will fit into the greater global picture?
Yeah, I think Dubai has always been kind of a central hub, especially for travel. So I think, it's easy for us here in Dubai to reach many different countries. And I know that, for example, the Emirates Securities and Commodities Authority, they have been in close communication and dialogue with, the FCA, with the Singapore authorities, with the SEC, and with other jurisdictions when they're actually considering the onshore framework and regulation, which they're consistently studying and hoping to deliver in the near future. So I think, we also are a very neutral country, which has very close diplomatic ties with so many other countries out there. I think at one point the UAE passport was one of the top kind of passports where you can enter so many different countries with the passport. So I think leveraging on our close diplomatic ties with many countries, we're able to kind of get through to the right people and the right industries to kind of collaborate and work together. And I think just as the same as it is with companies in a new market, where if you have the right partners and you strike up the most amount of partnerships, then you have the best chance of success. And I know, like with Sheesha Finance and Draper, Goren, Holm, we have a really good kind of partnership, because I know DGH really invests early stage on the equity side. But then with the case of one or two of their portfolio companies, Sheesha Finance has come in early stage on the token side of these companies that DGH supported on the equity side. And we're like kind of taking them onto the next level on the token side. So I think collaboration between the regulators and the market participants is always very important. And you can't work in isolation. The world is closely connected. Travel is easily accessible to everyone. So I think if you're not leveraging that and communicating with everybody, no matter where they are in the world, then you're kind of missing out there.
Missed opportunity, definitely. Fatma, on a closing note, I'd like to pose the same question to you.
Well, as Dr. Marwan and Saeed mentioned, so once we have the regulation set in the country, we'll be able to open with other countries. And as Saeed mentioned, Dubai is always the hub of innovation and the hub of the use cases and solutions, blockchain solutions, but also it's providing the exposure to different blockchain network across the universe. So again, the regulation, once the regulation is set in Dubai and also meeting the regulation with the other blockchain networks, we'll be able to integrate with each other.
Absolutely. All right. Well, I think I speak for everyone when we say that we will keep a close eye on Dubai and see what happens in the coming months. I think it's far from over. To the four of you and Ralf in spirit, thank you so much for taking the time and joining us today. To the 20,000 people that have joined us online virtually, thank you so much for taking the time. Please do enjoy the rest of the LA Blockchain Summit. Goodbye, everyone.
Goodbye, everyone.
Thank you for having us. Bye.
Amazing insights there from a really diverse panel. Now we're talking about investing in sustainability, inclusivity, and of course, diversity. Ali Madhavji from Blockchain Founders Fund will be speaking with Andrew Tan from Draper Dragon, Matthew Friedel from Milwaukee Venture Partners, Jesse Draper from Halogen Ventures, Neha Mehta from Femtech Partners, and Kendra Ragaz from Accrue Capital. Really excited for the conversation. Enjoy.
All right, welcome to our panel at LA Blockchain Summit. Our topic, as mentioned for this session, is investing in sustainability, inclusivity, and diversity. Now, there are a lot of critical and unanswered questions that I'm sure our audience here has for our panel, and we're going to try to explore and provide answers to those questions. It's great to have so many friends and audience members tuned in from all around the world. I'll be your moderator for this session. My name is Ali Madhavji. I am the managing partner at Blockchain Founders Fund, which invests in and venture builds top-tier startups and consults organizations such as the United Nations. I serve on the board of two public companies in the blockchain space. One is CryptoStar, which is a Toronto Stock Exchange venture company, and the other is Mechanical Technologies, a NASDAQ-listed company. And I serve as a senior blockchain fellow at INSEAD. But more importantly, we have a phenomenal panel here with us today. First off, we have Andrew Tang, who is the managing director at Draper, Goren, Holm. Matthew Friedel, co-founder at Milwaukee Venture Partners, a female-led angel network. Jesse Draper, the founding partner at Halogen Ventures. Neha Mehta, CEO and founder at Femtech Partners. And Kendra Ragaz, partner at Accrue Capital. But let's jump into it. Let's start with the elephant in the room. Many people think of Bitcoin, and oftentimes they're categorizing mining as wasteful, bad for the environment, and not sustainable. It's not too widely known to the public, and I'm sure the majority of our audience would like to know, can blockchain really be used for good? And what about Bitcoin? So Andrew, let's start off with you. What are your thoughts on this?
Yeah, I think it's a sort of a very interesting, superficial look at blockchain and the power of mining. If you look at the number of blockchain projects compared to the number of banks in the world, you know, it's an order of magnitude. And if you look at the number of mining rigs, these mining computers, versus the number of mainframes that financial institutions use in the world, another order of magnitude. So really we're talking about, it's a very efficient way to conduct financial services using much fewer number of computers and CPUs. And in fact, if you look at Bitcoin and some of these earlier technologies, since then we have had a lot of proof of stake blockchains now being brought online, and doesn't even require that much mining. So I'm actually thinking, even at the proof of work, it's an improvement from existing financial services infrastructure. And when you take it to proof of stake, that is yet another 2 to 3 orders of magnitude. So it's actually a misunderstood observation.
Thank you, Andy, for that. Kendra, what are some of those misconceptions around blockchain itself and its applications for doing good in the world?
You know, I think importantly, the blockchain has the ability to do quite a bit of good in the world. That is very important for just our broader society. Number one, it provides a lot more transparency in all sorts of industries. And that's good for everyone. It also takes out a lot of costly middlemen, making things, you know, far more accessible to people. And then I would say, you know, at our firm, we do a lot of fintech, traditional fintech investing as well. And one of the things that this does is really provides more financial inclusion. So if you look at the numbers of, let's say, Black or Latinx investors in crypto, it's far greater than other traditional asset classes in that it is more accessible. And it's also, there's just far more attractive opportunities for many people who feel that traditional investing opportunities have either excluded or even exploited them. So I think there's a lot of opportunity and a lot of really positive elements of blockchain.
Fantastic. And Matthew, as a seasoned executive, what are some things that you're looking at from, a Milwaukee, venture partners perspective on where blockchain can help solve global challenges?
Yeah, that's a good question. So one of the other hats that I wear is I teach at a university. And what I tell my students is that I think the really exciting opportunities coming down the pipe are on blockchain, what I call 3.0. Anything that is heavily regulated, where there's a third-party intermediary that can be, eliminated or moved to the side is a candidate. So on the government front, digital identities, healthcare, anything that requires some level of bureaucracy, I think is a candidate for, these applications that are going to be coming down the pipe. And what's interesting is that I think people have a misconception, one, about cryptocurrency, but also about what blockchain is in its nature. And if you think about it, try to describe the internet to somebody in the early 90s, right? It's hard to do. But we got these platforms that came down the channel, and then now they're a part of our daily life. I mean, crypto is a part of our daily lives. And soon, blockchain application 3.0, which alleviates some of that bureaucracy, are going to be in the mainstream and just make our lives better.
Absolutely. And Jesse, do corporates or governments, see the sort of potential with blockchain that we're talking about here? What are some of the major hesitations they still have on the technology that you're seeing from, say, your portfolio?
There was actually a really great article in the New York Times a couple of days ago saying how at first the government and the banks were really repelling blockchain and Bitcoin and all sorts of crypto, and now they're starting to embrace it. I think, especially with the launch of ETFs, and then all of these other, I'm very excited about Flow right now and all of these other types of crypto. Something I would like to say, though, is as a female, and I invest at Halogen Ventures, we invest in women. We have 70 portfolio companies. There has to be a female in the founding team. We don't discriminate. We have 3 male CEOs, I'd like to say. Something I'd like to say is recently, I almost wanted to just sell everything. I wanted to sell all of my Bitcoin and my crypto. And it was because I had retweeted something that someone had been tweeting online that said, hey, let's try and get Bitcoin to 69,420. And I retweeted it thinking, yeah, I want it to go higher too. Like, we're all excited about it. We can kind of make this market go the way we want when we're big, passionate Bitcoin crypto holders. And that is disgusting. What I didn't realize was 69,420 was a whole bunch of men hoping that it would get to 69,000 because it's a sexual position, and 420 because obviously of the pot sort of National Marijuana Day. And I think that is a problem. I'd encourage more women to get into crypto. It's a real opportunity. And I think that the bro culture in crypto really needs to change. And so that's something that I'm frustrated with today. I understand we attach ourselves to these different numbers, but as a female in business and technology who's excited about crypto, all of you men holding this crypto, please don't tie it to sexual positions. That's disgusting. But I think there's so many opportunities, to Kendra's point, it's the democratization of wealth as well. As a VC, I have to fundraise from these fund of funds and endowments that are managed by about 20 advisors. There's like 20 advisors who control the majority of the billions and trillions of dollars of wealth in the world. So that means 20 organizations making those decisions for venture capital. What I'm really excited about is how this will completely diversify wealth in general. Different people will have access to different types of capital and be able to invest in different opportunities that they were never able to do that before, and less of these organizations that control the majority of the wealth will be in control.
I definitely, believe sort of that, the distribution of wealth is going to create a lot more opportunity. I think we're already starting to see that with crypto. I do want to dive deeper in a moment into some of the things that you mentioned, including, female-led companies. And we're going to come back to that in a second. I think this is a really important topic. We're actually LPs in Draper, Goren, Holm, but also another fund called Loyal VC, and we've got 39% female founders and growing. And so it is definitely a focus that we have on some of the things that we do. And I think it's starting to grow, throughout the industry. I think from this first piece, we heard a little bit about some of the misconceptions around Bitcoin and sustainability, where blockchain can start being used, more responsibly to actually solve global challenges. But I do want to dive deeper into this inclusivity and diversity piece. So in the traditional world, there's a lot of talk about a lack of diversity in the investment world, including underrepresented founders in different categories such as gender, race, religion, sexual preferences. Kendra, I want to start with you. How does Crew Capital approach inclusivity and diversity in your investment thesis?
Great question. So first of all, we're a very diverse team. So 90% of our investing team is a woman or person of color. So it's sort of just core to who we are. And as a result, we also have different networks, which we would argue has enabled us to generate above average returns. We think of that as being really positive. By the way, we also are multi-generational, which that's a separate subject, but we also believe is really powerful in terms of our investing. So, as a result of these different networks, we certainly have a much higher percentage of diverse founders in our portfolio than average. The other thing that we do is we really bring in our networks in terms of both in advisory and in board roles, and also as people seek to diversify and fill out their executive teams. And as we all know, I think now it's widely accepted that diversity drives better outcomes. So, we've really found a lot of reception from our founding team, some of whom are not diverse, but want to add more diverse members, and they're really grateful to partner with us. And then more recently, we raised our first growth stage fund, where we've primarily been early stage investors. And because we were continuously asked for more diverse representation, we've had a new sort of focus, both back to Jesse's point about democratizing some asset classes. We invited diverse executives to invest in our growth stage fund alongside our institutions. And what that's done is also created an incredible pool of talent and perspective for our portfolio companies. So I think your original question was actually, how do we look at it from our thesis driven approach? We look at our investments as we would with anything. I just think that we ask different questions than the average VC firm, and so we therefore have more diversity in our portfolio.
Well, absolutely. I think you mentioned a few really key points that I want to emphasize here, right? So, I think there's the thesis perspective, but there's all of these building blocks and all of this infrastructure that you're putting around it, right? So that advisory board that you mentioned here, we talked a little bit about it before the call as well. Having diverse experts or diverse advisors that can come in and mentor your founders, potentially serve on their boards, I think also start to create more of that ecosystem of diversity of thought and make it more natural in organizations. Andrew, In Draper Dragon, what are some of the challenges and barriers that we need to solve for further inclusivity and diversity in the investment world, and what are some of the things that Draper Dragon's doing?
Yeah, I mean, clearly, I reflect upon even just my engineering school days. You look around, and clearly, it's not a true representation of what the optimal, class looks like, and that, that sort of mix, when you take that to the business world, to the tech world, it has changed very little. So even though, we, from the Draper ecosystem perspective, we always have this goal to try to really diversify our, either our investment team or portfolio company, we do realize there's a more deep-rooted challenge. So we got to go back to the education. And that's why we have Draper University within the Draper ecosystem. We really try to go back earlier in the value chain and see if we can talk to more young people and encourage them to go into entrepreneurship or venture capital or tech. And I'm happy to report we have already, the Draper University has been around since 2012, 3,000 graduates, and we have about 30% women going through the program. I know it's still not up to par, but I tell you that number is much higher than my engineering class, undergrad and graduate school.
No, I mean, I think for the venture world, I mean, I've seen data, 2% of traditional, funds are female led, right, investments. And so, and that number has been growing, but much too slowly. And we need to be doing better. And I think the things that, Draper University is doing, Jesse Draper mentioned with Halogen, I think are phenomenal for the industry. Matthew, at Milwaukee Venture Partners, you guys are very early stage, right? My understanding is you're coming in at sort of the angel
pre-seed or seed rounds,
or seed round. Can you tell us about what you're looking for, from a diversity perspective? How do you guys value this, and what are some of the challenges that you see, maybe downstream as you look at how do your companies then go get funded, after that?
Yeah, so we look at not only the deal and the opportunity, but the first criteria that we look at is the team itself, the founders and their vision. And there's an analogous statement saying sometimes we bet on the jockey. And I think Kendra alluded to it. There's been tons of research that have said the more diverse you have in your team, the more successful you are. So we look for not only diversity in terms of backgrounds and perspectives and things like that, but we also look for passion and genuineness in being able to deliver that, because being a lifetime entrepreneur myself, it's those lowest points can be challenging, but if you have that passion, if you have that integrity, if you have a customer focus, these are the characteristics that we hold very strong in the type of deals that we are looking at. And then just one more point, so again, we're female led. We're an angel network, so we're all individual accredited investors. We're not a fund. So I would love to say that there's a magic bullet that we can have to add more diversity. But what we've done is had a very open book, open group policy. So you can come to our dinner meters where we're evaluating and then see how kind of the sausage is being made and kind of breaking down some of the barriers that are associated with, these type of investments.
Absolutely. No, that makes a lot of sense. And maybe you can dive a little bit deeper into, what you mean by female led as part of that angel network. I understand that there's probably several different layers to look at, right? There's sort of the investor group being sort of diverse. There's, what Kendra was mentioning as well with some of that advisor and infrastructure that can go and support the companies. There's the portfolio companies themselves that could be diverse. And then there's probably even their customers that could be diverse if you're targeting sort of different markets, right? And so, what areas of that are you looking at, Matthew?
Yeah, specifically to Milwaukee Venture Partners, the way that we structure it is we're a nonprofit volunteer-based organization. So our leader, Karen Plunkett, is the managing director, and then she's on the board as well with that. That kind of drives the viewpoint that we look at in terms of our, portfolio company. So it stems from a culture that we're creating inside of our organization to be inclusive, wanting to not only add additional accredited investors to our group, but also what do the founders look like? What are their vision? You know, what is their mentality? What are their morals? You know, that all drives us. So if we see a deal that's really great, but it doesn't align with our values, we will probably pass on that.
No, it makes sense. And Jesse, go ahead. I think like I'd be interested to hear, you know, your thoughts on, you know, aspects where, you know, Halogen's getting involved, but even is there things that you're also doing to facilitate or improve diversity and inclusivity within the portfolio companies themselves?
Oh, definitely. You know, when I started this, I was like 10 years ago, I was running a technology talk show, and I was only interviewing men in tech. And I made this initiative to interview 50% women in tech because I just didn't see, I just was like, how am I only interviewing men here? We need to, you know, increase the amount of women in technology. And in order to do that, we need media exposure on these women. And I got inundated. I call it like the Batwoman signal. It was like I had sent out this crazy signal for women. And what we've learned now over the years by investing in these incredible women is we're seeing thousands and thousands of deals, and we've made over 50%. Over 50% of our founders are minorities of some sort, and we think of diversity of age, race, and gender in every investment we make, because we know those things will create stronger businesses overall. The data is there, and you want people with different backgrounds and different cultures and different, just different experiences, bringing those things to the table. And we do have one of our male CEOs, who I actually sit on the board of this company. When I invested, I said, hey, you know, I don't see a lot of women here. I think we need more women here. And he has taken that to heart, and they now have over 50% female employees. They're thinking about women at the board level all the way down. Something I'd also say for the venture funds and any kind of fund out there now is the ILPA, which is sort of like the standard fund of funds gigantic 100-page deal memo that you have to fill out if you're, taking investment from someone. They have this huge section now on ESG. And it's really, really important that you're looking at ESG from at the board level, at the founder level, at the employee level as well, because they're starting to make sure that things go through the entire organization. Versus just, putting women and diversity on boards. They want to make sure that you are, walking the walk all the way through. And so, but I think that's a really good thing. I think the companies will be stronger overall.
I agree. Like, I think that, helps them be better, faster, stronger. And I want to open it up a little bit and dive a little bit deeper into this topic, right? Because at first we were talking about, a little bit more on the investment thesis, investment process, like that sort of aspect where you're looking at diversity, sustainability, inclusivity. But what about post-investment support? So what sorts of things, and Jesse started to touch on this, but what are some of the sorts of things that, Kendra, Andy, Matthew, you guys are doing with your portfolio companies after you've invested, on some of these topics?
I'm happy to start. I think, and Jesse, by the way, I love what you're doing, and super grateful for everything you are doing. I think there's another element of diversity that I think is becoming more and more important to our founders. And we were actually seeing our founders naturally do this, which is diversity on your cap table. So to go sort of more broadly, I think there are varying figures, but of the $71.3 trillion of assets managed in the US, I think the number is something like 98.3% is managed by a fund owned by white men. So, and I think the ownership percentage is something like 25%. So that number could certainly be sliced and diced in all other ways. I think no one would argue that that number is good for us for the long term. So we were seeing some of our founders go out and create SPVs. So we were seeing our female founders say, we love working with you, A-Crew. You guys are diverse. You get our story. You understand the pain point from the female consumer or from a services perspective. You've helped us with our team. we want to make sure all this value that we're creating is, is really benefiting a broad group of shareholders. We really want to make sure that we're being very inclusive in wealth ownership opportunities. So, that's one thing that we've done with our new Diversify Capital Fund, is just really expanding wealth generating opportunities, and our teams love that. In terms of very specifically with diversity, we've done a number of things. We will do workshops on how to promote and support risk-taking. That's actually something that women tend to have a harder time doing in cultures, as well as underrepresented minorities. Also just, promoting more inclusivity. And, candidly also just, we work really hard in terms of trying to make executive connections and then also customer connections for our companies. So there's a whole, list of things we do. And I know nowadays in venture, everyone works really hard to be a good partner to their companies. But I think having a diverse team, we can bring a really unique sort of value to our portfolio companies, or we'd like to hope we do.
We're seeing a lot of that, Kendra, as well. We just did an SPV with a company that's much later stage than we typically do. And the CEO was sort of like, yeah, we're going to go public. It's going to be great. We're going to make a lot of people a lot of money, and we want to make sure we get in. We have this allocation for specifically women and POC because we want to make them a lot of money. And I'm seeing that more and more, and it's such a cool thing that that's how they're thinking about it.
Yeah. It is great. It's really important.
I guess Andy, Matthew, go ahead.
I was going to share just one of the things we do with our post-investment support. So the Draper ecosystem, we have over 1,000 portfolio companies. So one of the biggest value that we provide in some ways is to kind of not bother the founder, but yet let the portfolio companies get to know each other. And most recently, I observed a very interesting observation. So we invest in Ledger. It's the leading hardware wallet company, and they're based in France. So on their board, they're actually chief diversity officer, and they're governed by the French law. You got to have a certain amount of diversity. So my first reaction as an American was, oh my God, more regulation. I don't like it. But what I learned from that was the regulation itself may be an overhead, but the concept and the philosophical driver of the regulation is actually really good. So what we did was we took that philosophical approach of recruiting more women and have diversity and have a person on the board who's in charge of diversity, right? It's no different from having an audit, chair and, finance chair. In this case, we have a person who's supposed to look at diversity. What it does, especially for blockchain company, is that I think to Jesse's point earlier, there is a little bit of bro culture, right? So we got this awesome technology, but very unusable user interface. I mean, who downloads MetaMask to buy NFT? So it's not the mainstream consumer product yet. So that is what we try to sort of bring to our American, early stage startups. You don't need a diversity officer. You don't need a board, but that should be a one of the checkbox, and that we would grade the CEO on. And initially, it may seem like burdensome, but you'll realize the wisdom when you hire the right people and they help you improve your user interface, and you get a lot more users. You become a unicorn. Everybody's happy.
100%. Matthew, do you have any thoughts on post-investment support?
Yeah, just as a blanket statement, I think most companies, they're coming to you for funds, right? But I would argue that the more value we bring is through our networks. And we are seeing, some pretty early companies that are struggling on a couple different fronts. So we try and use our networks to help them, whether it's on the sales side, whether it's on the logistics side, whether it's on, whatever it is. So our network is always available to those post investment entrepreneurs. And I would argue that's equally as important as the funding, although, that's necessary. But we really want to make those entrepreneurs successful, given all the diverse background that we have in our experiences.
Absolutely. Actually, in our philosophy at Blockchain Founders Fund, we actually believe that the capital is at an early stage is actually a smaller part of the puzzle. And so we actually work with our companies every single week on strategy, product market fit, scaling revenue, scaling users, and then making sure we've got a plan to ensure that the companies are well capitalized. And that's been, working incredibly well. And we've been first checks into, a number of major companies in the blockchain space. I want to move, from here. I think this has been a fascinating discussion, on sort of that investment thesis and how that includes, diversity of, diversity, inclusivity, and sustainability, but even the post-investment support piece. But let's look 5 or 10 years into the future. Jesse, we're gonna start with you. You're gonna have to share with us your crystal ball on the future. How will venture capital look, from this perspective? Are we going to have, equality, or what is it going to look like?
Oh gosh. And I'm like, well, we're at the blockchain summit, so I better tie that in, right? I think it's changing. I mean, to Kendra's point, we're seeing a lot more SPVs. Our investors are a lot more excited about SPVs than investing in the next funds. Everyone wants to be an investor. So I think something needs to change and will change. And I actually think blockchain will be an enormous part of that. Blockchain is going to change the future of finance forever. And I look forward to being able to collect LPs investments, in Bitcoin and in differentiated digital currencies. I think it'll be really interesting. So I can't wait.
Fantastic. And Andrew, what are some key factors we need to solve to better ensure equality and inclusivity over the next, say, 5 to 10 years?
So I think in a way things are happening, right? I think part of the challenge for diversity or lack of diversity and inclusivity in the past is just lack of awareness. But with information so readily available, stats, they're just kind of in our face, so we understand. And I feel like the Gen Z crowd is going to lead the charge and say, this is not right, we're going to make it right. And I think it's going to just happen naturally. I started investing 20 years ago, and our playbook was, let's go to AT&T Bell Labs and invest in a couple of PhDs, and then give them a little bit of money. And then they created this prototype we sell to Cisco for, $1 billion. And then they sort of graduated to, now let's just follow Stanford GSB grads, let's fund them, and then have them create a company and sell it to, Google for $1 billion. But now if you look at blockchain projects, I mean, forget Bell Labs or, GSB degrees. Some of these capable engineers came from all walks of life, anywhere from the world. They may not, for all we know, they may not even have college graduate degrees, or sometimes they may not even have a real photo. It's an avatar people are investing in, and they are creating awesome products, changing the world. So I think this is happening, and I think our job is to really just embrace it. And when you see these situations that almost looks a little bit different and makes you uncomfortable, you want to ask the question, hey, maybe you want to give this opportunity a chance, even though it looks very different from what you're used to, because the world is changing. For those of us who are in position to pull trigger and to invest in something, you want to be more open-minded and say, this looks different from the other movies I've seen, but I think the narrative is changing.
Yeah, I want to actually dive deeper into that, because I think that's quite interesting. I mean, in terms of Kendra, Jesse, Matthew, geography of investment, as a way of diversity. I mean, in the blockchain space, it's pretty much expanded globally. Teams, some of them are launching products globally on day one, or having teams globally on day one. How do you think about that? How does that reflect in your portfolios from a geography perspective, and how do you foresee that changing?
Hasn't COVID helped improve the way that we work together? I mean, so we are now in an environment where we can work virtually. Somebody can be in Singapore, or somebody can be in the coast, or somebody can be in Europe. and allows us to coordinate much more effectively. I mean, not to say that there's many positives out of the pandemic, but our ability to be able to collaborate and work in a virtual environment, I think it's been improved, and that is helping, some of these companies be, not just centralized in one specific area.
Absolutely. Kendra, Jesse, thoughts?
I would agree with that. I want to just go back to one maybe point on from Andy's comments, which I thought were great as well. So first of all, agreed, things are global. We have founders from all over the world, and we tended to be historically a little more US based. So the pandemic, I definitely think, has made us, we've seen for better and for worse, mostly for better, that we really are a global economy in many ways. I'm really bullish over the next 10 years. I'm sorry to sort of backtrack for 1 minute on from a diversity and inclusion perspective, because what I see changing in blockchain is a lot of the, maybe let's say the form factor and the consumerization and the comfort. And so now that you can buy a fractional Bitcoin, now that you're going to be able to shop with crypto, I think you're going to see far more women and underrepresented minorities moving to this platform, because you don't have to open up an account from a traditional institution that might be kind of scary. And so I'm really bullish, and I'm very positive in terms of my outlook that this will bring more gender and racial parity. And I think there's even a little more racial parity now into the sort of just the crypto asset class. And then also I'd say the pandemic has gotten people all sorts of people very comfortable from an age, gender, race perspective of being online, natively online. And so more comfortable with a lot of those sign up and security issues. So I'm really looking forward to this being a powerful tool to have more inclusivity.
I love that.
Absolutely. I mean, Jesse, do you have some thoughts on geography investment? Are you guys global in sort of your mandate? How do you foresee that changing as well over time?
We do have some founders from all over the world, but we are primarily domestic in the United States currently. And I think it has helped us. We've made quite a few investments virtually. I still, now that things are opening back up, I think we still do want to meet some people. We've seen some potential fraud issues and things, like there's a lot more concerns around, how do you do background checks and extra diligence when you're only living in an online world. So I do think I want to maintain the human connection somehow. We sort of say, okay, new founder, like we just made this rule, like new founder, someone needs to go meet them. And I think that's important. Like we're humans. It's not healthy to be on your computer all day long. And I think you want to maintain some form of interaction, human to human. But we've gotten a lot more done. We're more efficient, less travel costs. Our companies feel the same. It's been pretty incredible that way. But I do think that we need to remember we live in a human world.
No, absolutely. From our side at Blockchain Founders Fund, I mean, we've got companies across 6 continents. We do a lot of these digitally, as I'm sure many of us do now, and we see that actually continue to create opportunities as well in emerging markets, right? And it's been fascinating, to see that sort of develop and grow. I am curious, though, how you're thinking and if your mandate sort of allow, but you've got this whole movement of DAOs that, have started, but, you could see it picking up a lot more over, say, the next 5 to 10 years. You've got topics like privacy, which, are very big. And in the blockchain space, it's been interesting because from our side, we've seen a lot of investments that you don't even know who the team is. It's actually because they're so big on privacy. You get some avatars and you don't do video calls with them. You do audio calls with them. And so
I would not do those deals. I wouldn't do those deals. I would be afraid to do those deals. You need to go meet the avatar. That's not normal.
So are we gonna have like a metaverse you can go into and you can meet the avatar and spend some time with them?
Yes, but I would suggest final step, like meet them in person and make sure it's not like a dog running this company. And I meant like an actual dog. Like, I mean, like you just don't know. Maybe there's some great engineer who's a pet somewhere.
Even in virtual world, relationships still matter. We like to meet the founders. We like to talk with them. We like to understand their background. I'm with you, Jesse. Not to say that we couldn't get to a spot where we can do virtual deals, but relationships matter.
And we do virtual deals. I mean, you think of like even years and years ago with Second Life, people were buying real estate in Second Life. You know, I think that already exists. People are comfortable doing that. But I think for us, when we do a deal, yeah, just make sure you can go as far as diligence and, you know, committing, you know, as long as then the final step is just meeting them in person.
What about Kendra, Andy? Are these things that you guys could be doing, like more down investments or privacy investments where you might not even have a typical equity structure, you might not know the team? Like what does that look like for you?
I'll start. We also like to look at meet the team. In COVID, we haven't always met them in person, but we've typically had some sort of second relationship where, you know, we can do some very thorough reference checks with folks that we know who would have worked with them. So, you know, trust is still key. And we obviously have a fiduciary responsibility to our investors that we know, you know, who we're investing in. So at least at Acrew, we're not quite there yet in what you're talking about. I don't know about you, Andy.
Yeah, so we're a seed fund, institutional seed fund. And 20 years ago, when our founder Tim Draper realized, hey, in order to do seed business, you got to really have that, you know, that in-person connection, local knowledge. So he created Draper Venture Network. So we are actually part of an alliance of 23 venture capitalists around the world. So for our local seed funds, it gets done locally by the local GP. So the core fund, the US fund, Draper Associates, we would then participate in Series A along with them. So that's kind of how we get around, and I think has worked out great. And I do want to address the Second Life Jesse mentioned. I thought it was fascinating. It's the new world where I think we're seeing the second generation of this Second Life of metaverse. When people are getting real jobs in the metaverse and earning income, I feel like this time is a little bit different. You know, I'm not proposing we all just put on our headsets and call it a day and be part of the matrix, but I do think this next generation of gamers are spending more time in the metaverse because now they actually have a job. It's harder for the parents to say, hey, you know, get off the game and go do something productive. But when in fact the job is in the metaverse. And then if your job is in the metaverse, you may start consuming in the metaverse. And that new economy, it's kind of fascinating. There's no H-1B involved. You work cross-border. So suddenly this is a whole new world.
No, and I want to touch on this, right? So we're actually the first checks into Splinterlands, which is one of the two largest games in the blockchain industry, alongside Axie. And you know, we're hearing incredible stories, life-changing stories every day in villages and communities. And there was actually a NASDAQ and Motley Fool article that came out a couple of days ago that said someone put in $10 into the game to start, and it's worth $17,000 now in such a short period. And it's incredible to see, you know, the entire economy that's being built out of this. I mean, they're doing 1.3 million daily rentals of items. I mean, it's quite incredible to start seeing how this is transforming, you know, communities, making it more effective to be, you know, investing your time into something like this, into a game where there's shared economics versus, you know, being a taxi driver, working at a grocery store, these sorts of things.
During COVID, there were a lot of workers couldn't get work visa to go work in the foreign country, so then they just log on to the blockchain and, you know, play to earn model. Right? And I'm a firm believer in intelligence and talent is evenly distributed across all people, but access is not. So I do think blockchain, being a decentralized technology, is one of the best tools to democratize access and really, you know, open up, even the playing field for everybody.
Absolutely. Go ahead.
Oh, you know, I'm just saying, Andy, that's one of the most interesting things I've heard. And to think about, I know that you guys have had trouble for years trying to get people visas so that they could work in the United States.
Right.
And I mean, this really changes the world in so many more ways than I even thought about.
Yeah.
100%. And I think this also covers that sort of last layer that we talked about, which is actually the portfolio companies' customers and, creating opportunity, diversity, access, as Andy put it, has been incredible. Just given the time, we've got to wrap up. I'm sure we could go a lot more and pick your brains more, but we're going to have to do that another time. This has been a very insightful discussion from our incredible panel. I can personally say I've learned a lot, and I'm sure our audience will agree as well. I'm encouraged by, the transformation in the venture capital industry, leading to more diversity, as we heard here, inclusivity and sustainability. And it is here to stay and only going to accelerate. And so there's many other incredible presentations and panels from experts all around the world remaining today and tomorrow at the LA Blockchain Summit. What better time to learn from these experts from the comfort of your own home? Be sure to check them out, as I know I will. Thank you again to our incredible panelists for making the time here to share your insights.
Don't think you're an investor? We make investments morning, noon, and wait, what time is it exactly? We make short-term investments, long-term investments. We diversify our interests, realize our gains and losses, and try to keep the big picture in mind. You don't need to become an investor. You were born one. Robin Hood.
Well, next up, it's a great pleasure for Draper, Goren, Holm to welcome back the Securities and Exchange Commissioner Hester Peirce alongside Jordan French of the Daily Grit News as they explore the SEC's current thought process. Well, this session will be followed by a panel of industry experts assembled by Ownera's Amy Ben David to chat private market tokenization.
Welcome, everyone. Jordan French here with Grit Daily News. Welcome to LA Blockchain Summit. Big shout out to Draper, Goren, Holm, Jay, and the rest of the team on the back end. They'll never get enough credit for what they do. I'm here with none other than SEC, that's Securities and Exchange Commission Commissioner Hester Peirce. Hester, welcome to LA Blockchain Summit.
Jordan, thanks for having me. It's a delight to be part of the LA Blockchain Summit, even if it has to be remote. And I, as you know, as a former regulatory attorney at FERC, I have to give my SEC disclaimer, which is that my views represent my own views and not necessarily those of the SEC or my fellow commissioners.
That's exactly what we want, is your personal views, unfiltered, unadulterated. Hester. But I got a lot of questions actually just before even this talk started. And I think it'd be helpful, especially for the uninitiated, if we could lay some foundation of, what is the SEC's mandate, today, especially as it relates to, cryptocurrencies and perhaps even NFTs that have become a considerable marketplace, Hester?
Well, that's a big question. The SEC is a big agency. It's got about 4,500 people spread all over the United States. And our mandate, which dates back to the 1930s, is to protect investors, of course, facilitate capital formation, which means help build an environment in which companies can raise money and grow, and foster the integrity of the markets. So fair, orderly, and efficient markets. And so what does that mean? That means in practice that we regulate the stock markets, we regulate broker-dealers, investment advisors, and we regulate the market infrastructure entities. And we also oversee disclosures by public companies. So it is a big mandate. And then crypto came along, and that fits within different places in that mandate. A lot of the attention has been on initial coin offerings and whether those are essentially securities offerings, which is something that we regulate. But there are also questions around whether platforms and professionals that interact with crypto, whether those entities might fall within our jurisdiction. You raised NFTs. That's a very complicated and very fast changing area. So I will give, which is that NFTs, certainly if you are designing an NFT platform or you're designing NFTs, you should be thinking about whether or not they're securities. If you fractionalize something and sell pieces of it, that could be a security. And perhaps NFTs could be securities as well, depending on how they're designed. So that's not very helpful, but I think as with a lot of these things, and I'm sure we'll get into this as we talk further, the facts and circumstances really do matter, and you have to be careful because you can easily trip over securities laws or other federal and state financial regulation.
Certainly, and it is helpful. You did, you mentioned the word securities, and we'll set that aside, and we'll get right back to that. That'll dominate a lot of this conversation. I'm excited for it. But one thing you also mentioned, though, is protecting investors. It's effectively part of the mandate. It's in all sorts of language, and it just sounds also like a slippery slope, almost like to what extent do you protect? Because there's plenty of downside, right? There's plenty of downside in stocks. The stock market, for example, which that was contemplated certainly, right, when when the SEC was formed. Again, we know that these are your personal views. Where does that line end in your mind, Hester?
Well, I really like that question because I think often people just look at that part of our mandate, the protecting investors part of our mandate, and they see it, sort of, well, it's an obvious, it's like motherhood and apple pie. Of course, you want to protect investors, but that can mean a lot of different things. So one important way that we protect investors is by ensuring that they have disclosure so that they can make their own decisions. And we also, as I said, we regulate financial professionals. And so we're looking to make sure that those financial professionals are behaving with respect to their clients and customers in ways that are protective of those clients and customers. But at the same time, it can be very easy for a regulatory agency like ours to start to think about some of the things that you mentioned, protecting people from the downside, making sure people don't take risks that they shouldn't take. And that really is not our job. Our job is to empower the investor. But also, from my perspective, it's really important that we maximize opportunities for investors. And so that means making sure that competitors who have new ideas for new products and services can come into the securities market and offer those products and services. Making sure that companies that want to go out and raise capital, that investors are able to participate in those capital raises, are able to be part of building those companies. So I view investor protection as a really multi-layered concept where, yes, you're trying to protect investors against fraud and fraudulent actors, but you're also trying to protect their ability to participate in the markets and to be part of such an important piece of the fundamental building blocks of our economy.
Certainly, and a lot we could unpack there, Commissioner Peirce. But on this, we'll move back securities back into sort of our sort of main view here, and it's worth already asking, what if something is not a security? There's been this question about certain cryptocurrencies. They've been traded, how they've, they're sort of their genesis. There will be an ICO, which is a bit of a dirty word now, and we can get back to that in a bit. But some didn't go that way. They just sort of like started to float in some way. And I think you know where I'm going. They look like commodities. If something isn't a security, what happens to it from a regulatory standpoint? Commissioner Peirce.
So that brings me to our sister agency, which is the Commodity Futures Trading Commission. And the CFTC, as it's known, is the regulator of the derivatives market. So we're unusual in the United States. We have this bifurcation where we have the SEC regulating the securities markets, the CFTC regulating futures and other types of derivatives. And so that is sometimes leads to places where our jurisdiction might overlap or might come, there's some gray areas. Does it fit within the CFTC's jurisdiction, or does it fit within the SEC's jurisdiction? But if you're talking about a commodity and there's a derivative like a future built on top of it, so you have Bitcoin futures and you have futures based on ETH, those futures products are regulated by the CFTC. Now, the CFTC can look through to the underlying commodity market. A lot of what the CFTC does is its origin was in commodities or derivatives based on agricultural commodities. And then over time, that sort of expanded into a lot of financial commodities. And so these are financial derivatives. But now, we see crypto derivatives as well. So the CFTC can look through to the underlying market to police fraud and manipulation type things, but it's not the regulator of the commodities markets. So I'll leave that to my colleagues there. Dawn Stump, who's a commissioner over there, did a really nice explainer of what the CFTC's jurisdiction is, and I commend people to take a look at that so they get a sense of what that's about. So it is not really clear, again, depending on what you're looking at around an asset that has been deemed to be a commodity, you have to assess whether or not the CFTC would be the regulator, and if not, depending on what the activity is, there might be some other regulator that would have jurisdiction over that.
Yep, and you explain regulatory overlap, and to the extent that we can try to clarify this for people. I'm going to read this back to you. I think futures related, especially if there's Bitcoin futures, an example that you offered up. That's what the CFTC. That's who folks who go to if there's a complaint issue or maybe a new issuance, for example. And the underlying could have overlap by both the CFTC and the SEC. Let me know if I got that wrong, Hester.
Well, and I would say other agencies could be involved too around the underlying. And so query whether the SEC would have, again, it depends on the facts and circumstances, and I don't want to talk about any particular digital asset. Right. The SEC could potentially have jurisdiction over something related to the underlying asset, but there could be other regulators, non-financial regulators at the federal level who might have something to say about that. There could be state regulators that might have something to say about that, which is, I think, go ahead.
I was going to say, yeah, exactly. We've certainly seen some enforcement actions out there. The first one that comes to mind, South Carolina has been a relatively active regulator. I think a few other states have issued enforcement actions, and just to unpack that. So the answer is coming from you. How do the states fit into this?
Well, again, this whole landscape is developing a bit. So I think we should distinguish between two things. One is regulation, so day-to-day regulation of activity, and the second is enforcement. And sometimes someone who doesn't have day-to-day regulatory authority, as I was talking about the CFTC with the commodity markets, they don't have day-to-day regulatory authority, but they might be able to bring an enforcement action. And so similarly, you might see states coming in or the SEC coming in with enforcement action. So you can have a lot of different players on the enforcement side. Now, one of the other things about the United States, and let me bring it back to securities where I'm more familiar, that's my area. So we have the SEC at the federal level, but state securities regulators have been very important regulators in this space for a long time. And so we share authority over the securities markets with our state regulatory counterparts. And then on the shifting away from securities again for a moment, on the crypto side, the states are involved through regulating money transmission. So there's another spot where states can come in. So it's definitely a confusing landscape. And that's why a lot of people in this space find they need to go talk to at least one lawyer and maybe multiple with different specialties to figure out where what they're trying to do will fit within that regulatory regime.
Yeah, it's I'm very bullish on the legal market here. Certainly hearing this in this, Hester, but perhaps for good reason. There are some very real risks, and one thing I want to drill down on, because we'll touch on a couple other really cool issues, including some of the talks that you've given recently, and Wild West analogies. People know that's coming, but it's drilling down on the currency side, of crypto, and how that fits in. Broadly, from a pedestrian standpoint, Hester, a fiat currency like the U.S. dollar, perhaps Canadian dollars, and or euro dollars, they might be all looked at differently, but those don't seem to be necessarily securities. Yet a lot of the cryptocurrencies call themselves currencies, and perhaps even obliquely in competition, right, with U.S. dollars, and certainly investors see them that way. Is that something that you could also unpack for us? Perhaps your views on the currency aspect of cryptocurrencies, and to the extent that they should be regulated by the SEC.
Well, it's difficult to talk about cryptocurrencies all with one blanket term, because different crypto is used for different things, intended for different things. Certainly, some people are using certain crypto assets as currencies, as ways to transact with one another, to pass value from one person to another. It is difficult to again, take a blanket approach and say, well, this is how the securities laws apply to those circumstances, because you can have something that someone is treating as a currency, but we would nevertheless consider that to be a security. So it is, again, really necessary that you look at the facts and circumstances, that you think about those in light of the securities laws. I think there's some really interesting developments in the crypto space now around stable coins. A lot of people talk about stable coins as being a potential alternative, more American approach to a digital currency than a central bank digital currency, because this would allow for competition, and it would allow for protecting people's information from being financial information from being viewed by the government. So there are a lot of fun conversations around that. Many of those are really outside of my purview as a securities regulator, but it has been really interesting to watch the developments in that space.
It certainly, and dare I say, it sounds like, again, these are your personal views, that you encourage this type of innovation, Hester.
Yeah, so certainly, I think one of the really wonderful things about this country is that it has always been a place where people want to come and build things, and that innovation, which stems back to the very beginning of the country, has really powered our prosperity and our growth. And so innovation is really important. Now, one thing that can happen, and I think it's one of the things I'm worried is happening on the securities side, is that when you get a regulatory system that's pretty well developed, and you have players who have been in that regulatory system for a long time, you can end up with a situation where both the regulator and the big players are comfortable with that situation. And they're not really that excited about new entrants coming in, or people coming in and saying, hey, we might want to do this in a different way. We might want to try something new. We might want to build a new product. So it can be very difficult to open the regulatory barriers so that people can try new things. And so that's one of the concerns that I have here at the SEC, is that we make sure that we keep our securities markets dynamic, that we allow for new competitors to come in. Of course, we're going to have regulatory constraints on what they do, but those regulatory constraints should be limited and should be flexible enough that people can achieve the objective of the regulation, but do so in ways that are more appropriate for the new technology or the new product. So that's something that we really need to make sure that we keep that regulatory flexibility so that we keep the dynamism, and that dynamism is what makes the US a good place for people to come and innovate.
Certainly sounds like, part B of the mandate, not just protecting investors, but perhaps, give some, it sounds like, just to repeat this back to you, give some breathing room, to those who do innovate. Just to repeat this back to you as well, is like a really pedestrian analogy, almost truly pedestrian, is, an example of an Uber or a Lyft. Everyone knows of the sort of entrenched competitor, that's the taxi lobby, and it's instinctive for them to go to politicians to stifle that competition. So I'm sure a lot of people in the audience will be, are keen to hear this from you, and are encouraged by it.
And I think one of the things we have to keep in mind is that often the attempts to protect the existing status quo are couched in terms of investor protection. And so we have to be able to do the hard work of sorting through where are there real investor protection concerns, and where are these investor protection concerns being raised in an attempt to try to just make sure no change ever happens. And that can be difficult, right? And so I think people who are trying to do the right thing can come to that discussion and have different views on that. But that's why we really need to have these conversations. We need to have some push and pull at the regulatory level and also in broader society as we're talking about these things to determine what the right regulatory framework is.
Certainly, and Commissioner Peirce, consider, you mentioned the regulatory framework and, finding where that is. I think practically anyone in the audience would agree that's important. Nonetheless, there does appear to be, some daylight between you, at least one other of the commissioners. And I'll go to something that everyone in this audience is anticipating, and that's the sort of Wild West analogy or metaphor, rather, that Gary Gensler brought up. You also brought it up in your own speech, perhaps counterbalancing it. And just to unpack that for everyone who's maybe a bit uninitiated, it's this sort of evocation that the cryptocurrency, sort of universe is chaotic. It's the Wild West of vigilantes doing what they will. And certainly there's probably some credence to it that you might concede. We'd love to hear your views, on how much people should put stock into that analogy, and perhaps the contrasting viewpoint that people romanticize, the Wild West is one of the most popular, film allegories out there, or certainly plot arcs, and a lot of it had to do with what being American was. Hester, your take.
Well, so I did want to counter Chair Gensler and others. I mean, he's one of many who just use this Wild West terminology to suggest it's just a mess out there and we need to come in, the government needs to ride in and impose some law and everyone will be better off. And, I think we tend to just throw those words around. And I wanted to say, well, okay, let's look at what it was actually, what was the West about? And it was a bit romanticized. I agree with that as well. But there is this notion of people leaving the staid societies on the East Coast and looking west to this broad, beautiful country and looking at what they could do there and building civilizations under really difficult circumstances, but building, really impressive civilizations there and cities and then, innovation hubs. And so let's not forget that other side of the story. That's what I wanted to do with that speech. Now, again, you mentioned that there is some daylight between me and maybe what some of my colleagues think. I do commend people to read a recent speech by my colleague, Commissioner Crenshaw, who did address digital assets. It was a speech earlier this month to get a different view. But I think it's important that we're at least having this conversation. And that's why I wanted to push back a little bit on this notion that just because something doesn't have a very intense government regulatory framework, it doesn't mean that there aren't other self-regulatory types of frameworks that evolve and that can actually serve people quite well.
Yeah, certainly. And the natural question to ask is, how do you resolve those differences? And forgive me, I'll ask a compound question just for the sake of time to get it to you. And there are a few things that you've proposed. We could have any commissioner on at this summit or the next one, but you're here with us. We'd love to hear what your proposals are, if you could unpack them for us. Thanks, Hester.
Well, so what I've proposed is a safe harbor for token distribution events. So when a project is ready to launch its network and wants to have broad use of that network, how can it get the tokens out in a way that's compliant with the securities laws, but also achieves the goal of getting people using this network? It can be tricky, as we've seen under the securities laws. And so the safe harbor approach that I've put forth would address some of the concerns around our people who are buying these tokens getting the information they need to make wise decisions about whether to buy the tokens. Balances that with the idea that the projects really do need to move forward. And so it lays out some disclosures that these projects would have to make. And then at the end of a 3-year period, the idea is that if the network is decentralized, or if the token is really, you can show that it's a utility token, you could move on outside of the securities framework. So that's one thing. I would like to work on some of the other many outstanding issues there are around custody. For example, I think we need to do a better job to provide some guidance for people who want to be involved in this space, particularly regulated entities, what they need to be thinking about around custody. But I do welcome people to come in and talk to me about that issue and about other issues where they need clarity, so I can start thinking about what a framework might look like. Again, it may not be the framework that ultimately gets adopted, but I think it will at least get people thinking.
Certainly, and we'll set that aside because you just offered everyone to contact you if they had ideas or proposals of how to address certain issues, and we'll get to that towards the end. On just sort of the broad daylight issue, just inspecting some of the inner workings between commissioners, how do you resolve? What are the mechanisms to resolve issues and sort of close the gap so that you can do something that perhaps is fair, but also everyone agrees maybe it makes sense to do something in response to an action?
So this kind of brings me to a question that you asked me in the lead up to this conversation, which is there something about the SEC that people don't know? And this really brings to mind something that I think a lot of people don't know. There are 5 commissioners at the SEC. Chair Gensler is the chair. He's one of the 5. And so there's a law that says we can't all just get in a room and talk about things behind closed doors. We can either have a public meeting with all of us, or we can have so-called closed meetings when it relates to enforcement actions. Those we can have behind closed doors, but there are rules around how that has to happen. So that does make it difficult for us just all to go out to lunch and say, hammer out a safe harbor framework. We can't do that. We can work through our people who work in our offices, and we can work on a bilateral, 1-2 of us can go and talk about something. But I think that's why these conversations sometimes play out over a longer time period. Now, the chairman of the commission does have a fair amount of authority. He has authority over the staff and also has agenda authority. And so the key, I think, is to get something around crypto on the agenda so that it can be on the rulemaking agenda so that we can actually talk about building a framework. Chair Gensler has been very vocal about crypto and specifically has said to people, come on in and talk to us and we can talk about what adjustments need to be made in the regulatory framework. I think my concern is that a lot of our outward facing activity has really been through enforcement, and that is not a good way to build a regulatory agenda, because then you're looking backward and you're punishing people for what they did in the past, as opposed to saying, look, we realize there's some ambiguity here. We realize there's some gray areas. And rather than of course, there are times when you do have to look back. If there's fraud, absolutely, no doubt. But if we're really trying to build a good regulatory framework so that people can use it and can do what they're trying to do, but do so in a way that's consistent with our laws, why don't we focus our energy on that? And then when people violate it, then of course there'll be enforcement consequences. So that's one of the tensions right now, is that I think we've led with our enforcement foot. I'd like to see us leading with our regulatory foot, which would be a much more collaborative project involving all of the commissioners and the commission staff as well.
And so just to drill down on that specifically, I think we all know what an enforcement action looks like, and you're just to repeat this back to you, you're teaching the other direction. What does regulatory action look like to people and to the public?
So it can look like a couple things. One, you can have informal regulatory action, which would be, some people have seen that in this space, a no action letter where someone comes in and says, hey, this is what I'm trying to do. I'll adhere to these conditions. Will you let me do it? And the staff usually the staff, it can be the commission, but usually the staff says, yep, if you do it just as you said you would, we won't bring an enforcement action. But sort of and then we have exemptive orders as well, where we can say, you know what, you're going to be exempt from the rule if you do it according to these conditions. The preferable way, and the way we typically do rule writing, is through a notice and comment process, where we'll actually put out a proposal. We'll say, this is what we're planning to do. Public, come tell us what's good about it, what's bad about it, what you would do differently. And then we take all of that public commentary into account, and we write a final rule, we give an implementation period, and then people are off to the races. They know what they have to do, and there's often communication with the agency during that implementation period, as people say, hey, I have a question about this, and we'll come back with responses to those questions. But that's the way rules are typically written, and I think it would be wonderful to see something like that in the crypto space.
And certainly in this audience, listening intently, they're hanging on the words public comment. In the interest of time, Hester, how can people get you a public comment or reach you in that capacity to contribute to potential frameworks, at least our ideas, and furtherance of them?
People should feel free to reach out to me, Commissioner Peirce at sec.gov. And then also I should mention that FinHub is our staff level entry point for people who have specific projects or questions that they want to discuss with the SEC staff.
Yep, that's FinHub, and you heard the email address earlier. That's all the time that we have. Big round of applause for Commissioner Peirce for joining us from the SEC. From the HQ we see in the background. I'm Jordan French with Grit Daily. Thanks again to LA Blockchain Summit for putting all this together. Thanks for your time, Hester. I know you got a lot of work ahead of you, and it sounds like you'll see at least some public comments from this audience. Appreciate it.
Thanks so much.
A huge thank you to SEC Commissioner Hester Peirce there. Now we're talking private market tokenization. We're getting real with Ami Ben David from Ownera, Robin Friedman from Nomura, OEU from ADDX, Scott Lucas from JP Morgan Chase & Co., and Burrit Foos from ABN AMRO.
Hi, everyone, and welcome to the panelists. Before we start, I'll just say that Robin had to drop off. She's not feeling well, so get well, Robin, and we'll jump right in. So the subject of the panel today is digital securities, tokenized securities, and getting real. We've been talking about this for a few years now, but now we're at the stage where it's getting real, and I'm specifically talking about the institutional market. We have here some great people who are actually at the forefront of doing exactly that in the institutional market. And this is the subject we wanted to cover today. So before we go ahead, let's start with an introduction of the panel members. Barry, do you want to take us away?
Yes, absolutely. Thanks, Ami, for introducing the panel and for inviting me here tonight. My name is Berit Vos. I work with ABN AMRO Bank in the Netherlands. I've actually been working in this space, applying blockchain technology within the financial industry and focusing on digital assets since 2014. Currently, I do that in the capacity as innovation manager, work within group innovation of the bank, kind of working with all of the different business lines, so across all the products and segments that we have on developing and implementing digital asset propositions.
Thank you. Oyi?
Hi, my name is Oyi. I'm the Chief Commercial Officer at ADEX. ADEX is a private markets platform. We're headquartered and regulated in Singapore, and very happy to be here with the panel today talking about, private digital securities in the private market.
Yes, and thank you for joining us from Singapore. It is quite late over there, later than in LA. All right,
Indeed.
Scott, over to you in London.
Thanks, Amy. My name is Scott Lucas. I'm at JP Morgan, and I lead our markets DLT business, so building DLT trading products on sort of regulated private permission networks across the different streams of the markets business, credit, equities, rates, etc.
Yeah, and you covered the commercial side as well as the technology, or mostly on the commercial side?
On the commercial side, yeah. We have a technology team that I work with to turn thoughts into reality.
Great. Okay, so I think to start our discussion, we're talking about gaining real. So I'd really love to get from each of you just a snapshot of what you're seeing happening, either things that you can talk about or that already went public, or that you can talk about within your organizations around tokenization, things that are coming, or things that you see in the market that you think will come in the coming quarter or two. So I'm not talking about what's going to be in 2 years, because we've heard that 2 years ago. It is about what is coming now, what are we working on now, what do we have going into production, and I'll do it the other way around. So I'll start with you, Scott. Tell us, JP Morgan, what are you seeing?
Sure. I think, well, obviously a lot of activity, and my main focus is really on in the sort of the existing financial markets and products that sit within what we would trade today. So arm's length from crypto. But even in that space, we have our own product around a repo that we launched a year or so ago that we partner with other market participants with. I think we've invested in a company called HQLAX that does a similar thing with tokenization of securities, and then moves those collateral versus collateral. So I kind of feel like from the where are we on the curve, the idea that you can take an existing asset, tokenize it, and then trade that for value across different jurisdictions and different firms, like that's kind of been one, and now it's about productionizing and scaling that to really sort of meet the needs of the market. And I think that will be a complementary tool to existing market infrastructure, but it's a really helpful first step to get businesses over the idea of, yeah, this technology can actually make a significant change in how we think about some of those products that have not changed for a very, very long time. And the next wave of investment we really see is in natively digital assets. So whether it be issuing securities or derivative products where you can use the underlying technology and the contractual basis of that, and that remove some of the processes that we have in the existing system to drive efficiency and speed. I don't know, Amy, that's where you're looking at with some of your work. That's, I think, the next level of investment that we'll see, and the next series of efforts will come to the market. And we've seen a little bit of that with issuances by the European Investment Bank, actually issuing a bond onto the public Ethereum network. Really interesting dynamic between public and private chains and existing products in a native way. So I think there's a lot more investment to come on that side. And clearly we are looking at that along with our peers and competitors to see what the client need is, what the market need is, and how we can bring some of that to bear.
And I think that it took some time because at JP Morgan the scale is different. So the repo product, for example, this is quite scalable already, isn't it?
It is, I think, but it's really interesting when you look at the freedom that is available sort of outside regulated markets to innovate and move at speed versus bringing a very long period of case law associated with these products with you, and the legal construct around trying to make the technology work in a way that people can agree. There's a really interesting interface there. So it's very scalable, but you've still got to get over some of those traditional hurdles around legal, regulatory boundaries that you've got to work within.
Yes,
But it's certainly that argument has been won. It's now just about implementation.
Got it. Thank you. Oyi, you're live and official with some tokenized products. I'd love to hear what sort of products you have, what sort of product you're launching, what products you're going to be launching next quarter. Tell us the whole.
Thanks, Hami. I think where we were very fortunate, I mean, ADDX is a blockchain-based private markets exchange. And we sort of started with a blank sheet of paper, right? Designing what we thought should be sort of the optimal building blocks to have a private market infrastructure. So we actually commercialized last year, just before COVID hit. So it was obviously a very testing time. But since last year to this year, we've actually done quite a number of transactions already. Where we see the predominant use case at the moment are funds and the access and the democratization of private equity funds or VC funds, private market type products to high net worth individuals. So, we would have seen our recent release. We did a deal. We did a Partners Group Global CCAV Fund, which we tokenized on our platform. That was last month. We actually just today announced the launch. Actually, we closed the first round of a crypto fund. And interestingly, that is our expression at the moment of crypto exposure, which is the underlying is actually a fund managed by a group called Trovio in Australia. It's actually a bunch of ex-JP Morgan colleagues of Scott, I suspect. And, that was very well received by our investors. So funds, as I mentioned, it's great. It did very well. It's a, very well-performing fund. But where we're seeing the use cases develop over time, and this will become more institutional, is actually on the bond side, as well as the pre-IPO and the structured product side. On the bond side, we now are starting to see issuers come with us on digitally native bond deals. And we think this will be a space that in the next 12 to 18 months will be very deeply developed. One final thing I would mention before I hand it back to you, it was that with the banking infrastructure, obviously we started out not developing that banking infrastructure because we were a young startup. But you would have seen UOB, United Overseas Bank, which just announced its results today. The CEO mentioned our strategic alliance because I think the group itself sees a lot of interest and potential development with blockchain. They're working with partners like ourselves to see how we can then work with a new setup and a traditional infrastructure to see how that might work.
Amazing. So I think getting real is, we already covered that. And Berit, you have a lot of things happening at ABN AMRO as well. Tell us what you can talk about.
Yeah, absolutely. That's always an interesting balance to try to strike, of course. And I think for us, when it comes really to tokenizing securities, we don't have anything live yet. We are close to it, though. I think in the past few years, ABN AMRO has spent a lot of time actually more in the area of digitizing trade finance, for example. The focus of the bank has been changed a little bit. So also for the team that's working on digital assets, we're really focused on digitizing securities at this point in time. And the thing that you don't see, and I think that's valid for a lot of financial players, is that we've been working on a lot of propositions and concepts for the past 2 years, and a lot of the time actually goes into detailing out the legal and regulatory frameworks, right? I think that's the thing that really costs the most time and energy, and it's actually really complex, because regardless of which market we go onto as a regulated institution, we have to comply with regulation no matter what, right? So that's a very important thing. What I can say is that we have a couple of issuances and deals in the pipeline. We might even participate in a deal before the end of the year, but definitely first half of next year. And I think next year we'll see a lot more issuances of financial institutions happening. Very interesting, Oyi, that you mentioned to expect that the bond market, the tokenized bonds will take off, because this is really one of our, I'd say, key areas that we're focusing on. It's a business that is, I say, close to us, and that's also really where we're starting, right? We're starting with the segments and with the asset classes that we know really well, that are close to us, that we have, relevant networks and let's say a significant reach, before doing more exotic asset classes, which obviously are on the radar. But we do notice that with our partners, peers, investors, that taking the step of tokenizing something already makes it exotic enough. So keeping the rest as much as possible familiar for everyone.
Yeah, I think what's interesting for me is that I've been doing these conferences 2 years ago, and we were talking about the future. Right now, we're talking about, okay, legal is difficult and regulatory is difficult, but we've done this for the last 2 years, and now we're looking at actually deploying stuff. And especially, it's a little bit easier for a mid-sized bank than a huge bank to move faster, and maybe go after accounts that are, let's say, mid-sized and not just a huge account. So there's a lot of place for the mid-market also to innovate. What I can say is, from our side, at Ownera, we've been working on the FIN P2P network to interconnect the banks and enable transactions across the market. So we see a cross-section of what everybody's doing. So we're seeing a lot of projects that are about to launch across, you mentioned bonds before, but also, real estate, funds like you guys are doing, and private equity fund, hedge funds, even crypto funds. We're seeing money market funds, we're seeing treasury funds coming in, and we're seeing pre-IPO companies also looking at tokenization. So at least 4 or 5 different verticals that are seeing real projects going into production in the institutional market. So what I'd like to take kind of the next question is to talk about the progression of things, or just get your sense on where things are going. It's almost a question on 2 levels. One level of the question is, crypto versus securities, because the thought process, and a lot of people here in the conference would expect that crypto brought us the digitization, the concepts of blockchain and so on. So you would expect crypto to be deployed first in institution, but I get the sense that a lot of institutions would actually deploy securities digitized long before they will, not long, but before they will launch crypto. Do you think that this is kind of a reasonable assumption, or do you think that crypto will come alongside crypto? I mean, spot trading and things like that. Do you think that is the financial institution market ready for crypto, or will it be starting with securities as kind of seeing right now? Barry, do you want to start?
Yeah, actually, just thinking about how to answer that question. I think that there will definitely be institutional crypto. I think there is an interest for it and an appetite for it, although it will not be for everyone. And I think it really highly depends on your activities and your profile, and also the appetite that you have as a financial institution. I can say for ABN AMRO, it's not something that we currently have planned to provide any services on. But that doesn't mean that no one else will do that. So for us, will definitely be securities first. And I can imagine that sounds or feels a little bit counterintuitive, because with crypto, the assets are there, the markets are there, liquidity is there, and these are all things that are very, very important also for digital securities to take off. So it might feel strange to not go for that, but there are a couple of other considerations that you have to take into account as a financial institution before you involve yourself with crypto or offer any crypto services. And an important one there is also still regulation. And the regulation, I think, around crypto is different around the world. Even within Europe, wildly different stances from the central banks on what you can and cannot do with crypto and what you should and shouldn't offer. And that just makes it a lot more difficult to navigate also, I think, the crypto industry for Europe-based financial institution. Because even if you would be allowed to provide certain services, you would be kind of confined to your own small market, because 200 kilometers away, the regulation might be completely different.
Yeah, I think I agree with you. And Scott, from what you're seeing at at your organization, other organizations that you work with, I think it's not only that securities are coming ahead of crypto, but actually we're now deploying the infrastructure and the technology, and a lot of these wallets and the technologies might be able to trade crypto later. It's the same technology or very similar technology. It's just that what do you start with, and it's a lot easier to start with securities. Are you seeing the same? Do you think the same applies to you guys?
Yeah, certainly securities, and I would sort of broaden that out to existing regulated financial products are sort of where we need to focus first. And the reason we have to focus there first is because we're allowed to do that, and we're not allowed to get involved directly in the crypto markets. And I think there's quite a lot of coverage around interest from institutional investors and sort of how that might eventually play into the institutional market. But for right now, and until there is both regulatory clarity on what is available to you and also the cost of doing that, because clearly when you get into that framework, you then start thinking about capital, et cetera, and that has a different expense for an institution like ours than does perhaps for someone else outside the regulatory space or regulated space. That then sort of plays into how that would deploy. So for right now, like crypto is not in the playbook for us. It's not something we can focus on, but quite clearly there's real benefits in the technology that cryptocurrencies run on. And observing those markets and looking at interesting ways of adopting some of those processes to regulated financial markets to drive efficiency, take out cost, offer different products than we can today, because the technology just lets you do different things. That's certainly the focus from our perspective.
Yeah, and I think for what I think that it has implication for people that are watching us, and I know a lot of people are watching us that are coming from organizations that provide services like custody solutions, settlement solutions, and so on. And they were trying to get into financial institutions with their product, which is crypto product. And one of the things I'm saying to them is, well, it's the same product for digital assets, because a wallet is a wallet, and you should be focusing on offering custodian services and other services for digital securities first, and then you'll get to crypto in the end, but not the other way around. That's an interesting. I think it's a turn of the market that's interesting.
It's separating the sort of what the rails are with what's in it or on it.
Exactly.
And if you feel you've got the infrastructure to offer services related to those rails, wallets, connectivity, etc., then that's a play that would be more acceptable in the short term, because we can't and don't intend on in the short run getting involved in the crypto space until there's real clarity.
Yeah. And the other question I want to ask, and maybe I'll offer that to you, Oyi. The question of private blockchain versus public blockchain. Everybody here in the conference is obviously coming from the public blockchain, while the institutional market definitely started with private markets. When we started the group, we had the group to digitize private markets. We had 70 financial institutions talking about interoperability and interconnectivity. This is the project we're deploying now. And everybody said private only. We don't want to touch public blockchain. But now I start to feel winds are slightly changing. I know you started with private as well. What do you think about that?
Yeah, I think that, look, when we started the business and we thought and we drafted it on that white piece of paper, as I mentioned to you, I think there was no way that we could have come from the approach of getting licensed and getting in and out of the MAS sandbox without being private, right? Yeah. That was just not possible. I think private has a lot of advantages where regulators would like to see, because cybersecurity, certain features, how and all those things that come with the private blockchain, I think are still applicable today. But I think what's happening is in Singapore in particular, because of the way that the regulators are looking at crypto and how they're allowing certain institutions to have the what we call the Payment Services Act licenses to operate a crypto exchange, is that I think we will start to see regulators look at how the public and the private chain could potentially coexist in the ecosystem. But I do think that that does force the public chains to then adopt certain measures to ensure that they also meet regulatory standards, or that the private chain has to, build certain features in to ensure that the connectivity into the public chain will eventually have the right, oversight and the right sort of KYC, AML, all the things that regulators are extremely cautious about. Yeah.
That's exactly the point that, when I talk about public versus private, when we're talking about securities, the public is not really public because it is, I call it like a VPN on top of public. It's a closed network. It's because you can only allow specific people in based on their credentials, KYC, AML, accreditation, whatever it is. So you have closed networks on top of public networks, and you have so many public networks and so many private networks that, without a network that interconnects all of them, you're going to have just a mess of networks. So it becomes less important or almost technical to decide to go with a private blockchain or a public blockchain, as long as you can kind of create a fence around the set of clients that you want to work with that meet your institutional guidelines. But I know, Barry, you have you've been in the blockchain and environment in the Netherlands for a while, so you're kind of a fan of the public blockchains, right? As well. I mean, on a personal level, but within the organization, it's private yet, right?
For us, no, actually not. I mean, obviously, starting out with private blockchains, and I think a couple of years ago that was the norm. Like you said, 70 institutions, and everyone said private only. But at the moment, we don't have any, let's say, projects live that are using private chains. So we're actually putting the ambition for ourselves for any new issuances and new projects that we're going to do, we would be using public blockchains. The idea is that, I mean, I think when you're talking about solutions that can be used also for digital securities, and I think a couple of the important things and important reasons why you want to digitize or tokenize securities or any financial assets is also because increased accessibility, but also the discoverability and especially the interoperability. I think that's very, very important if you want to ensure that assets can be traded, hopefully at some point in time also across borders if the regulatory frameworks are in our favor. And I personally think that public blockchains are, let's say, more suited to help us achieve those things. Nevertheless, I do believe that you need probably a layer or a VPN, if you will, of permissioning on top. There are just certain rules that we have to comply with. There are certain things, certain information that you might have to keep or might also want to keep private. So you will have to layer, obviously, the ultimate solution to a certain extent. But I think that underlying infrastructure where those tokens are originated and where they can be traded, I would definitely say public.
Interesting. And Scott, I don't see repo running on public blockchain anytime soon. Am I wrong on this?
No, absolutely not that product. I think, but public and private will absolutely coexist, and I think the financial markets will, and they do, So I go back to the European Investment Bank. That bond is on the public Ethereum chain. There's a sort of a ring-fenced area, sort of under Stockchain Forge, that is sort of where that is held. So this sort of enclaves, I think you've spoken about on public chains, they already exist for public securities, and there will be other opportunities for that, and I think there will be coexistence of regulated market activity on both public and private chains. I do think the start point for a lot of us does need to be a private chain, depending on sort of where you are on the curve, in order to get that regulatory approval, in order to keep clients comfortable with the safekeeping of assets and the access to those assets, particularly at scale. So I think there's a bunch of arguments for and against for both of them, but I would expect at some point in the foreseeable future there will be coexistence of assets on both of those chains, and we will need the appropriate cyber and KYC and AML sort of protections that you have on private chains associated with parts of public chains, and that's a technical and quasi-legal problem to solve. That's not a law of physics, so it's solvable. We don't have to break that.
So it sounds we're all open to all these options effectively, and matching the right solution to the right problem effectively. And I think that takes me to the next question, which is, one of the areas where public blockchains are potentially stronger, and maybe not in all cases, would be the settlement side of the equation. Because when you're talking about trading private securities, somebody has to move the private securities, somebody on the other side has to pay, right? Or if we're doing DeFi or something, somebody has to collateralize the security, but on the other side, you want to move money as a lending, or if you're doing lending solutions and so on. Scott, what do you think? How do you see the future kind of the payment leg? Because the whole thing doesn't work if you can move securities digitally, but then you wire the money, right, and wait 3 days. That's not what we have in mind.
There's practical and philosophical questions there that are really quite interesting around sort of
run with it.
Not just how we make it work today, but like, so how do consumers who want to get exposure to cryptocurrencies actually get exposure to that? How do they turn dollars into Bitcoin? Like, how do you then trade it? Like, there's a whole, that's not seamless either necessarily. You've still got to move money from point A to point B at some point, transform it, and then once you're in the ecosystem, you've got a bit more frictionless activity, but you've still got to get in the ecosystem, and at some point you might want to get out of the ecosystem. So there's that problem exists, whether it's sort of in the sort of public blockchain crypto space, or whether it exists in like more regulated financial market products where you're exchanging, asset for cash as well. And maybe you do that at a high frequency, or you do that in a different way. I think the interesting challenge inside the sort of more regulated markets, whether it be public securities or private market activity, is what's the expectation and the capability today, and how do we make sure we don't go backwards? And one of the challenges there is, securities versus cash, and the existing architecture settles delivery versus payment in most instances. So we don't have I didn't send you the money, or you didn't send me the securities. You get that instantaneous sort of exchange, and removes the credit risk from that particular trade. There's not a lot of cash on distributed ledger out there, so therefore you can tokenize as many things as you want, and you could theoretically tokenize anything. And I think, again, that's a relatively sort of accepted argument, whether it be a piece of a wind farm, a piece of art, US Treasury, or whatever. You can represent that as a token in whatever form, but unless you have the cash to exchange that for in a way that is equivalent from a versus payment, like simultaneous way that you can today, which you can in places, then you go backwards, and actually you're introducing a different type of risk into the ecosystem that actually we've kind of moved away from. So I think, to your point around you said that the cash problem and how you manage that settlement leg and what that looks like, if we're maintaining the existing risk profile and moving forward, and you're generating efficiency on the back of that, great. If you're going backwards, I think there's a real challenge there to get people to accept that extra layer of risk as an offset for the efficiencies. The efficiencies and the costs and the time, etc., would have to be significant to then turn around and say, even if it's a 20-minute gap, that has actual practical risk framework implications for financial institutions. There's a cost associated with it. So that I think is going to be solved. And as we see, whether it be the appropriate regulation, and I don't know what appropriate means, but appropriate regulation around stable coins to then have them accepted as part of the broader ecosystem, whether it be central banks issuing a currency, or even just moving part of the currency on chain onto a ledger, so you've got regular dollars moving on a different technology platform. But I think bringing some cash at scale will really accelerate the opportunity to improve the settlement, which then takes that risk question away, which means then you're just realizing the efficiency benefits that are available through tokenization. And that piece there, I expect, is something that's probably solvable over a 12 to 24 month horizon, or at least sort of getting into the space where you're bringing mass to that. But it's challenging. I think it's surprising how both on the public crypto side and the digitized security side, the thing that everyone thinks is easiest, which is cash, is actually one of the harder problems to solve. when it comes to entering and exiting either of those markets?
Yes, I think that at least in the security side, you're right. We are waiting for those kind of long-term solutions, but because we all want to go to production and we're talking about getting real, we are finding the solutions that are immediately available now. And those solutions are, for example, you talk about pre-funded accounts, where you talk about pre-funded accounts where you actually mimic traditional escrow and you give people a coupon for their money and you use that. So that's doable, right? Then you have the stable coins, the USDCs of the world, and how much do you trust them? If you're maybe a small player, you're okay with it. If you're a bigger player, maybe it's too much counterparty risk. And then you go up the ladder, you talk about treasury. Can you use treasury tokens as a means of payment? And I think you're in the camp that you had to find a solution. So I'm assuming you're using some sort of pre-funded account model.
Yeah, that's exactly right. I was just going to say, in our sort of setting, when we set it up, clearly, we have, because it's a private blockchain, it's also easier to execute all of that. So we are instantaneously settling, it's DVP, and we are using pre-funding as a mechanism. But I actually think that sort of going forward, because of the connectivity that we see with the traditional institutions, I think we will solve the cash piece hopefully quite soon. Because if everybody puts their head to how do we connect with a chain, how does the bank connect there, and how does the cash move, I think that's level number one. And as you said, Ami, I think the next step will be things like stable coins. How does that work? CBDCs, how is that going to incorporate into our ecosystem? I think that's actually going to happen quite quickly. I would say, as part of your what's the next 2 years, I think this is within the next 2 years. In fact, I think it'll be the next year.
I think it's moving faster in Asia. Moving over to Barrett, you've been involved in some CBDCs, I think, trials and processes and so on, and consortium, but still there's no stable coin in euro, is there?
Let's say
in euro today.
Yeah, nothing substantial enough that you could settle, large security trades with, so to be honest, but then I'm really just talking about, let's say, the Europe zone. I'm a little bit less optimistic for how fast we will have a solution. I think a euro stable coin is not that close. I think financially that's a little bit difficult at the moment in Europe, because you would kind of have to have a negative interest on that stable coin for it to make sense for anyone to offer it, which is obviously something that no one would accept. So unless you can get really creative, I think it would be hard to have a privately or commercially issued euro stablecoin at scale to be used for security settlement digitally. So besides that, I think a CBDC also for the Europe zone, I don't expect it to be there in the next 12 to 24 months. I think most central banks in Europe are still investigating this. They have, concrete investigation plans for it. They will last at least another 2 years, and only then, could an implementation be starting. And then I think the final, hurdle that I do also see when it comes to CBDCs is that I think a lot of the projects from central banks are currently focusing on designing and implementing a retail CBDC, which actually might result in a design, or is actually very likely to result in a design that can absolutely not be used for security settlement. So I'm a little bit less optimistic on when we'll get saved by the central banks because they're going to issue a digital currency. So for the time being, we have to look at other possibilities and mechanisms to do that. Obviously, pre-funding is an option, although I think in the long term, that's also suboptimal, right? We all want still something better than that. But I do think on the short term, that's one of the mechanisms that we'll have to use for the lack
it is a funny one, the sort of, and I agree with you, the CBDC, if you turn it into a full-fledged central bank digital currency, actually gets quite complex. There's a whole bunch of factors around that debate that are quite interesting. If you just turn around and say, why don't we just put euros on a distributed ledger path? So I've got target 2 for cash settlements, I've got target 2 securities for security settlements, and now I've got target 2 digital for digital settlements. It's just euros on a different form. And I think, that'd be quite helpful if if there was an approach for simplification, because you could see, you would then down select to a core technology provider. You would then provide a sort of a natural kind of layer that actually you could extend the capabilities of the currency if and when you chose to do that as a central bank. Like if they wanted to go down that route, a lot of the sort of logistical and infrastructure problems would be sorted to then think about, well, actually now on those rails, I can put other types of digital currencies. But if it's just cash on the European Central Bank balance sheet or cash on the Fed's balance sheet, they have different types of sub accounts now. Have a digital one. It'd be really interesting to move that. That would be something that could move the needle forward. I'm not particularly hopeful, but it would be a nice halfway house to accelerate towards if we could win that argument.
Yeah. Well, we are now, as I said, we have the solutions of the pre-funding. We can look at other solutions that, again, I haven't seen. I keep talking about the option of using treasury tokens as a payment mechanism because they are securities and they are stable and they are movable. So there's some logic to that as well, and also kind of the regulatory side is being looked into. So that could be an interesting solution. But what I would say right now to whoever's watching right now, here's a huge business opportunity. Find a way to do a European euro stablecoin and be as big as Circle. So that's something we learned from here. I think for our last few minutes, I'd like to do a quick round of just coming back to a question that I'm always, it's important for me to answer when we talk about tokenization. That's the question of why. Okay, so we are working on tokenization project, but why? What are the big things that are worth this move to the tokenization platform? And I think some of them are quite obvious, but I'd love to hear your opinion specifically on projects that you are in, where you see the big kind of reasons to do tokenization and why it's so critical for organizations to focus on that. Where shall I start? Oye, do you want to go ahead?
Yeah, sure, absolutely. We started really thinking about solving a problem or solving a need, right? We started with sort of saying we want to democratize private market investing. How do we best do that, right? What are some of the issues? What are some of the pain points? Fractionalization clearly changes the risk profile of a private market product and makes it a bit more suitable for high net worth individuals. How do we do that on a very efficient ledger so that we are managing all of this, the issuance and the post-trade as efficiently as possible? And as it turns out, obviously, blockchain is one of the most, at the moment, the most efficient and the best way possible to execute that. Now, we started off thinking democratization, but as we went into it, we realized that there's so many inefficiencies in the capital markets that are solvable, so that when we just built a platform, a lot of these things came naturally to us. So issuers came to us saying, we want to do a digitally native bond because we see the efficiencies of a smaller company, for example, not wanting to go the traditional 200, 500 million bond route, do a smaller size, shorter tenor, quicker turn. There's less fuss, there's less intermediaries involved. And, I think that's starting to sort of expose actually a large number of inefficiencies in the traditional markets and traditional securities. So it's not even about opening new markets. It's actually just the same clients and giving them different avenues for financing or giving them different ideas for, debt funding or things like that, or pre-IPO raising, for example.
Yeah, well, there's a lot of room for optimization. Scott, what about you? What are you seeing in terms of the reasons why you're going to your organization saying DLT?
Yeah, I think there's a lot of, like with any business, big or small, there's got to be a commercial driver for it. So where's the outcome that is relatively commercial? Because making it a bit neater, if it doesn't have any impact on the economics, no one's really bothered. And I do think, in an environment where there's lots of liquidity, not a lot of yield, but still a lot of heavy costs, then attacking the efficiency angle is quite a useful one, because you can take things out of the bottom line. And simple things like, removing inefficiency from the operational process, which then has a cost associated with it. The very fact that, to the bond point, they haven't changed in 100 and something years. We still pay coupons semi-annually or annually because people used to have to tear a strip off, post it away somewhere, post it away somewhere and then get it processed and then get their money and then account for that in an actual physical ledger. And when we dematerialized bonds through the 70s to 90s, that didn't change. So like there's dematerialization 2.0 coming, which you can turn around and say, well, actually a lot of those processes that we get people to do today, we don't need people to do. We don't need to accrue that credit risk. We don't need to maintain sort of a whole bunch of engines. We don't need to figure out like how much coupon I own because I sold it 100 days into the coupon period versus how much you own, and therefore there's like all of that can just go if you think about a specific bond having a different set of characteristics. And there's a lot of cost in that. And if you can get rid of that cost, like someone wears it somewhere, and particularly in the end result is going to be, you know, underlying issuers. So you then make capital flows cheaper. That's a good outcome. Yeah. So I think that's kind of like something, you step out of the specific details and look at kind of how we get into like large scale general positive outcomes, then that feels like it's a way of attacking some of these issues about making, you know, better use of capital than spending it on the process.
Yeah. And Berit, from your side, what are you seeing? Also, do you have also you know, focus on optimization, or in the innovation kind of group, are you also talking about new use cases?
Yeah, so actually both. So obviously, one of the things that we also started out with is all these optimizations and efficiencies that we could achieve. And although that is true, we also had a little bit of a reality check, right? Because if you do just one bond issuance tokenized, the bottom line of your operations is not going to change, right? So unless you actually do the majority of your, for example, your bond issuances or the majority of your business completely digital and completely tokenized, only then will your actual cost really go down, of course. So and I don't want to diminish the potential efficiencies and optimizations that you could achieve, but we have to be realistic, as in that's not going to, you know, pay itself out on day one. But besides that, indeed, working from innovation, we also have to look at indeed new avenues of business that we could generate. And I think, you know, I already heard, you know, the smaller tickets. So can we make products and processes accessible to customers that are just below, you know, our current thresholds because the technology is more efficient? Can you indeed create, for example, secondary markets? Again, liquidity is also not guaranteed on day one, right? So, but I don't think we should be scared of that chicken and egg problem, because if nobody starts it, we'll also never get there. And I think that there is enough benefits to gain to basically start this change, even if the big benefits are only coming a little bit further away.
Yeah, I agree. I think my kind of final comment, I think we're about to close in terms of time. I would say that, yes, in terms of optimization, it's a very easy sell because, you know, you can show it, you can demonstrate it, and it's a good show. But also, if you want to get some excitement within the organization, you can talk about new markets where you can take market share and build new businesses, and that's at the higher level of the kind of the financial institution could also be interesting. A good example that I always look at is collateralization. I mean, we've seen from the crypto world, collateralization could be as simple as a pair that, you know, a lending and borrowing could be a thing. It doesn't need to go through 15 layers of approval and credit checks and so on. So imagine you can take your real estate holdings or your my shares in a unicorn that I founded, and instead of having it sit down, I could borrow money against it at a click of a button, and nobody checks my credit and nobody does anything because it's completely automated and DeFi. This is a whole new market and it's exciting. So that's the other side of the equation, trying to balance this. Okay, let's do things that are significantly more optimized than before, but also let's offer these new things that the digitization offers that couldn't have been done without it. I think we are out of time at this stage. But I really want to thank all of you. It was a exciting and very interesting conversation. And I want to thank you again for coming today. Thank you.
Thanks, everyone.
Thank you.
Thank you.
Good day.
Bye.
Boom. Some amazing conversations so far. Thank you all so much for joining in and interacting on YouTube and our other streaming platforms as well. It's now time to turn it over to Linda Zhang of Transparent Financial Systems and her panel of industry experts, including former SEC Chairman Jay Clayton, to shed light on the evolution of capital markets. This session will be followed by Skybridge Capital's Anthony Scaramucci. So keep watching and don't miss out.
Hi, everyone. I think we are all on screen. I'm the Global Head of Policy at Transparent Financial Systems. We are a payment startup that is developing a digital dollar payment solution for U.S. businesses. I'm also a visiting scholar at Georgetown Law. And I have to say, I was delighted to be asked to moderate today's panel because I once regulated securities exchanges and other trading venues at the SEC back in the day. And at that time, and this was in the 2000s, we were focused on breaking the monopoly of traditional stock exchanges like NYSE and Amex, while ensuring the growth of a national market system of exchanges, alternative trading systems, broker-dealers, and high-frequency traders, utilizing a national best bid and offer price and security. So I thought I was dealing with new financial technology back then. But today's panelists are going to talk to you about the next leap in the evolution of capital markets. We have Anthony Woolley, Head of Business Development at Ownera, Dan Doney, CEO of Securrency, Michele Cortoni, Head of Strategy at Six Digital Exchange, Charles Gillanders, U.S. Bank Global Fund Services, and Jay Clayton, former SEC Chair and Senior Policy Advisor and of Counsel at Sullivan & Cromwell. These panelists are building, almost literally as we speak, interoperable ecosystems through crypto. And as some of you may know, a research focus of mine is in the intersection of open banking and DeFi and how to reduce the stickiness of bank deposits through data sharing. But similar issues arise in securities as well. And the other week, I was having coffee with a friend who described a tortuous process of transferring securities he owned to a new broker-dealer. It was so complicated, I was unable to follow his story. So I'm now excited to share with the audience some of the latest developments in digital securities. Anthony, I watched the Ownera video about Fin2P2, and I was very impressed. For the audience, Fin2P2 is an interoperable routing network that can cross multiple types of ledgers and different types of parties. So Anthony, can you please talk us through how you are breaking down silos to improve market efficiency and liquidity, and more importantly, the customer experience? And how was Ownera able to do it?
Yes, indeed. Well, thank you, Linda, and a pleasure to be here today. Calling from London. As you can see, the sun's gone down here. What I would say, I have a background in public capital markets, many years working for large institutions, understanding the complexities of that environment. And I joined Ownera and left that institutional world to focus on digitizing the private markets, right? Which is arguably the world's largest offline market, and therefore one that is incredibly inefficient, right? Today, private assets can only be accessed by a limited number of institutional investors who have privileged access, very deep pockets, and transactions have tremendous friction there, often taking weeks to execute. So definitely in the private markets, there isn't currently any market efficiency or liquidity. Now, if you look across at the public capital markets, you can make the case that there's some market efficiency and liquidity, but that is being achieved at tremendous cost, right? Institutions today, large institutions spend billions of dollars a year on public markets infrastructure, and they're trying to optimize 50 years of legacy, right? These complex chains of intermediaries, complex technology, operations, and really outdated assumptions about what is required to move value around the world. So for me, the infrastructure of public capital markets is just not fit for purpose for the scale, efficiency, and global distribution that the private markets require, right? And then over on the other side, you've got the world of crypto, right? That we're talking about here. And crypto's been innovating at a tremendous pace free of that legacy and assumptions about how the world should work, right? So it comes at the world from a position that, of course, trading should run 24/7 seamlessly around the world, right? We're in a global environment, and of course, assets should be secured cryptographically, and investors' identity should be protected cryptographically, and things like real-time settlement are just a basic fundamental assumption. And so the world of crypto, when it has all of that, then you can do the really exciting things, right? Smart contracts for managing decentralized lending and borrowing and so forth. But the crypto world does lack some things, right? It lacks the level of institutional participation today. It lacks sufficient regulatory clarity and really the global interoperability that can support distribution of high quality assets at scale around the world. So coming to what we've done at Ownera, I mean, really, the first and foremost, we brought the industry together, right? So to take the private markets online, no one entity can do it unilaterally on their own. So we brought the industry together to develop this open source protocol, FinP2P, short for financial peer-to-peer, and we did that with a vision of leveraging the innovations and service expectations of the world of crypto, but without falling into the trap of inheriting all the inefficiencies of the public markets. And so FinP2P is a digital cryptographically secured routing network that basically enables any asset, whatever type of ledger it's on, whatever type of DLT, or even indeed some legacy centralized ledger infrastructures, to distribute those assets to investors wherever they may be, but investors, importantly, who have their identity secured through a cryptographic wallet, whether that's a wallet that they represent themselves or an institution is protecting that cryptographic identity for them. That routing network can then also orchestrate transactions rates. So to unlock this distribution, you need to handle the securities and the payment leg of a transaction. So FinP2P can orchestrate such that you can have an asset sitting on one type of blockchain somewhere, and you could pay for it with a stable coin or eventually a CBDC coming from somewhere else. And once you can do that, you can also orchestrate the pledging of assets across that network. And that really unlocks the whole world of DeFi, right? The world of lending and borrowing. So we think that ability to connect once for an institution or a marketplace to connect once through an open source API to FinP2P is very seductive. It enables those institutions and participants to reach many pools of assets and investors. And we think if you've got high quality assets, you've got scale, you've got distribution, you can reach the investors, both the supply and demand is there, then that will drive efficiency and liquidity for the private markets, and also maybe show the compass and lead the way for a roadmap for where the public markets should be going as well.
Thank you, Anthony. That is an incredible ecosystem that you've built, and Securrency is one of the integration partners. Dan, can you tell us, how that partnership works, and in particular about the DeFi offering that we'll be announcing soon that will also incorporate a compliance component? I'm very interested in hearing how a product like that can, help make securities trading more compliant and secure.
Yeah, thanks, Linda. So some of the keys to these markets, understanding how blockchain solutions work and actually can enhance compliance, have to do with the baseline of what a distributed ledger is. Distributed ledgers are state machines. So any change in state has to be authorized by a party. So you have a wallet which signs a transaction that results in a change of state. So what's powerful about blockchain ledgers is you actually have a mechanism by which you have full accountability as to who made this thing happen, or at least which wallet did. And if you add a compliance layer to that, which ensures that only wallets that have been registered by known and qualified licensed parties can engage in a transaction, you actually get a mechanism by which you can have accountability across the distributed ledger for every change in state. Now, that's of course important from a regulatory perspective, is to be able to understand who's accountable for this transaction. But you can go a step further. You can actually encode the regulations, like for example, a transaction that might involve a Reg D instrument here in the US, of course, a party has to have certain qualifications in order to conduct that transaction. And you can verify that those qualifications are present, even in a peer-to-peer transaction, that those qualifications are in place. So this opens up the possibility of engaging in DeFi transactions, peer-to-peer transactions that may be more complex, trading transactions, lending transactions, by which parties who hold the proper qualifications can conduct those transactions. What Securrency's innovation in the space as we work with Ownera and others in Fin2P2P is a mechanism by which those regulations can be encoded and effectively in a special purpose language, which then can be attached to the assets and govern their transactions. So as Anthony mentioned, especially in private securities markets at global scale, there are many regulations from many different countries that may be implicated in a specific securities transaction. By encoding those regulations and allowing the regulators to actually test and verify that they in fact enforce their rules, those can then be attached to and considered in real time in smart contract transactions. This makes for a much more powerful financial space, as especially with private securities, those rules are often enforced to the best of people's ability, but not necessarily well, because who necessarily knows the rules of Australia or UAE when engaging in those transactions? This gives you certainty. It allows for very efficient, accountable transactions, and even in the DeFi space. So DeFi with lending, peer-to-peer trading, automated market making, yield farming, each of those are transactions that have rules that can be enforced in that space. So we're excited about the future of finance, regulated finance on blockchain rails. And partners like Charles are going to tell you exactly how that works is up next.
Great, thank you. So Charles, like with all these technological advances, US Bank is beginning to offer custodial services for institutional investors in the US and Caymans. So tell us, US Bank is an old and conservative bank. How did you guys arrive at a place where you're now feeling comfortable in providing custodial services of digital assets?
Yeah, no, thanks, Linda. So US Bank has been engaged in pilots with blockchain and crypto technologies for a good 5 or more years now. But I think it's been talked about already. We wanted to wait to see how the regulatory environment shook out. And the OCC letter last year on national banks holding cryptocurrency in custody for their customers, that was the first point at which we identified there is a sufficient mix now of regulatory clarity, a well understood market segment that we knew and were familiar with, and a well understood service that we were familiar with, and that means that the unknowns for our risk and compliance teams suddenly become very, very small. Once you have that regulatory clarity, once you have the known market segment you're addressing and the known market service you're providing, everything else is very addressable. And so that was the first opportunity for us to move forward in a crypto space. And we have more engagement coming, dependent on how regulatory changes shake out and how we see our customers' needs and the services that we can provide them.
Thanks, Charles. So, speaking of regulations, Michele, congratulations on Six Digital Exchange getting its regulatory approval from FINMA for its securities exchange and CSD. Building on Charles's remarks, in the crypto environment, you're seeing a lot of trends that are moving very quickly between traditional custody services and digital CSDs such as Six Digitals. Could you, elaborate on this for us?
Yeah, absolutely. Thank you, Linda, and pleasure to be here. I think, yeah, you're making a great point where in crypto, what many refer to digital custody has always been a safekeeping exercise. When you then bring that over into regulated market, well, that just doesn't make the cut, right? So CSDs are there, and in Europe we have CSDR, defining a CSD, I think three things, an entity that operates a security settlement system, an entity that records new issues, and an entity that maintains the security accounts. Now, all those three things kind of under CSDR create the central security depository for which you have assets in there to be determined, the specific security to be traded on public markets. Otherwise, that cannot be. So that the way that Six and SDX took this route into digitalization of, again, public markets first, to go in contrast to Anthony and Ben were mentioning earlier, is that, there is going to be this evolution also in public markets. And we decided to kind of put our flag in the ground and say, look, we can prove that we can build a strong and secure and safe, infrastructure based on blockchain. Of course, not the trading bit, but based on blockchain on the CSD level with atomic settlement and all the different capabilities that, distributed ledger that Dan so well explained earlier can bring to asset transfers, and then we can actually bring a regulated wrapper around it, so that we can actually prove that you can build an FMI based on the distributed system. Of course, it's a roadmap. Of course, some part of the centralized, and then there's a roadmap out into the decentralization, into working towards that as a distributed financial ecosystem that we can already see in crypto. So basically, and going back to your question in the custody, it's part of what a CSD does. And from a functional or from a technical perspective, it's all about, again, the keys and control and possession and where they sit and who can control them and what is the compliance framework and operational framework around it. Now, we work under a specific regulation that already informs us how to do it. But then we're basically proving that what you can do in the crypto world can be translated in public securities and to a CSD within the framework that is well existed, for the past few decades or so. The other thing to be interested in mentioning is the speed with which this the crypto ecosystem has been doing that. Kind of we're there and looking and trying to keep up with the pace. That's why I mentioned earlier, we put the flag in the ground and say, yeah, you can build this ecosystem and FMI based on blockchain, and it's part of a long journey. At the same time, we keep an eye out on how the DeFi and the crypto world is evolving, because are there synergies to be created? Yes, from a regulatory perspective, is a kind of a big question mark. How's that going to happen? But is there an expansion of the FMI role into some of these spaces? In how we don't know. I mean, that's a completely different question. But that's kind of our hypothesis. We're there to witness this expansion, and we started by creating a digital market infrastructure, as we call it, DMI.
Thank you, Michele. So I now turn to Jay. Unlike Switzerland, the US does not have a specific legal framework for digital assets. Do you think the current US regulatory framework is sufficient for supporting all of this innovation we're hearing about today?
Well, I believe that the legal framework that we have in the United States, which is both what I would say is a code-based and principles-based legal framework. In Europe, you have much more code-based legal framework, has demonstrated to be incredibly resilient. It is a function, substance-based regulatory system. So much of what we're seeing this technology applied to are functions, instruments, exposures, transactions that already exist. we're just seeing great efficiency come. Now, not every one of them. You know, there's an NFT market that is different from things I think we've seen in the past, and there are other things that are different, but a large portion of it fits well within the functions, instruments, et cetera, that we've regulated for some time. That doesn't mean that those processes can't be improved. In fact, I think they can be greatly improved. I mean, Anthony gave us sort of a tour de force, following up with some specific examples, you know, from Dan, Charles, and McKelly on where there are real efficiencies to be gained. The approach to that, I would say to people in the private sector, is what were the regulatory objectives of the old technology? Do those objectives at least as well, and then capture the efficiencies that the new technology brings. That's on sort of a micro basis, a really good way to look at the opportunity set within the regulatory framework that we have in the past. So let me pause there and see if you have any follow-ups.
Yeah, I think that's an excellent guidepost for industry. And before I ask my next question, anyone want to react to Jay's remarks?
Yeah, I mean, I would just say I wholeheartedly agree with that. You know, at the end of the day, what we're talking about here, a lot of it is already covered. You know, I don't agree with people who are taking a view of maybe this thing I'm holding isn't security, right? You know, if it looks like a security and it smells like a security, it's probably a security, right? A lot of the time we're dealing with, you know, existing financial instruments, whether that's on the securities or the payment side. And every time I see some new regulatory guidance coming out, actually I see that personally as a positive step. It's a reflection of you know, the world growing up, an environment where institutions can engage, and we can transform the financial industry at scale without being stuck with a legacy of 50 years of legacy infrastructure. And I think we're at quite a pivotal important time now where you can see institutions engaging, because we are reaching a level of regulatory clarity that can enable these transformations to happen in a safe and secure way, one that maybe passes the mum test, right? Where you can put your hand on your heart and say to your mum, yeah, you can do this safely and you can invest in it, and I trust this environment, right?
Yeah, I'd just further on that quickly, Linda, that we've seen no case where regulations and blockchain systems are incompatible. There's not a single example of a regulation in place, at least from US regulations, that would prohibit a party from operating a blockchain system, and vice versa. These fit nicely and in fact enhance and even support regulatory compliance. So we don't think the rules have to change. Clarity is always helpful. Statements that back affirmatively specific actions in the space are helpful. But we're not at a point where the US is preventing blockchain operations by any stretch.
Yeah,
I think in Europe.
Yes, please.
I'll be quick. To Jay's point, you know, a code-based versus principle-based, kind of the Napoleonic style that we like here on the continent. I'm in London, so that does work. But there's some countries like Germany and Switzerland, France and Italy to some extent, started creating the concept of that the security can be logged into a distributed system on a public network. That had to be done separately from existing regulation on the double book entry. You know, we had to build our CSD on that premise, because, you know, to the point, you know, CSDR did encompass a blockchain system. Of course it did. But in Germany, there's something called electronic Wertpapier, that, you know, the digital you know, Schuldschein kind of certificates and instruments that can be directly issued on a DLT, on Ethereum or whatever you have, Stellar or whatever you want. So I think that had to take a little bit of a diversion from existing regulation, but again, because it has to point to a specific functional description that maybe in a principle-based, I'm not a lawyer, but a principle-based country then would not need to.
Thank you. Charles, would you like to say something?
Apologies, I seem to have dropped off there for a minute. I think the only comment I would add is that you know, we've been working with Dan and security team for a while now, and one of the things that we find really fascinating about the product is that idea of global regulatory compliance. And I think it's wonderful that we have a framework being developed that will allow us to do so. But I do suspect that in the greater scheme of things, regulatory arbitrage is going to cause us all challenges. That having different environments with different levels of comfort around the world, when, to Anthony's point, these investors and issuers just expect that this is going to work, and it shouldn't matter where globally you happen to be sitting when you want to conduct a transaction. So I think that is something that collectively we all face eventually. But yeah, having the capability to live with what we have now is certainly very, very positive.
Thanks, Charles. So now I want to take the opportunity to switch to forward-looking questions. Dan, during our prep call, we shared different ways that DeFi and crypto can help companies and regulators manage risk. For example, asset-backed securities were a key transmission risk during the subprime mortgage crisis, but you shared a way DeFi could actually help with this problem. Could you share with our audience some of your thoughts?
Yes. So at the center of DeFi is self-processing assets. So that's framework smart contracts that actually process themselves. So think about it this way: if I've got a bank loan, having the logic associated with the loan and its processing and its reporting built into the loan itself, such that when a payment is made to the loan, it's recorded immutably, and then the payoff to the appropriate party, its owner, is managed through the smart contract. And of course, that adds to a layer of transparency, but it also gets to the beginning of solving what nearly caused the global financial collapse in the world. So we've developed a protocol that allows you to build, for example, securitized lending pools, which are warehoused loans or even RMBS portfolios, where the individual assets are reporting their performance. The fund is itself reporting its performance and handling the processing of the performance of those loans, all automatically in a fully transparent way, such that it can be audited. So when you look back to 2008, and what's more, where you can measure the encumbrance and risk associated with any asset in real time. So going back to 2008, of course, the problem there is we had large RMBS portfolios with underperforming assets, with limited transparency to the underperforming assets, which were then being used by many institutional parties as collateral on their balance sheets for other assets. Again, in the DeFi world, all of this encumbrance, all of the linkage between assets is fully traceable and can be measured in real time. In the old world, it wasn't. So when the collapse began, when things began to unroll, the impact on balance sheet after balance sheet became apparent over a very quick period of time, but it wasn't known in advance. So what has been done to fix the 2008 problem, we would argue in many cases hasn't fixed it. In some ways, perhaps has made it worse. What we're emphasizing is look to DeFi, regulated DeFi, because the solutions to some of the way you better handle collateral, the way you better measure balance sheet risks are actually there. And so we're excited to roll that out with our banking partners like US Bank and State Street to really have much more efficient, accountable, reliable, and with real-time measure of risk on bank balance sheets.
Yeah, thanks, Dan. That's really exciting, and also exciting to show policymakers in the town where I live, Washington, D.C., that DeFi is actually a tool that can be used to shine light in parts of the market that had been traditionally opaque. So, Charles, where do you think traditional banks are going to be heading next in the digital asset service industry?
Whoa, that's a $64,000 question, isn't it, Linda? So what I will say is that let me take the negative on that. What traditional banks are not going to be doing is standing up large teams of back office staff to process transactions. I think that the days of banks being a transaction processing environment are gone by now. The functions that we provide are those of trusted intermediaries who are regulated and compliant and have the infrastructure in place to demonstrate that they are capable of applying proper regulatory compliance services on behalf of other institutions at scale. And I think this merges very well with what Anthony was talking about before. The traditional banks are very well positioned to be those trusted service providers to those institutions at that kind of scale, but it's not going to involve back office transaction processing. We will have to adapt to the new markets just like everybody else is doing.
Thanks, Charles. So this next question is for both Michele and Anthony. Can you describe what you think will be the future of capital markets infrastructure? Do you see a variegated world of interconnected global networks or something different?
Michaelis, do you want to take this first on me?
I'll take the public, you take the private. And let's see how we merge. Kind of really follow Charles' point. There's going to be bottom up. So we used to work at the London Stock Exchange group for many years, and every time we start creating a value chain of the life cycle of a trade, you always start from the pre-trade and all the data that goes into creating that and opportunities all the way down to settlement. I think all that life cycle has dramatically changed. I think settlement completely changed that. Clearing very often is not required when you have certainty of settlement on a blockchain system rather than probabilistic settlement. You might actually still need some risk management, but it's dramatically different. So I think from the bottom up of that people used to refer to back office, but from an FMI perspective, that's where the real money was, right? Not really in trading and equity, but all the operation and the plumbing. I think that's the advent of blockchain systems and smart contracts, business logic, and therefore how these assets can be created in a network. Has changed that. So we kind of tested that under a specific regulatory framework in Switzerland, and now we're ready to take the next steps with issuances of these digital bonds that we're going to be working on and building out the pipeline. At the same time, there's something that we should not forget is that centralized markets are going to become decentralized, right? So how do we position ourselves from a specific perspective of a centralized market infrastructure to then open up and create that future ecosystem that we're really here discussing? And I think it can be done in multiple ways. There are many access points. There's the issuance point, there's the CSD point. So private market, then a private asset will be logged into a CSD if there's a specific need for that, for voting rights or what have you, or the requirement for a custodian to have asset in a security settlement system. Well, then you can log that in, and then you build the ecosystem down at the security settlement system, or then up at the issuance level. So building up a tokenization platform ecosystem directly to feed a primary markets platform or a secondary market platform as needs be to capital raise, or decentralize that completely. So I think we're really looking at the asset life cycle of a trade, compressing it and then distributing up and down, right? So I think the answer is a bit vague, but it will take days to really kind of put it up and map it on a whiteboard. But I think we're taking a lot of interesting steps on those, starting from the CSD, which is our strength.
Mm-hmm. So it sounds like you're literally just unbundling all those different services that had all been provided before at the exchange. And Anthony, you're next.
Yeah, I might cover a bit of the public and the private. So, and I think Dan was right to tell the story about the financial crisis, because I think the world mustn't be complacent thinking that the infrastructure, the existing public capital markets, is fit for purpose, right? It's not. What's happened in the last 10 years is that banks and regulators have wrapped sticking plaster around that infrastructure to meet the needs of compliance, to meet the needs of regulatory reporting. So you have hundreds of operational staff in banks trying to report in real time to regulators what's going on to compensate for inefficiencies in the infrastructure. And I think what's not going to happen is the public markets are not going to be saved by, to use the analogy, jacking up the house, trying to replace the foundations and dropping the house back on it. I think, the last 5 or 6 years, I think there are many large banks that thought that this blockchain could be adapted to save them somehow by transforming their back offices, taking costs out of their back offices. But it's not that simple, and you can't just use the technology to optimize what you already have. I think what we're seeing, and up until now, the world of traditional financial services has stood in kind of splendid isolation from the world of crypto. And I think we're at the point where that's changing, right? Where we're going to start to see those two worlds start to interoperate. I would be a little bit biased to say we see this happening first in the private markets, where there isn't that 50 years of legacy. And we see it starting to happen by doing fundamental and simple things like giving an investor a cryptographic identity where they can hold assets from both the new digital world and the traditional world in the same wallet, right? Now, it seems pretty obvious, but this sets you on a path where a bank account can't just be in a record in a database in a bank's back office, right? Every account in the financial industry needs to be a cryptographically secure wallet somewhere. Once you can start to provide that investor identity with those wallets, and you can provide access to assets from the old and new world, then you can start to deal with achieving efficient digital chain end to end, where an investor is investing in a digital asset in real time, where you can achieve real-time settlement of that asset, and where you can pledge that asset across the network. And I think then, by force of economic gravity, you'll see a siphoning of assets, financial assets, from the old world into the new world. And so I think that's more how that transformation journey will unfold, first in the private markets in the coming few years, and then onwards through the public markets. And then I think you'll wake up one day and you'll think, wow, wasn't it crazy that financial instruments used to take 2 days to settle? Unbelievable.
And when I was at the SEC, it was 3 days. So I am very struck by your remark about how the future of finance is predicated on a digital identity. And that is probably an issue that policymakers here in DC really haven't spent a lot of time thinking about, but certainly you do when you have to build your infrastructure. And so now I turn to Jay, who was the former SEC chair. This is remarkable timing in that the PWG stablecoin report came out this week, and I'd like to get your thoughts on if you think this report could impact the digital securities market, and more generally, if you think that industry and regulators need to do more to help facilitate the construction of a safe and resilient market infrastructure for capital markets.
Well, let me answer your second question first, and then try to use your first question to wrap up what we just heard. So your second question first, of course they do. Regulators are vigilant every day. And that's what we hire them to do, pay them to do, and they need to adapt. Really great points made on what's going to drive this push into the digital world. Consumer demand. Consumers are going to want this because it's more efficient, more accessible. We're seeing that in many forms. To Dan's point, it's a better product, not just from an individual point of view, but from a systemic risk point of view. Those types of things are going to drive this. But I think we would be naive to assert that at the center of our financial system, we will not have, for some long period of time, fiat currency and sovereign debt. Sovereign debt and fiat currency are tied into so much of our lives. Funding of all government obligations, actually funding of the funding markets, are all come back to short-term treasuries, cash, and the like. What I see from the PWG report is some recognition that the rails for that core of the financial system will need to adapt so that they can integrate with what I would call the consumer digital economy that's coming. So I took that as a good step. There was a previous PWG report on stablecoins. This is a second one to recognize that our financial system is completely integrated across all of these products. At the core of the financial system for some period of time is going to be fiat currency and sovereign debt. But figuring out how to best connect that with these developments is something that governments should certainly explore. I think the ECB is already doing it. Looks like the US government is doing it. The Chinese are doing it in certain ways. That is an area to pay attention to.
Thank you. We have a couple of minutes left. Would anyone like to respond to Jay's remarks?
I think very quickly, we as SDX, we've done extensive experimentation with S&D and Switzerland on stablecoins as well, and how to integrate that 6 runs to payment service in Switzerland with something I didn't know when I started. You pay with a credit card is actually done with a stock exchange. So how integrated a system that is, and those CBDC experimentation are really the heart of what we do in settlement in our CSD, right? That's how the only way atomic settlement can actually happen. And I think the expansion into Europe from a currency perspective with the ECB experimentation is the next step. So something that, underway.
Yeah, I would.
Sorry, Dan, go ahead.
Yeah, I would just say that the fact that the legacy system has separated rails for the payments and securities clearing that only barely touch is part of the reason why we have multi-day settlements. And so certainly it's possible. In fact, it's much more practical to have a common set of rails to manage all forms of value. And it allows for much more efficient transactions to occur. That doesn't mean there should be one distributed ledger, but the mechanism by which we can reconcile across all forms of value, we will see consolidation. It's certainly promising for the future of securities.
Yeah, and I think this piece is the absolute key thing, right? For somebody who spends my life in the world of securities, I think the most exciting thing that's happened the last 2 years is what's going on with stable coins. Right, I read the President Working Group report that came out yesterday, and I think you can see in that now governments and regulators understand that this is at a scale, it's serious, and if it's not managed well, then it will accelerate incredibly rapidly. And I think this is not at an individual jurisdictional level, right? This is at a global level. So I think it's good that governments and regulators are paying attention to this. It is moving very fast, and we want payment rails that are safe and secure, can handle high-value transactions in real time. And when you have that, that really unlocks what we need to do true DVP and DVD of security and payment exchange in real time. And then that you will see a transformation that we haven't seen in a long time.
Charles.
No, I'm actually just enjoying everybody else's comments, Linda. So I would completely agree with the perspectives from Michaela and Anthony. Though I think that the issue of atomic settlement is one that is very close to our hearts currently, and I think all of us will welcome progress in that space.
Yeah, I would just add, Linda, that let's just remember that the core of the financial system is something that we hold very dear for its stability. And that has to be front of mind as we make any kind of transition.
Yes, well, thank you everyone for sharing your insights today. And also many thanks to our audience for tuning in.
Thanks, Linda.
Thank you.
Thank you.
Have a good day.
Great conversations now, and now it's time to turn to the ETF rush and the ever-present regulatory risk and what is in store for the future and what is in store currently as we stand. Todd Goren from Ropar Asset Management Funds joins Anthony Scaramucci, CEO of Skybridge Capital.
Todd,
I'm waiting to get in here.
I think you are. I think you're in, from what I can tell.
Okay,
I can hear you.
Okay, so the host will let me in.
You're looking good, and I can see the
thank
back
you.
of your head as well, so that's even better.
So most importantly, hi everybody. This is Todd Goren. I have the privilege of proposing some questions to Anthony Scaramucci, who has been an incredible crypto advocate and someone who's actually been driving a lot of the work that he did. Actually laid the foundation for the current ETF that is happening with the ProShares. And so I have the privilege of talking to Anthony right now about doing what he's been doing in the space, how he looks at the future, et cetera, et cetera. So I'm going to let him just start by giving a brief overview of how he's looking at the market right now, and then I will ask him some specific questions.
All right. Well, first of all, thank you, and I appreciate everybody joining. And you're giving me a little bit too much credit. I think we were application 7 for an ETF. We weren't quite the first mover, but I think more importantly, about a year ago at this time, after doing extensive research in the realm of cryptocurrencies, Bitcoin specifically, the blockchain generally, and Ethereum, Skybridge, which has been a traditional institutional and individual investor, sort of see myself as a self-proclaimed institutionalist. So not quite Charlie Munger that would think something like Bitcoin would be the worst thing that ever happened to the civilization. I mean, my God, I mean, there's so many things that have happened, but Charlie thinks this is the worst thing. Or Warren Buffett saying that this is rat poison squared. I'm just bringing these people up because these are the people that I deal with as an institutional investor. People in our industry, the blockchain industry, know the word FUD, or the acronym. It stands for fear, uncertainty, and doubt. But what about the fuddy-duddies? What about all of these older men and women in the industry that have decided that they don't want to do the homework on decentralized finance or understand the elements, the mathematical purity of something like Bitcoin or the blockchain, and they're trying to relegate it the way some of the real old-fashioned people were saying that the horseless carriage was just a fad, and they were going to stick with their horse and buggy. So back a year ago, I had a checklist in front of me, Todd, and I basically said if Bitcoin got to 100 million wallets, if I felt comfortable storing hundreds of millions of dollars worth of Bitcoin, and I was comfortable that there would be a regulatory rubric inside the United States that would be open to the notion of accepting Bitcoin either as an intangible asset, which it is now for the IRS, or long-term as a transactionable currency. Those three factors, they seem fairly benign to positive for me. We pulled the trigger on several $100 million of Bitcoin, which thankfully was good timing, better to be lucky than smart. We have over $1 billion in Bitcoin today. And of course, we filed for some of these ETFs. So can I just spend 1 minute on the regulation and then I'll take another question? Is that cool?
Please do. That's
Okay,
actually what we're trying to make sure we
So I wanna just address this for people from a legal point of view. I saw some of the friends of mine, legal beagles that were on the last panel. I went to law school back in the late 80s. I went to Harvard Law School. I'm not one of these guys that says, oh, I went to school in Boston. I'll just tell you that I went to Harvard Law School. Although I will tell you, my blue-collar mom thought it was Hartford Law School, which is still an inside joke inside the family. She was like, why would they name it Hartford Law School if it's not in Hartford? But in any event, I learned 3 things in law school. So the first thing I learned was don't be a lawyer. I mean, that was a pretty obvious thing. I learned that in my first year. The second thing I learned was to avoid lawsuits because they are cataclysmic. You may think you're right, but you're going 50-50 with the jury. But the third thing I learned, which is important for this conversation, is about property rights. And ultimately, whether you like the United States or dislike the United States, there's been one thing that has been a constant, a North Star in the United States, and that is property rights. You can go back to British common law, which dates back almost 1,000 years now, or U.S. law, let's call that 245 years. Property held in the United States is deemed sacrosanct. This is one of the major reasons why institutional investors from around the world, individual investors from around the world feel comfortable buying property, stocks, bonds, other things, putting intellectual
currency and the U.S. dollar.
Yeah, exactly. Putting intellectual assets into the country. And, you know, if you get that and you understand that, then you know that Bitcoin is a representative of property, a result of which it would be almost impossible, dare I say impossible, given the political climate that we're in. I guess anything is possible. But after looking at this legal precedent, I would say that it's virtually impossible for somebody to abrogate your Bitcoin or to take it away from you. I think there would be a huge challenge in the court system. And I think that's important. It's important to put that down as a marker when discussing the regulatory rubric around Bitcoin. They may not like it. They may opine against it. Elizabeth Warren, obviously she's uninformed, so she's really opining against it. But by and large, the people in Washington recognize that if they want the United States to stay the center of the financial world, the capital market center of the globe, they're going to have to accept Bitcoin and other elements of decentralized finance. And so with that, it's anybody's guess when the cash ETF comes. But I'm very happy, and it's a good indication this past month that the SEC allowed for the Bitcoin futures ETF.
Okay, so a couple of different things that I want to cover with you. One is, okay, so there is now a Bitcoin future ETF. When is there going to be a spot Bitcoin ETF? And when is there going to be something other than a Bitcoin ETF? You know, you and I were talking before we got on before we were published. Right now, is that about? It would be so much more interesting to see a basket of cryptocurrencies as an ETF. So please give me your thoughts on that. I think you've been spending a lot of time on it.
Well, here, you know, I mean, these little sticky problems because I have an application filed, and so I've got to be careful about what I say because we're in a little bit of a quiet period. So I'm going to talk generically about the regulation. I think people will get where I'm going. Gary Gensler and his team, they have a tough spot because if you really understand the metrics that they're evaluated for the ETF, pricing manipulation and making sure that there's clarity of pricing is super important. So, for example, you don't see any micro capitalized stocks in the form of an ETF because they're afraid of people being able to run those stocks up or run those stocks down. In the case of Bitcoin, there's really no regulatory rubric around Bitcoin itself right now. However, because Bitcoin futures have been invented, those futures are in fact regulated by the CFTC, which is a organization, a commission that Gary Gensler knows a lot about, having been the chair of it under the Barack Obama administration. So I think that is really good news for us because I think it represents a start. And I think if they can get clarity around pricing and the variabilities of pricing and some surety that those prices can't be manipulated, I think they'd be ready to do that. I'm old enough to remember the whole thalidomide situation, Todd. You're probably not. But there was a morning sickness drug in the 1950s that was approved for women to take in Europe. And the FDA said, whoa, we're going to do more evaluation and more research on it. And unfortunately, the morning sickness drug was effective at combating the nausea, but it caused birth deformities. And the FDA at that time was lauded for delaying the drug. It never got fully approved, and it was eventually banned in Europe. The reason I bring this up is that is roughly the mindset that transfers over into the securities business as well as the health and safety aspect business. Someone could then push back, well, what about the vaccines? I think the vaccines were pushed through as an emergency contingency. They've now proven to be quite efficacious, and they eventually got their non-emergency approval. But but we're a slow-moving regulatory beast here in the United States. But I think those things are happening. I think there's a lot of good news coming.
I mean, so Anthony is a Mets fan. I am a Yankees fan. Sorry. So I'm not that old.
But I think
I'm
we
not
were
that
both.
old.
I think we were both Braves fans last night, though.
Absolutely.
You know,
Anybody
unless
but
you
the
were from
Astros.
Houston, and
Anybody but
unless
the
you're from
Astros.
Houston, you were probably rooting against that team last night. So, you know.
So okay, so just for all transparency, I'm an investor in Anthony's funds, and I think that his new product is actually really interesting for someone who is not a doesn't want to be that adventuresome in far, investing directly in a cryptocurrency. So take 3 or 4 minutes and talk about your ETF that you guys launched at Skybridge, which is basically an equity, a bunch of equities that are crypto enabled. Is that the right way to say it, Anthony?
Yeah, I think what we, again, we're institutionalists. We set up a Bitcoin fund in cooperation with First Trust. We set up a Ethereum fund, and then across our portfolio, we had initial starting of about 4.5% in Bitcoin. Due to appreciation, it's grown to about 18%. And so if you add up all of those, our total holdings of Bitcoin are just over $1 billion, just over, it's just under 1.1 billion at current market prices. But we wanted to create a product where some of the more old-fashioned people could get involved. We're calling it sort of the picks and shovels product, if you will. Companies that are laying the infrastructure and architecture of the world of decentralized finance, companies that are geared towards doing well, if Bitcoin, frankly, is doing well. And it's called the First Trust Skybridge Digital Innovation and Cryptocurrency Portfolio. It doesn't have any crypto in it per se, but we do have a very large position.
Give the example of like Square or
Square.
Square.
We have a large position in Square. We have our 2 largest positions are Coinbase and MicroStrategy. MicroStrategy being a holding company for Bitcoin. We have a reasonable sized position in Marathon Digital Assets, the mining company, Bitfarms, Voyager. Again, you mentioned Square. We have a position there. We also have a position in PayPal. And it's a blend.
What is the percentage right now of Square's revenue that is coming in through cryptocurrency?
Yeah, it's small. I don't have it off the top of my head. I'm going to say it's about 8%. I mean, I could look it up on Google, but it's small.
But it's something like 8%, but it's growing every single day.
Yeah, but I think.
And I remember talking to Michael Dell,
Square
is about what the percentage of Dell computers that were sold using cryptocurrency, and it was a surprisingly large number. I don't know if you've talked to him. I know you guys are friends, but it's over 10% of all Dell sales are in crypto.
Yeah. He brought that up actually in his recent book. I would say to you, the Square is very fascinating to me because they are the Netflix of crypto. So just hear me out for a second. They start out as a credit card processing company. They're optimizing small businesses. They're trying to offer them a lower price than, say, First Data or some of the big behemoths. And they then recognize that they need to move into wallet creation and wallet procurement in the cryptocurrency realm, and specifically for Bitcoin, but eventually for others. And that's sort of a lot like Netflix, starting with the DVD, gravitating to streaming, and now getting into production. And I admire these guys a great deal. I think Jack Dorsey said that he's going to dedicate a large portion of his life, the back end of his life, to Bitcoin and the evolution of Bitcoin. And frankly, you either see it or you don't see it. I think people that are listening to us right now, Todd, probably do see it, or they're on the cusp of seeing it. Otherwise, it wouldn't be at the LA Blockchain Summit. But what is it that we see? We see a massive delayering mechanism for our society, and we see a virtually costless ability to transact with each other peer to peer. And I just want everybody to think about that. You take out the middleman on just about everything, or the middle woman on just about everything. It's massive savings, massive efficiencies. To quote Mark Andreessen, it's even bigger than the Netscape browser that he invented 95 years ago. I want to tell this story quickly, if you don't mind. This is because I said this at lunch today to a group of skeptics that I'm trying to onboard into our ETF, the CRPT ETF. I said, in 1985, as I'm really dating myself now, I'm going to be 58 in January. In 1985, I was waiting in a post office in Rome, and I had to call my mom. Wednesdays was Prince Spaghetti Day. And so, that's when my mother, I had to get the phone call into her to let her know I wasn't smoking pot and I didn't have venereal disease and all the other lies that we tell our parents. And so there I was in the post office buying 5 minutes of time, $3 an hour, $15. I had to convert it into lira. And then they told me to go wait for a phone booth. When I got in the phone booth, the AT&T operator came on and I told my mother all those lies, told her I loved her, the beeping started, and then the call ended. And it was a $15 call for 5 minutes. I've got this phone in front of me right here, this miracle that's eating the world. And you can go to that same cafe area or that same post office in Rome, find the Wi-Fi, make the same call forever if you want to, and it's costless. And I think that's going to happen to finance. That's going to happen to the financial services industry. Now, there's a group of people in the industry that don't like that. Obviously, MasterCard and Visa and American Express, they don't like the fact that that 3% number that's held dear for them for the last 60 years is under threat as a result of the blockchain. But that stuff is coming, Todd. And so you can either pretend it isn't coming and you can, get all cranky about it and sound old, or you can embrace it and own a piece of this stuff in your portfolio.
I mean, of course, you and I are 100% on the same side of the bet here. I mean, we're both crypto advocates and we're both very long crypto, so that's all going to happen. But talking about regulation for a second, Anthony, I know you've talked to Gary against a fair amount, and they didn't actually approve the ProShares ETF. They just didn't disprove it. So, from your perspective, how are we going to look at the future, and how is the SEC going to look at these, especially like a spot price Bitcoin or a spot price Ethereum product?
Yeah. So I want to be clear. I haven't talked to Gary, and primarily because I'm in this quiet period, and you have to be very, very careful.
Sorry, I didn't mean to put you in.
That's okay. No, I just want to make sure that I'm clear so that at least I'm representing it fairly to our viewers and listeners. But here's what I would say. When you say they didn't approve it, they have a chance to block. They have a chance to delay it, which they delayed it. It seemed interminably, and then they have a chance to either approve it or let it go through. And so, or disapprove it, I should say, or let it go through. And so they let it go through. And so that is a major step. I mean, let's just shine a light on that for a second. There's a reason why Bitcoin went from $40,000 into the low 60s while that process was happening. Why people said, oh, wait a minute, this is okay. Because Todd, I am dealing with this demography. I'm dealing with the 60 to 250-year-old person, the person that's still talking to George and Martha Washington. And they don't like it. Okay. But now they have an opportunity to buy it. Okay. Think of the vaccines for a second. There's a lot of people said, I'm not going to take the vaccine until the FDA approves it and it's in the marketplace. Then the FDA approves it. And they've lost that excuse, but now they've got this opening. It's sort of just like that. The acceptance of that ETF was monumental. I don't want to understate that. It gives a license now to institutions around the world. Whoa. The financial services center of the world, and Washington, still the most powerful capital of the world, has decided that they're not going to cede the next century of finance to another player. The United States wants to be involved in the intellectual property, the assets, the infrastructure, the laying of all the cables and architecture to make all of that happen. So what's it going to cost for the cash? The cash is going to be about price discovery. If you can convince the SEC that you can have free and fair trading without any manipulation whatsoever, I think you end up in a situation where you get the ETF approved.
Right.
And I think that's
It's
coming. I think
incredibly
that
liquid. It's incredibly liquid. I mean, you
no, I
look at
understand that.
the
I understand
trading
that. I think
volume.
there's still a fear that there's whales out there that can move the price or can, take prices directionally. I'm not saying that's fair. I'm saying that I think that's a concern. And because these are not clearing on an exchange, right? Stocks clear on an exchange. So therefore the exchange, the orders are coming in, the sell orders and the buy orders, and they're meeting on the exchange. So it's very, very easy to track that data. Bitcoin is way more amorphous. You can track the futures data because it's regulated by the CFTC, but you can't track Bitcoin's data right now. But I think there will come a day where you will be able to track enough of its data. Remember, there's also a proportion test. You remember that from your statistics class in undergraduate school. If you can end up tracking enough of the data where the regulators feel comfortable with it, I think they'll let it go through.
I'll say one thing for sure, and I'm going to flip another question to you. If anyone, everybody on this kind of Zoom, call has all set up a wallet. It is much more difficult, time consuming, and know your customer, much more burdensome than setting up a stock account. So I think that I think that the cryptocurrencies, what you want to call Gemini backed, any Binance, Coinbase, any of these guys, it is so much more of a tight process that it is setting something with Goldman Sachs, your old firm. It is much more difficult, and the fact that people still believe that cryptocurrencies are something that is going to be hacked or something that's to be stolen, and so a bunch of black market stuff is something that we all, everybody that's listening here is on the same page, and it is something that we're going to have to continue to fight, and I think the ETFs are a really good step forward on that. And
yeah, no question. Well, I mean, the other thing I would say, I would encourage everybody to read Mike Morell's white paper. It dispels a lot of the notions, a lot of the myths out there related to black market activity and money laundering. It also explains why, after 13 years, the Bitcoin network has never been hacked, why the blockchain has proven, despite a 12-and-a-half-year assault on the blockchain, to not be hackable. And I think he also explains why something like the Colonial Pipeline transaction, something that I think shocked people, and there's a lot of misinformation about, the FBI was able to get back $2.3 billion worth of Bitcoin. They didn't hack the blockchain. They were able to figure out who the players were that were instigating the ransomware. They got into their servers and got into their emails, at which point they were able to get their passcodes off of their emails. But they never hacked the blockchain. And I think if you follow what's going on, I think the authorities are getting more comfortable, not less comfortable, Todd, with Bitcoin, because you can see the wallets. You can identify
the
a wallet.
transparency is so much stronger than any stock portfolio.
Yes,
I mean,
100%.
Not even close.
But here's the thing. You mentioned a stock portfolio. It may be easier to open the account, and I accept that because there's a lot of safety protocols in place now, places like Coinbase and other places. And it may be easier to open a stock account. But to trade a stock, if I'm going to buy stock that you own, it has to go through 7 different entities, including the Depository Trust Corporation, before it goes from one account to the other. Imagine over the blockchain, we could do a peer-to-peer transaction and we could trade stocks with each other, and we could delayer all of that and all of the costs associated with that. Let me take it to a real visceral level. I use RightGuard. Okay, and if you're interested, I use CoolWave RightGuard, and I have a tremendous volume of it at the house. Where do I buy my RightGuard? I actually buy my RightGuard from Amazon. Why? Amazon is a third-party trusted vendor. I'm confident that I'm going to get real right guard, which is being produced by Procter & Gamble and sent to Amazon. And I pay Amazon a fee, and they obviously take something from Procter & Gamble, or they mark it up to send it to me. But just imagine now, and there's all costs associated with that, but just imagine over the blockchain, the transactions are costless, and I buy my deodorant directly from Procter & Gamble. And just imagine that fulfillment happens because over the blockchain, even though they don't know who I am, because we're operating on the blockchain, they totally trust me. This is a software mechanism that's designed to allow two parties that may or may not necessarily trust each other to transact with each other as if they're trusted best friends and best buddies. And so all of a sudden, this big third party known as Amazon has been taken out of the equation. I can deal directly with Procter & Gamble. Well, you're not buying in bulk, Anthony. Well, that's true, but why do they care? Because these transactions now are costless over the internet, the same way I can make that Wi-Fi call from Rome to my mom 35 years after the $15 call. So this stuff is so revolutionary, and it is so important to explain it to people in a way that they can understand it, so that you can force their curiosity. You can light a fire of their intellectual curiosity so they get started on learning about it, and then learning about the potentiality of all the different applications.
I mean, Anthony, my personal experience, my father is in his 80s, and, explaining to him about blockchain and cryptocurrency is the most important thing that I can do, because if I can explain it to him and he can understand it and he can support it, then I can explain it to someone who's 25. And I think that
Totally right. I mean, I totally agree with you.
So think about, so maybe we talk for a second about like centralized versus decentralized blockchain protocols. I mean, do you have any thoughts about that and how that will be regulated, and how we can kind of promote publicly traded ETFs kind of thing on that perspective?
Yeah. Well, listen, I mean, I think the first thing, the big ones are going to have to go first. So Bitcoins and Ethereum are going to have to go first. I think that you talk about centralized versus decentralized, there's some layer one protocols that are solving for the trilemma, so something like Algorand, you've heard me speak about it. Obviously, I spoke a lot about it at the SALT conference.
Yep.
I have met with Silvio Micali, the inventor, the Turing Award winner from MIT, the MIT mathematician and computer programmer. Algorand to me is a very special technical property. It's solving for decentralization. It has a negative carbon footprint. It's Sharia compliant. Its transactions per second are at the high end of the layer ones, and it's unbreakable. Silvio once said to me, I said, well, how hackable is Algorand? He said, well, I want you to imagine every second that has been created since the beginning, the Big Bang, over that 15 billion years, every second. Okay. And then it's probably more than that to one. That's
Right.
the likelihood of it being hacked. And so to me, I think that those are really good. I think they're good future profiles, and they're good future footprints for a lot of digital applications. Could they end up as ETFs? Could they end up as, could they end up in people's funds? I believe that they will be. I'm concerned about the centralization. There's some coins that are overly centralized, which could augur for inflation or some levels of manipulation. And so I am concerned about those, but not things like Algorand or Bitcoin.
Right, but going on one of the things, I mean, I'm an investor, an angel investor in Casper, and it's 1/1,000,000th of the energy that Bitcoin uses, right?
Mm-hmm.
So Ethereum is 1/1000th of Bitcoin, and Casper is 1/1000th of Ethereum. And so, how do you think about looking at kind of like a smart contract wrapper on something like a green Bitcoin or like a green carbon credit or anything like that. How do you look at that as like maybe you could do an ETF on that? Maybe we could
let's talk about Casper for a second. Because I was with one of your partners in Abu Dhabi last week talking about Casper, and I think for Casper is got amazing technical properties. What Casper needs more of is a robust community and a robust expansion of that community. Now, Anatoly and the guys at Solana were very successful at that. They got some sponsorship from FTX and Serum, the exchange related to Solana, and that led to this sort of explosion of their community. If Casper can get that, Algorand's community is growing, albeit slower right now than Solana, but as people discover Algorand, it could hockey stick past all these things. Casper has that potentiality, but its rate limiting step is, in my mind, is the community. You got to get more people doing more homework on Casper.
Thank you for saying that. It's also, obviously, I'm a huge proponent of Casper. It was my one choice in private.
No, I looked at it. I looked at it pretty carefully after your partner from Abu Dhabi had raised it with me. And listen, I'm not a Bitcoin evangelist, and people get mad at me that are purists in Bitcoin. I don't think Jesus and Moses had a baby and then they named the baby Bitcoin. That's not me. Okay, I'm a Bitcoin investor. I see the value of Bitcoin. I see it as digital property. I see it as something that you'll be remiss years from now if you didn't make a decision to own some of it, because you're going to end up, there's going to be plenty of use cases for it. And as we continue to corrupt fiat currency, I think it will be an anchor for a lot of investors for many decades to come. And so a result of which I want people to be invested. Now, I'm not telling them to be 100%, put 100% of your money in Bitcoin, anything like that. I'm a rationalist and I'm building a portfolio for people. So is this a 1%, 3%, or 5% exposure for people? Yes. But let me tell you something, Todd. I put a 5% position on, or 4.5% position. It grew to 18%. Now you have this intellectual.
Exactly. I'm in the same boat.
So now you have this dilemma.
3% position that became a 20%.
I'm taking calls from my institutional investors. Well, wait, hold on a second. You got 20% exposure to Bitcoin. Okay, but I had a 4% exposure that grew to 20%. So what do you want me to do? In the immortal words of Warren Buffett, he said, geez, I'm not going to shoot Michael Jordan or trade Michael Jordan for 4 scrubs and then call that diversification. Bitcoin has some amazing fundamental things going on right now. The wallets are scaling. There's only about 18-ish million Bitcoins. Several million coins were lost in its early inception days. There's a million or so out there that has to be mined. JP Morgan, Todd, says that there's 49 million millionaires. There's probably 18 million Bitcoins. We don't even have enough Bitcoins for every
Dimon says that Bitcoin's worthless. So we don't agree with him.
Yeah, well. You see, this is the thing, and I have an enormous amount of respect for Jamie Dimon.
Me too.
And I'll stipulate here in front of everybody that he's way smarter than me, and he's got great experience. He did a wonderful job navigating that bank through the pandemic. But here's what I would say: he's either frustrated by it because it's an assault on that beautifully moated company, that castle that he's sitting in, or he's not doing enough homework. I can tell you this, Todd, people that do the homework, that would include Ray Dalio, that would include Stan Druckenmiller, Paul Tudor Jones, Steve Cohen, Dan Loeb, anybody that's done the homework and put the time in, they end up owning some Bitcoin.
I don't know if you had the same experience as I did, but yeah, I was on a private board of the biggest THC cannabis company in the United States. And I got thrown off the Fidelity platform. And I bet when you were doing like Internet 1.0, that kind of similar thing happened to you.
Yeah, I mean, listen, I'm having the problem right now. I have a lot of retail clients that are affiliated with some of these very large financial institutions. And they're vexed because they They don't want to be made stupid. You know, you make decisions sometimes in life not to get fired as opposed to creating value. You know, I like to tell people I'm an entrepreneur. I'm about creating jobs, not preserving my own. You know,
Anthony,
but
you're
there
100%
are
entrepreneur.
bureaucrats
No one
out
ever
there that
argue
are into
that.
preserving their own job. And so one of the way you preserve your own job is not to look stupid. Imagine if I buy Bitcoin at 60,000 and it goes to 10,000. And then there's guys like Warren Buffett and Charlie Munger saying, see, I told you so. There's a lot of people in the institutional community cannot deal with that potentiality. And so, a result of which they'll stay away from it. You know, I got to tell one more story. I'm sure we'll probably run out of time, but I got to tell this story.
We got about 3 minutes.
All right, so this will be a 2-minute story, then we can wrap up. I'm at the Sun Valley conference, Sun Valley, Idaho, Alon and Company conference. There's a guy by the name of Jeff Bezos making a presentation. This is 23 years ago. He's a contemporary of mine. He's probably 34. I think the company just came public. And he's laying out the case for it. He's saying, you know, we're not an internet bookseller. I just sold books so I can get used to the logistics. You know, they're easy. You know, this is going to be an everything store. I'm going to sell everything and I'm scaling. But the bad news is I'm going to lose money for 10 years. But I'm creating this Metcalfe's Law network effect, and we're going to become the retail network, if you will, for the internet. And so then Mr. Buffett came on right after him and gave a speech. I said, yeah, that's great. And Jeff seems like a very nice young man, but I'm not buying a share. Okay. And let me tell you why I'm not buying a share. This thing has a market cap larger than Sears Roebuck, which at that time was one of the largest retailers in the US. And, you know, it has no earnings. So forget it. I'm not buying any of it. And I'll just point out to everybody, of course, I didn't buy any of it because I was listening to Mr. Buffett. And I'll just point out to everybody that a $10,000 investment in Jeff's IPO of Amazon is now worth $22 million today. Now, you would have been subjected to 8 periods of time where you lost at least 50% of your money, 1 period of time where it went down 85%. But last time I checked, Jeff is shooting himself into space in his own rocket, Todd. Okay, he's bringing Captain
exactly what you're
Kirk with
saying
him.
is the same thing about Bitcoin, right? I mean, it's the same thing.
So that I missed Amazon. I've told my clients, you want to miss Bitcoin? Fine. I am not missing the biggest technological advancement in money in the last 5,000 years. You want to miss it, and you want to blah, 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 and, you know, fuddy-duddy, and, you know, talk like you have chronic back pain. That's fine. I am not missing it. And I just wanted to get that out there before our time elapsed.
Right, but Anthony, we're counting on guys like you to actually create vehicles so that the institutions can actually invest in this stuff without, you know, worrying about spot price of Bitcoin or spot price of Ethereum or Tether or stablecoin, whatever. I mean, the panel before us was talking about, you know, how stablecoin works. You know, stablecoin is I mean, sorry, excuse my language, it's for fucking pussies. You know, I mean, that is a vehicle to trade. It's not a vehicle to invest. And guys like you need to lead the charge.
Listen, I'm certainly trying. I mean, I would tell people you can buy CRPT, which is the First Trust Skybridge Digital Innovation Fund. We priced it at $18.90. It's up about 30% since the pricing, direct result of the appreciation of Bitcoin. You can buy it on the New York Stock Exchange, CRPT. It's a proxy effectively for Bitcoin if you look at the regression analysis. I'm hoping that we'll eventually have ETFs that are approved. I'm not in love with the futures ETF, so we never filed for one. But we do have a cash ETF that we file. I'll keep my fingers crossed and leave it up to the regulators to make that decision. But yeah, we're in the process of building product, and we're in the process of proselytizing what is happening, because I think it's important to let our clients know. And here's the thing, Todd. I want clients to at least understand it enough where it lights an intellectual curiosity, a fire rumbles inside them where they got to get to know it. And then if they decide after they've learned about it that they hate it or they don't want to be involved with it, that's fine. but I don't want them
after
to
they've done with their
flip.
money. It's fine.
Yeah, I don't want them
Anthony,
to flip
we're getting killed here.
Thank you, bro.
Apparently, my language is not great. And but you're the one that's supposed to be the
I'm supposed to be the profane one, but you know, I'm on my best. I'm on my best behavior in a situation like this.
And you're very well dressed, and I love it. Thank you very much for spending this time with me. And hopefully, people learned something. If they didn't, then it's my fault and not yours. But thank you very much, Anthony.
I appreciate it, my friend. Thank you.
See you, buddy.
Bye-bye.
Some great conversations there. A huge thank you to our speakers. Now, coming up next, we're going to gain an insight into the future of trust and transparency in the cryptocurrency space in a discussion led by Cointelegraph's Asia editor and chief Tia Peng. Following that discussion will be TradeStation's Crypto's James Putra and his panel of industry experts who will explore the wants but also the needs of the next wave of digital investors.
Hi, everyone. Thank you, Jessica, for the introduction, and thank you, LA Blockchain Summit, for another invitation. It's great to be back. And hi, everyone. I'm your moderator for today's panel. With the invention of different cryptocurrencies after Bitcoin and possible mainstream adoption heading crypto's way, we see more services provider joining the crypto environment, and also regulators are trying to understand this space and setting up a regulatory framework around it. And questions such as, does my service provider actually hold my assets become even more interesting in the crypto environment? So here we are having great panelists with research in digital identity, taxation, and law backgrounds to share their thoughts and expertise on how and where the future trust and transparency of crypto is heading to. And before we start our questions, I'd like our panelists here to introduce yourself and of who you are and your background. That'd be great. Chris, would you like to start first?
Yeah, sure. Chris Harding. I'm with Civic. We are a identity solution provider in the crypto industry. My background is I was an auditor for a very long time. I was KPMG for probably about 12 years. So this is a topic that's very familiar to me.
Great, thank you. And Celine, hi. Hello. I don't think I can hear you. Maybe we can go back to you later on. Toby, would you like to go ahead?
Yeah, great. Thanks, Ting. Hi, Tobin McComas. I am with the Chamber of Digital Commerce. We are a trade association with the mandate of serving the blockchain and crypto industry with all things regulatory and policy focused in DC. So happy to be here, and thanks for having us part of the conversation.
Cool. Thanks for joining us. And Aaron, hi.
Hi, everybody. Great to be with you today. I'm Aaron Jacob. I work at TaxBit. I head up our ERP solution. TaxBit, we are a technology company providing tax and accounting software for the digital economy. We're serving consumers, governments, and enterprises of all shapes and sizes. So really excited to be here and grateful for the chance to connect.
Cool. Thanks. And Noah, hi. Good to see you again.
Hey, everyone. Noah Buxton. I'm a guy with a background in law and regulation and IT assurance. I'm someone who got pulled down the rabbit hole of Bitcoin in 2016. And so today I consider myself really lucky to be co-founder of the blockchain and digital assets practice here at Armanino, which is a top 25 public accounting firm in the US. And I get to put my passion to work every day now, basically 100% focused on crypto leading a team of subject matter experts that's doing a lot of traditional accounting type work that this space needs, from audit, tax advisory and compliance, through risk assurance and consulting. But also we're building new products for the space. And so I also consider ourselves very lucky today to have earned a reputation as a global leader in digital assets. One of the unique things that we've done here is develop a platform called Trust Explorer. It was actually the world's first real-time audit. So it was a big deal for the assurance and public accounting space, but also was addressed at a stablecoin use case or crypto use case to begin with. So we're very proud of that. Trust Explorer does many things today, but it's actually in real time. I think it's about, I checked earlier today, something like approaching $28 billion worth of crypto assets that we provide real-time assurance over. So we're edging up on 1% of the total crypto market cap now under real-time attest. And again, very proud of that. Happy to be with you all today and talk about another subject we're passionate about here at the firm, which is proof of reserves and advancement, of these new standards of trust and transparency.
Yeah, talk about the new standard of transparency. You mentioned about, there's new regulatory framework coming up and what you guys have done. Also, it's called the proof of reserves. Can you tell us more about what it is and what's the background? How did you come up with this findings?
Sure. Should we let Celine introduce herself, or? Oh, sorry, she dropped off. Yeah, sure. I can go into that. So I think we've got a lot of smart people on the phone that are coming from or on the line that are coming from different angles around this. So it'll be a great conversation. First off, what is proof of reserves? I don't think still that term is widely used in the space. I don't think it's permeated through sort of every corner of the crypto or digital asset space yet. However, it isn't something new. It's actually from 2014. So in its essence, it's a way that exchanges and other service providers or platforms can provide assurance to their customers that they're adequately reserving crypto assets to meet the liabilities that they owe to those customers. So in shorthand, let's say it's a type of audit. It's a newfangled type of audit. And it's actually a cypherpunk idea to begin with. It was originally conceptualized by Greg Maxwell, who's a Bitcoin core developer, and essentially was an idea that he had around preventing the type of losses that were sustained by users of the Mt. Gox exchange. Essentially, Mt. Gox was hacked over a number of 2 times essentially, but at the end of the day was unable, when there was a run on the bank, was unable to make good on the liabilities in Bitcoin that it had to its customers. And so a lot of people lost significant funds. And this was in a time where there's other activity, that was very pronounced. This hasn't gone away today, right? Like there are still issues with fraud, with theft, with improper management of crypto assets, and we see these things in the headlines periodically. So one thing that's interesting about proof of reserves is I can joke around. It was kind of it's like you can think of it as a vaccine against the scourge of improper accounting and improper reserve practices. It's not really a vaccine, of course, but there is this interesting part of proof of reserves. One of the really unique things, if I just told you proof of reserves is a type of audit for exchanges, you might say, why do I care? That sounds like an audit. That doesn't sound very interesting. The truth is that there's a really interesting component of proof of reserves, which allows the customer or the end holder of the liability to participate in this whole process. And so it is kind of like there's a herd immunity, so to speak. Basically, in a proof of reserves process, you can invite this end consumer to come in and check the exchange. They can individually participate in ensuring that their liability was actually counted in this whole process, assets versus liabilities, and they get to count that they were included. And so it's like a herd immunity. If enough people do this in a proof of reserves process, the chance that the exchange has cheated, so to speak, becomes infinitesimally small. And so it's this interesting check on exchanges.
I'm curious to know what's the difference. When Bitcoin was created and it was meant to be a peer-to-peer payment solution without a third party, confirmation. And this is why we say we put our trust in in math we trust, and then now we have all these different other inventions in crypto, and we are talking about we need third party auditing companies to look into what's missing, what's going on, and try to regulate it. Isn't kind of controversial to what crypto was meant to be? And how does this proof of reserve work? Is it also blockchain backed, or how does it work?
Yeah, so to your core question around the ethos of Bitcoin, the original spirit of Bitcoin and its peer-to-peer nature, and doesn't this seem like we're just involving a centralized party? Let's say it's Armanino, a big public accounting firm. Why do we need them in the equation? Wasn't that the whole point? So I get that. And I think we need to be frank about the reality that crypto markets, capital markets now, we're seeing the intersection today, right, of traditional finance and capital markets and this alternative universe of crypto and digital assets. And these things are coming together, right, with the largest institutions in the world starting to place capital, large publicly traded companies starting to place capital in these assets. The truth of the matter is that exchanges are the key on-ramps and off-ramps for fiat assets or other sources of capital to come into the digital asset space. And because they're these key gateways, they by necessity have to custody customers' assets on the way in and the way out. Now, that doesn't mean that you have to keep your coins on the exchange, right? Certainly there's many people who do that. They want to make some trades and they pull everything off the exchange and self-custody. And then you're back in that original sort of Bitcoin peer-to-peer, self-custody mode. And that's great. I mean, I fully support that. I think that the original ethos of the space is important. But the reality is that something between 20 and 40% of the total market cap of digital assets today sits with third-party providers. And it does that because institutions, for instance, almost have to use a third-party custodian or exchange provider. And retail chooses to because, frankly, it's easier. So, and then I can answer the second part of your question, but I'll take a breath. I'm sure there's others that want to jump in on that.
I see Celine, you're back. Can you hear us? You're muted though. Hello, can you hear us? I guess she still cannot, has some kind of audio problem here. So yeah, Chris, would you like to make comments on the question?
Yeah, I think the world of crypto has just grown so significantly beyond the point of its initial inception, which was Bitcoin. And you're absolutely right. Like the core principles to Bitcoin was very, very clear in its peer-to-peer nature. I just think the industry has grown so substantially and so many different players have come in that every time somebody new comes in, there's an element of trust that we need to be able to assign to those players. And without, I think, enough control or transparency as to how those trusted parties operate, I think it's always going to be the Wild West, right? I think the industry is kind of slowly growing up to the idea that regulation is absolutely needed, and there's a lot of good to be had by sensible regulation that doesn't necessarily impede innovation, but that does aid in kind of this trust element that we're talking about, right? And help enhance the transparency of how things happen within the industry. And all of that, in my mind, is leading to wider adoption, right? So if your core belief is that this is going to be somewhere and we want to take this to the massive and we want people to use this, people that are not necessarily digitally native or happy to engage with technology that is foreign to them or new, and they don't want to necessarily go through the learning curve of getting up to speed of how to manage my own wallets and how to do transfers, and what if I accidentally send it to the wrong account number or onto the wrong chain and I lose my money. There's a lot of risk in that, right? In the traditional design of things, right? So the more we can add protection for people and the more we can add transparency, I think all of that just adds on to wider adoption, which I think benefits the industry way more than than us not taking those steps.
I see. So you believe with a regulatory framework, it's going to help the mainstream adoption in expedite it?
I do. I think, look, currently when you're engaging with any crypto product, right, what is your go-to for you to decide whether or not you want to invest in that project, right? So say you want to buy tokens for a new project that's just coming onto the market, right? You go read the white paper, you look at their website, you try and figure out what the tokenomics is of the project to kind of guess if it makes sense. But none of that information that's available to you to research, to assess the risk that you're taking in that investment is anywhere is in a regulated or concise format. Like every single thing that you read is unique in its nature, right? It probably comes from the project team, so they're heavily incentivized to make the project look way more rosy than what it might be, right? So all of that inherently translates to risk to the investor. And the more we can kind of like get closer to a place where there's transparency and rules, we can get to a space where wider adoption is encouraged because people understand the risk that they're taking. And to me, I'm a risk guy, right? So I'm all about understanding what risk I'm taking, right? I think most people that's early on in crypto has kind of gotten used to the idea of, well, it's okay, I'm taking a little bit of extra risk because the returns are so handsome. But I do think it's not going to continue that way, right? The returns are gonna start dropping off pretty soon. So I think we need to evolve as the industry evolves and as regulation evolves.
I see. And how does the identity fit into the regulatory framework?
Yeah, I think that's a very good question. Look, I think it's core to regulatory framework. If you look at the FATF guidance that just came out this week, right? It looks very similar to the traditional way of doing things, right? Which is back to the core principle of understand who the individual is that you're dealing with, or understand who the institution is that you're dealing with, right? So those are the core kind of like components to FATF guidance, right? I don't think we're moving away from that traditional way of doing things, at least in a regulatory framework, unless we can come up with a proven solution that can replace that model, right? I think we'll always sit in a space where regulators would kind of default to the thing that they know and the thing that's proven to work, probably not perfectly. Well, I know not perfectly, but at least it's something, right? And until we can come up with a better solution, I think identity will always be core. Now, that said, I do think we are making significant advancements in how we deal with identity and privacy, specifically in the crypto and kind of the Web3 world, right? And I'm not talking about scanning eyeballs with orbs. I'll leave that one for a different debate. But we are taking steps, and this is not a plug, but I'll just tell you what we are doing from a civic standpoint, right? So because we believe so firmly in this concept of trust and transparency, we are offering a free service to NFT founders who wants to come to Civic and have their identity verified by us, right? So we would go through your kind of traditional KYC steps, verify who the individuals are, that's the founders of the NFT project. We would verify that they truly own the web domain that they're selling these NFTs on. They own the Twitter handle that they do all the marketing on. We do sanctions checks, all of these traditional things. And then we communicate out to the NFT community that we verified these founders, implementing some trust around the project, because now it's not completely anonymous, unknown individuals. At least somebody knows who they are and has done some due diligence around the project, right? So we're kind of instilling trust through this identity verification process that we're doing, while at the same time ensuring that the founders can remain pseudonymous on Twitter or completely anonymous, right? So that's kind of, in a way, we're providing a service, but still protecting the privacy of those founders and those teams that don't necessarily want to be known out in the wider world.
Yeah,
So
Chris, that's really interesting. I mean, anonymity is obviously at the ethos of what we're talking about, but counterparty risk is a real thing. And so, that was really the inception of trusted third parties in capital markets to eliminate that. So it sounds like you guys have a really strong solution, which allows for the anonymity, but also significantly reduces or maybe even eliminates that counterparty risk.
That's absolutely right. And we look at identity as a sliding scale, right? So we're building kind of the Lego piece, the identity Lego piece, to plug into the Web3 world, right? In a way where projects can decide how much of their private information do they want to give out, right? So you can go all the way from giving no information out, and we can verify that, yes, you are a human being through very interesting technological ways, right? All the way to something that's going to be compliant with regulation as we know it today, right? So for us, it's a very, very broad spectrum. And I do think we'll continue to see more and more companies in this space innovate. And hopefully as we innovate and as we prove that these solutions are useful, that these solutions starts kind of overtaking the traditional way of doing things, right? But I don't think it's going to be a complete replacement of the traditional system. I think it's going to have to happen in sections as is proven. We'll be able to kind of like replace the traditional way of doing things.
And how would you think this identity solution can linking into the traditional like taxation part? Because we cannot avoid talking about anything without the taxation when it comes to regulation. So Aaron, I guess that question goes to you, and how complex it is to look at the crypto regulation for taxation here.
Yeah, no, it's a great question. Thanks for asking. It's great to share the stage here and appreciate hearing your thoughts, Noah and Chris and Tobin. So it's a good question. Identity verification is very important when it comes to taxes. And if you caught me with a big smile on my face earlier, it's because I saw a ping from a colleague with some customer feedback that said, I hate taxes, but I love TaxBit. And, that sentiment is, one that most of us share. Taxes are complicated. And, the tax code, it's thousands of pages long. And so things do get very complicated very quickly. And that is certainly the case in the area of cryptocurrency. What's interesting is when it comes to cryptocurrency for tax purposes, it's really crypto property, where you're required to track the cost basis or your entry point to these assets, and then track all of your trading activity. Compare your cost basis with sales proceeds for trading activity, whether it's an actual sale into fiat of those assets or it's trading from one cryptocurrency or one crypto to another. You have to track those events and use them to determine your realized gains and losses at the end of the day. So it does become very complicated, particularly as the volumes and activity become increasingly higher. We have to do it for every single lot. Every time you enter into a new digital asset, you've got to track those things. So doing it at scale actually becomes very complicated, and it becomes very complicated very fast. So one of the things that companies do and individuals do is use tools that are available to folks. And there are good tools that are out there to automate a lot of that tracking. One of the things that makes things increasingly more complicated, despite volumes, is when you're doing cross-platform transfers. You think about if I buy tokens on a certain platform and then I transfer them to a different platform, how does that second platform know the cost basis or know what I paid for the asset on the first platform? And the answer is right now, in most cases, they don't. And it falls on you as an individual to be able to to consolidate all of your trading activity, track your cost bases, even when it's across platforms, and be able to report appropriately on the ultimate realized gains and losses at the end of the day. This is something that many of us have experienced. I do a lot of my purchasing on Coinbase, but then I transfer to various other platforms for various reasons. And being able to track all that information is a challenge. So taxes, it's probably not anybody's favorite topic, but it's a really critical part of the solution, the infrastructure and ecosystem to help the digital asset community continue to thrive.
Do people actually filing for tax in America?
100% they do. This is actually getting an increasing amount of attention right now from regulators, including the IRS. For those of you who are in the crypto space, you know full well that last year on literally the front page of the 1040, you were asked a question if you had any cryptocurrency activity during the year. It's on the front page of your tax return. And that's highlighting and it's messaging to all of us how serious regulators and the IRS are taking this. And, they are educating themselves and they're looking at tools that are available themselves to be able to make processes more efficient. And so each of us also need to make sure that we're taking advantage of those same things and so that we can be accurate and we can, stay on solid footing, keep ourselves out of trouble. A couple of other interesting things that are happening. Many exchanges right now, they're providing 1099s to their customers. And for those that are new to this, a 1099 is essentially a report that shares your trading activity and the results of that trading activity for your digital asset activity. So it's going to show the proceeds, it's going to show your cost basis and the resulting gains and losses that you then can report on your own individual tax returns. So, this is, companies are doing this, exchanges are doing this in anticipation of that becoming a requirement at some point in the near future. This was one of the highest debated areas in the infrastructure bill that was passed in the Senate just a few months ago. So it's getting a lot of attention. Certainly people are and should be filing, including that in their filings, their annual tax returns. And regulators are paying really close attention to it. So it's important that we take it seriously and we, fill our part as good stewards in the community.
Good information to know. And Noah, I saw that you wanted to make some comments here too.
Oh, I might have come off mute. Yeah, to build on what Aaron was saying too. I think all that was obviously spot on. There's these emerging areas too. I feel like the gap between where IRS has been clear with consumers or taxpayers and where the market is just continues to grow, and it's really problematic. So, as Aaron I'm sure does, we hear from clients very frequently, right? And the emerging topics are DeFi. So some of what Aaron explained around like tracking this activity, right? These trades, what's the basis for the trade? When were you in and out and what different coins? What did you do between exchange accounts? A lot of that, you have the benefit of getting data from the centralized exchange, right? Through an API, usually, sort of hook up TaxBit, download your information. You're going to get like some 1040, a 1040 form or a taxable gain.
Yeah.
What about when you layer on?
Yeah, that's right.
Yeah. What about when you layer on decentralized finance where you've made trades on a DEX and there's no inherent pricing in that trade on chain? There's no information around the basis of that asset. Those things become really complicated. So I know like TaxBit and smart people in the space are solving for this. But again, the space is running away. You've got IRS I think one of the most recent things I've seen that's concrete is they announced that in 2017, the hard fork from Bitcoin to Bitcoin Cash was indeed a taxable event that created income or imputed income to those who, got the benefits of that fork, the BCH that they received. I think that's, wow, groundbreaking, right? Maybe I'm going further and being a little bit more ostentatious than Aaron can, but to me, that's pretty frustrating, right? Because as someone who's trying to give clients good advice in the industry, that is just woefully behind, right? We all knew that was income. We came up with that long ago. We didn't know it was black and white concrete treatment, but that was obviously what it was. And again, now we've got DeFi, now we've got NFTs, we've got staking rewards. These things, create incredibly complex data problems, frankly, and then those are also tax problems. So yeah,
You're hitting the nail on the head, Noah. It's something that we hear from customers all the time. I've got DeFi activity. I'm now entering into liquidity pooling. I'm staking my assets. All of these things that are happening in the industry, and the industry is moving incredibly quickly right now. We need to be able to react to it. So certainly us at TaxBit, we're running really, really quickly to be able to support all of our customers' needs from a tax perspective, because there are questions that pop up, and being able to track income for staking rewards, then being able to track what are my realized gains and losses on trading activity, regardless of the platform or protocol that's coming from, becomes really important. What is also interesting to me is you think about taxes, and for so many people, taxes is very reactionary, where it's kind of like I go to the hospital, I have a procedure done, and then I spend the next 3 months just like waiting in anticipation of when the bill's going to come. And I never really know what I'm going to pay and what my obligations will be. And sometimes taxes can feel the same way. I'm waiting until March and April. I give all my paperwork to my accountant, or I use some kind of tax provider preparing software, and I'm just waiting for what that number is. And I don't really know, and it's a little bit scary. Well, what's interesting in the digital asset space, we're helping people be more strategic about their taxes. You can harvest losses, for example. They can put you in a very different tax position. They can put you in a more beneficial and more advantageous tax position than you otherwise would be in. So one of the things that we often share with our customers is think strategically. Don't feel like you're in that hospital situation where you just have to sit back and recover and wait for the bills to come. You can actually be a little bit more proactive on your part by leveraging technology providers that are out there, and be strategic in the decisions that you're making, so that you can track in real time what your tax bill will be at the end of the year, and make decisions today rather than thinking about it in March next year when it's too late to make those decisions for the most part. Think about that today and be strategic today, so that you can drive what your ultimate outcome will be next year when you're filing your taxes.
Well, Aaron, Noah, this all sounds great. I'm glad we have people like you guys working on this stuff. I recently bought a house and I had to do source of funds, and some of my source of funds were crypto source of funds, and just to go through that process, that was another example of where we need some guidelines and guardrails and some just something to point to say, okay, these are reasonable things to expect individuals to be investing their money in, right? So banks should be accepting these proof of funds or source of funds as valid proof. Like they wouldn't even accept Coinbase documents. And I'm like, this is a public company, so we've got a long way to go. But yeah, as I said, it's good to see you guys working on this interest. Not so fun stuff, right? But very important.
Hey, we think it's fun. Real quick, Ting, I wondered can I draw us and the audience back to this idea. You use this word regulatory framework, or this phrase regulatory framework, a couple times in relation to proof of reserves. So we're going away from taxes and identity back to proof of reserves real quick. And so I wanted to kind of address that, because I think it's interesting. There's a lot to say on regulatory framework. Mm-hmm. We've seen the infrastructure bill was mentioned. We've seen the president's working group on stablecoins just dropped yesterday, I think it was. I would think of proof of reserves actually more as a self-regulatory measure right now. So just to be clear for the audience, this proof of reserves idea, again, is cypherpunk in 2014, varying levels of acceptance in the industry. There's a couple of big crypto exchanges that are doing this today, but not at super high frequency. We've started to do this with a couple of clients in a unique way, and we're pushing for more traction around this because we think we've got a neat method around it. But ultimately, I think it's a self-regulatory measure. It's not currently enshrined in anything other than, well, actually two places where you see proof of reserves. You see it in the Wyoming special depository institution, essentially state banking charter requirements. So that's essentially being a fully reserved bank with a state charter, and you also see it embedded in the New York BIT license requirements for money transmitters that deal in crypto or virtual assets, virtual currencies, as they say, in New York State. So it's sort of enshrined there, but otherwise it's a self-regulatory thing. And I think that one of the reasons it should be a self-regulatory measure in my mind is that I guess one way to think about it is like the infrastructure of trust and transparency, I'll say, that we all rely on in our daily lives and that we probably grew up relying on without thinking much about it. It's all subterranean now, right? It's all the pipes and the sewer and the power lines that we don't even see, we don't even think about. But ultimately, yeah, we trust our bank. We trust what my banking application tells me is my balance. We place a lot of credibility in that. But why do we do that? We do that because there are regulatory frameworks. There are standards and methods, of audit reporting, for instance, is a big one. And there are regulators that place varying levels of oversight over the financial markets. And so, but the crypto markets don't have that today. They've got sort of like, I don't know, the analogies. They've got some things underground, but it's not a robust infrastructure that people can rely on. And so Chris made some of those points, but ultimately, if we believe that digital assets can be better financial instruments, we believe that they are better stores of value, they are better ways of communicating value or transferring, and maybe ultimately they might even be a unit of account, then shouldn't we, as participants, put energy into like actually doing it better, right? So, and one more example. So regulators today, if you're a crypto exchange, a lending provider, et cetera, in the US, mostly what you have to do is comply with a varying patchwork of state money transmission laws. The end result of these regulations is actually really ineffective. Like, sorry to tell you, state regulators, I'll be the first to tell you, the annual financial statement audit and the varying levels of IT compliance and maybe a capital reserve requirement, you're not doing a great job for protecting consumers when it comes to digital assets. You're just not. Why is that? One of the big areas is crypto custody. You may be holding hundreds of millions, if not billions of dollars worth of bearer-like customer assets without potentially some exchanges like Gemini have a self-insurance or reinsurance program. Others, there's varying levels of insurance. There's no FDIC layer. So yeah, consumers are exposed, frankly, but the state regulations are not meeting the measure right now. Could they meet the measure better with something like proof of reserves done in a frequent cadence and reported to state authorities? Yeah, they really could. That would be a lot better. So anyway, that's my spiel on that regulatory framework. But
I think you're absolutely right. I think there's an evolution needed as well within the crypto industry on this topic, right? I think you hear guys like Gary Gensler and Senator Elizabeth Warren talking about investor protection, and it feels to me that the general response in the crypto industry is an eye roll and is like, oh, stay away from our industry, don't get in here. I don't think they're wrong. I think we do need to implement controls and safeguards that's going to keep people's money safe. But to your point, I think at our core as a crypto industry, we are builders, and we need to come up with innovative solutions that we can implement the rails and stuff that sits underground, as you said, that service the industry appropriately, but that also get to investor protection, which is ultimately, I think, what the regulators want to get to. They just don't know what the right answer is to get there, and I think it's up to us to show them what those answers are. Yeah, exactly. So I think you're absolutely right. I think
look at the president's working group identifies one of the top issues, right, is essentially a consumer protection issue on the stablecoin, right? What if there's no sufficient reserves of fiat to meet the token demand, right? All of the token holders want to redeem dollars at the same time. Yep. Their solution or their recommendation is to make everybody a bank. Is that, I don't know, that seems like overkill to me. I think in that case, why aren't other money service businesses and fintech applications also need to be banks. The character is very similar, so yeah, I think that there's more focused measures that can be self-regulatory, that can be much more narrowly tailored, that can allow for the current status quo of money transmission for financial services being okay. But there's also, new things, new tools that the industry and regulators can use to get proper oversight, to get proper compliance, and to get proper protection.
Chris, I really liked what you said there, though, because in essence, I kind of boil it down to, we need to lead from the front, and we need to maintain and partner with regulators and maintain good relationships so that we can influence positively and with integrity, being good stewards of our stakeholders, what's going on and how we can work together. One thing that is interesting, just as we work with the IRS and we work with other regulators, is we sense a real desire to lean in and to do what's best from the industry. And I think in some ways, that maybe hasn't always been the perception from folks in the crypto community. And it's something that we're really encouraged by, is regulators wanting to put common sense things in place that, they don't regulate the industry out of existence, but instead they give it the framework and the structure that's needed to grow and to thrive and to continue along this mainstream adoption curve that is moving very, very quickly. So that's something that we've been really, really encouraged by. And we're trying to do everything that we can to lean into those conversations and be good thought partners and thought leaders in the space.
Yeah, and that's the other positive thing to kind of like start ending this on the positive note for the crypto industry. I've been in this space for a while, but it's been dramatic, that the change in how this crypto industry is willing to accept the notion of being regulated over the past 6 months. Like it's come leaps and bounds, and I feel like we're growing up a little bit, and people are now way more open about opening up the door for regulators to come in to put these rails in place. And that's a very promising thing for me that I look at and point to say there's hope for the industry in the long term. And the more we can get people on board to kind of like slowly get comfortable with this idea, as long as it's reasonable, I think it's going to be a growing industry for a very long time, and we're going to be we're going to all benefit from it. So
Toby, you're back, and
I'm back. Sorry.
Yes, and you're with the Digital Chamber of Commerce, and I wonder what kind of, Chris and Noah and Aaron, we've been talking about taxation, proof of reserves, and identity that can help the future trust and transparency of crypto. But you obviously also have access to other ways that can improve the trust and the transparency. So can you give us more of your insights?
Yeah, no, that's great. Thanks, Tang, and apologies for dropping there. But Chris, Noah, Aaron, they're all doing really, really good work and important work in the space. And we have a unique seat at the chamber where we sit between industry and the policymakers on the Hill and the regulators, whether, again, that's the IRS or FASB or the SEC, CFTC, et cetera. And so to the extent there are opportunities to continue to educate, to enter into, as Chris said, partnerships, and Aaron reiterated as well, partnerships with the regulators, with the policymakers. I think that's how we really move the ball down the field. We're very active, with the IRS, with FASB, with the SEC. Noah was a huge part of our proof of reserves paper earlier this year, which is an excellent read for those of you who are interested. But we continue to have these conversations. We want to continue to support the innovators, as well as the industry as a whole, as we all again try to see the industry grow up. and see the benefits here. I mean, we're talking about, you know, eventual efficiencies here that are significant to the existing systems, but they need to come with those investor protections and with that transparency that the guys have talked about.
Tobin, let me maybe just add one anecdotal thing to what you said. I used to work at the Financial Accounting Standards Board, so I've sat on that side of the table, and I can tell you from firsthand experience that that type of outreach and interaction with the broader stakeholder group is really critical to the process. You know, I remember sitting in conversations where we were talking to investor groups, we were talking to auditor groups, we were talking to preparer groups, genuinely trying to come up with what the best solution for all stakeholder considerations would be. And so my experience, at least working at the Financial Accounting Standards Board, is that there is a real genuine interest and desire to hear from the broader community. And oftentimes outreach efforts are made, and we need to make sure that we answer the call to those outreach efforts, and we're providing the input and the feedback and allowing that collaboration to exist so that answers are you know, created and come to that make the most sense for all industry participants. And it really results in the best outcome. You know, collaboration results in better outcomes than making decisions in isolation and in silos. So that's been my experience in the past. And so I think it's you know, behooves each of us to do our parts to answer the calls for outreach when it's requested, and to be good players and participants, because it really does benefit the industry as a whole.
I'll just plug the chamber real quick too, Aaron. We've been a member as a firm for about 3 years, and if you're involved in crypto, blockchain, digital assets, and you're not also in some way involved with the chamber, you're definitely missing out. The legislative advocacy that's done is, you know, of the highest caliber. The community is amazing. You've got the top law firms, top accounting firms in the world, and their best minds on these calls and working groups. And then, yeah, you've got this, you know, this amazing network to draw from. Lots of like-minded people and very active work. So good stuff.
Thank you. Appreciate that.
Yeah. And just to tie it up, I'll second that, Tobin. Like the paper on proof of reserves, if people haven't read it, it's really interesting, but it's also kind of a proof again how we as an industry can be the builders here and be the designers of our own destiny, right? Looking at new tools, new techniques to kind of service similar outcomes to what we achieve in the traditional system.
Love it. Thank you, guys. I think this is a great discussion, and for me, I do agree that self-regulated framework for the crypto industry might work better than just plugging into all these traditional existing ones and try to fit into the crypto space, because it's much more complex than we anticipated. And so great to hear that the chamber and the regulators are open, allowing the innovation to continue and letting the regulation like frameworks like proof of reserves to help the industry to grow in the long run. So I think it's gonna go like you said, it's gonna stay here, this industry, and we're looking forward to what's gonna happen next. So thank you guys so much for sharing your thoughts, and hope we'll see you again.
Thanks, everybody.
Thanks.
Thank you, everybody.
Great stuff, guys. Thank you, everyone. Bye-bye.
Bye.
Bye.
Up next, we are taking a look at what to expect from the next wave of digital investors. And hosting the conversation, we have James Putra from TradeStation Crypto, Hader Rafke from OKCoin, John Fargo from Luna Crush, Annabelle Huang from Amber Group, and Jake Ryan from Crypto Investing, The Age of Autonomy, and Devin Nepner from Simple.
All right, welcome everybody. We are here today to talk about the next wave of digital investors. It's a panel that I am super excited about. I'm joined with an all-star cast, super knowledgeable from all different areas of the crypto space. So I'm very excited to kick this off, and it's been an exciting day. So let's dive right into it. So why don't we start off with introductions? We'll just go alphabetical. Annabelle, if you can tell us a bit who you are and what problem you're solving, please.
Sure. Hi, everyone. Very glad to be here and be joined by this amazing panel as well. So my name is Annabelle Huang. I'm a managing partner at Amber Group. We're a Asia-based wealth management crypto finance platform. We help our users, clients, both institutional and retail globally, to trade, manage, access crypto, really trying to build the bridge between traditional finance, where our background is, into digital wealth. So that's who we are and the problem we're trying to solve.
Awesome. Thank you, Annabelle. Devin, you're up next.
Hi, my name is Devin Niemer. I'm an investor primarily in real estate and business, but very quickly my crypto portfolio is going to outperform all of them. It's clear as day that I'm not too far from that being the main thing in my net worth. But at the same time, so because of that experience in all of these different bootstrapping businesses and real estate, I learned a lot about leverage for doing all of those things. So when Aave was introduced to me and the ability to borrow against debts, I thought, well, why not borrow?
I think, did we lose John? All right, Haider, maybe you can jump in here.
Yeah, sure. Hi, everyone. So my name is Haider Rafiq. I'm the Chief Marketing Officer here at OKCoin. OKCoin is a global crypto platform. We're based in San Francisco, but we are a distributed team. And what I am looking to solve, particularly with the great team we have here, is bring more people who are crypto curious and essentially on the fence about crypto into our platform and give them a really easy to use experience that is a combination of a CeFi and a DeFi. So we know there's been a lot of demand around DeFi in the last 12 to 18 months, but it's really problematic in terms of signing up for numerous wallets, DEXs, only to get exposure to these high yield protocols. What we're doing is within 1 or 2 clicks, you can enter these protocols directly through our CeFi platform using your bank account, and you get access to these high yields. And we actually remove all the fees, the network fees for you. So you're able to get maximum exposure versus worrying about the initial fees to enter these protocols. Yeah.
Awesome. Super interesting. And John, we can close us out here on this one.
Yeah, sure. Thanks for having me. This is exciting. Great panel. So I'm John Farjo, Chief Product Officer and co-founder of Lunar Crush. We track, all of the social activity across all of the coins and probably a whole bunch of ones that you don't. We really look at the real-time social activity and try and make sense of it all for everyone. I guess you could think of us like if you are looking at, say, your Twitter feed, you're kind of seeing what's going on right now with just a small subset of the crypto community. We track everything, every single mention around every coin. And what we're really after, we're trying to give really the community an ongoing idea of what's going on. Is activity moving up? Is it moving down? Is the community growing? Is it shrinking? I was on another panel yesterday where we talked just about how much it's grown. A year ago, we were 200 and something thousand posts a day, and now we're almost going to hit 2.5 million a day. So activity is growing crazy. It's global. We have users in 213 countries. Most of our team's in California, but we have people in Texas, in Chile, in Costa Rica, in Kenya, and we're growing our team right now. But it's what we do.
Well, that's fantastic. Welcome back, Devin. Sorry you got cut short here. Did you want to add anything before we jump into the firing questions?
Just real quick that we're working on a project called Simple. The main focus of it is as prices dip, buying the dip, right? So as prices dip, you leverage against it, buy more, and then the asset prices go up. You use that to pay down the debt and you acquire more tokens. So basically it's a way of multiplying the quantity of tokens that you have.
Awesome. So as you guys can see, we've got a really talented panel here, from access to wealth management to metrics to really the full spectrum. So my first question, and I'm going to start with John, since you seem to be at this sort of really interesting intersection of the data. Are you seeing any standout adoption trends or themes from this current bull market?
Oh, definitely. So I'd say I'd go back to January 1st, and that was the first day that, if you were on lunarcrush.com, you would have seen Dogecoin went crazy from a social perspective. And then the price didn't fall like it used to fall. Doge used to go up a penny, down a penny. You go up way high, way down, and then it would sit there for 6 months. And all of a sudden, we started seeing some themes happen. And then we started seeing more tokens in the meme space go crazy. And now you're seeing Shiba, you're seeing Flocky, you're seeing Yushi, you're seeing all these things. So that's definitely been a theme. But I'd say on the more recent front, I would look at the metaverse space. Over the last few months, we've seen mentions of metaverse just in general go way higher. And then we have things like Facebook change their name to Meta, and then all the memes follow and all that stuff. I think someone renamed it to Feta, cheese, and all sorts of different names. But we're seeing metaverses go crazy, and that's really an interesting trend that we do not see slowing down. We see that accelerating. I'd say NFTs are massive, and we're going to do so much more in the NFT space. So stay tuned for that. But NFTs are big and going to get way bigger. And I think the other thing that we also see from a trend perspective is just the number of people talking about crypto in general. From a higher level, from the highest point it's ever been, which is now, it's accelerating faster than it's ever accelerated before. And so what we're saying is that I don't want to say that things are going mainstream, because the numbers are still fairly small when you think about it, but the numbers are accelerating. So to say that there's 1 million people talking a day about crypto, those are still small numbers. I could see that going way up, but those are some of the things that we're seeing.
Super interesting. And Haider, are you seeing that at the same type of level of interest? Is it translating to accounts? And do you see any other trends or themes that that stand out to you?
Look, the growth has been phenomenal on our side. We, internally had a goal of 10x growth in 12 months, and I think we lost count after 40x. And thanks to the market momentum, but I think it's also the efforts and the product focus we've had. There are two things that I think I'm observing that are pretty glaringly obvious. One is retail investors on our side are looking for ways to put their crypto to work. And I think these staking and DeFi investing products are becoming more and more popular and in demand. The other thing that's pretty interesting from the institutional side of things is that in the last year, altcoins made up about 53% of the total purchases institutions made on our platform. And that historically hasn't been the case. It's always skewed more towards BTC. So those are the two trends that I think are quite fascinating. I'll wrap it up with, I hope that legacy firms who've been around for a while are part of that innovation. I think if you look at the innovation in the last 12 months, it didn't come from the legacy companies, including ourselves in many cases. I think you look at DeFi, you look at Metaverse, you look at NFTs, look at GameFi. None of this stuff is actually happening on the legacy household brand names that we know of. And what is really important is for us bigger platforms to make sure that we're at the front and center of it, and we're doing it in a way that makes the UX a lot more simpler and easy to go in and out of these markets. So that's in summary what we're observing from the OKCoin platform.
Wow, awesome. I mean, that's super interesting to see to hear about them, and also to see the shift in dominance of trade activity. Annabelle, from your perspective here, are you seeing similar trends? Do you see things that stand out a little bit differently? Tell us.
Yeah, no, I want to echo John and Haider's point. Because for us, we actually sit, we cover a lot of the institutional players as well as retail, and we sit in between Asia and also the Western markets. So just over the last year or, almost 2 years, it's incredible to see the growth. So first on the institutional side, a lot of the traditional hedge funds are onboarding with us, family offices as well, first allocating to Bitcoin. But I think once they get down to the rabbit hole, they actually start looking at DeFi, and a lot of them are buying up crypto punks as well. So they're fully being adopted. So I love to see that. But I think there's still so much more untapped market that could participate in, and I think that's at least that's a trend of what we're seeing. Then on the retail market side, it's actually quite interesting. So I've been on the road for almost a month, and I was in London, Dubai, then went to Russia CS market, Turkey, and now in New York for the NFT conference. So you do see a very different retail sentiment in different countries. I think in Turkey, to some extent, the other developing markets, a lot of them are forced to hold crypto because their own fiat currency is sometimes more volatile and inflation is just simply too high. So they're very focused on remittance or payment and easy on-ramp features, and mostly doing spot trading, kind of buying the Doge and the sheep coins of the world. But in the US, right, it's very focused on DeFi, on NFTs. I think it's because this market had the luxury of having the basic economic infrastructure, and now we're getting to know the more blockchain-based technology and what it can enable. So it's quite fascinating to see the differences here. But I think overall the adoption is coming, especially on the back of NFTs, because it has more cultural and social component. So I think that could be the way towards mass adoption. And here at Amber, that's why we build the institutional platform, and now also porting over to the retail market, hoping to build simple UI UX for anyone to come into the space, whether it's owning your Bitcoin or even just custody your profile, your favorite PFP. So I think the opportunity is massive, and then tied into what the metaverse narrative, right? Then that's again a whole new world.
Very interesting. So I mean, we're talking adoption, DeFi, metaverse, institutional retail, changes in sort of the dynamic volume profiles between Bitcoin dominance out to some of the other altcoins. Devin, take us home here. Tell us about, from your perspective, what's standing out for you.
Yeah, so I could reiterate all the things that you guys said, but I think you guys covered it pretty well. So I think a different approach would be to say I'm an example of someone who was very, very resistant to getting into the crypto market. I did very well in real estate, very well in business, lots of other things. And I had an opportunity to invest.
Devin, we lost you again, man. So that was probably the most important part he was about to tell us too. So we'll give him the CP2s back in.
Oh no!
I just went to the mic on the laptop. Is that better?
We got it. Yeah, you're good.
Okay. So I was resistant. I could have gotten in. A friend of mine wanted, I think, only like 10 grand or something back in like 2011 to mine Bitcoin, and that would have been the best 10 grand I could have ever spent. But I was resistant against it. I looked at it as speculation, it's gambling. I didn't quite understand it. But as time progresses and all the things that you guys talked about, like NFTs, for example. So if someone is into a certain cultural thing, could be basketball, could be whatever, right? That could be the bridge that gets them on. But then once you get on, you don't go off. Because when, like, I send money around the world for various businesses, and there are times when the transaction gets rejected and all start to finish, it takes 3 weeks to send money. You can send it like that in crypto. This is not the panel to educate that. You guys all know that. And just that, when people realize how fast they can get paid, it's amazing. But then you add in all the other stuff like you guys were talking about, and it becomes a one-way street. So as much as I was resisting against it, when I found the thing that connected with me, I'm not into watching sports. I'm not into those things. That's not what appealed to me. But I am into using leverage to gain economically. And so when there was an opportunity to use leverage to gain economically, that's the thing that brought me in. And then once you're in, you do not leave. Once you're in the space, you're in the space. Like there's no going back. The rest of the world does not compare.
So once we have you, you're hooked. So
exactly.
you mentioned some things here which are interesting. So like you had some struggles getting involved, or at least some resistance getting involved. What do you see that are still these big challenges that we need to solve ahead of the next big wave of enthusiasm?
If you're asking me, the answer is the same problems that I have, right? So I looked at it as speculative gambling. And then when you have Shiba Inu and all these other things that are coming up that are meme coins, basically, it just sort of feeds into that narrative that it's gambling. But stable coins have existed. DeFi has started to exist. We've started to build out this ecosystem where if you're going to the bank and you can get 0.24% on your savings, or I'm currently getting about 30% on my stable coins, leveraging an Aave, that is kind of a complex thing, but essentially using a flash loan to max out the reward tokens, but I'm getting 30%. And like, how are you going to compare that to somebody getting 0.24% in their savings account? right? So once you recognize that you can do that, and that's my lowest performing account, by the way, right? So once you realize you can do these kinds of things, how do you go back to the regular world, right? Like you don't. So once you're in, you see, oh my God, this is insane. You don't leave.
Gotcha. So we got to hook you with the excitement. And Haider, you service both markets, retail and institutional here. What are you guys seeing that are these biggest hurdles or challenges that we need to try to break through before the next bull market?
I think there's some fundamentals that still need some innovation. So my personal pet peeve is around wallet addresses. It's the reason why we ended up integrating with Unstoppable Domain. I think that side of the technology still needs work. More browsers need to support it before that thing becomes more usable. But I think wallet addresses is one thing when people are going to transact with each other from one wallet to another, to peer. I just saw a tweet from a gentleman today on Twitter where he said, I lost, $7K because I ended up getting the wallet address wrong. And so I think like that's one big area. The second is, I love the idea of self-custody, but I don't think most of the world is ready for self-custody simply because where the technology is. So this idea that we're going to save our backup phrases is still not, it's pretty archaic. And I'm hoping and hopeful that there will be a better system in place. And I think those are the two things that will make people comfortable because they're just unnecessarily technical.
Yeah, totally makes sense. I mean, everyone in crypto has that white knuckle moment the first time you try to send crypto around. Just hope and pray that it makes it to the space. So you mentioned you saw something on Twitter. John, I got to ask you this question here. Are you, what are the users telling you, or what are you seeing as the next, the biggest challenges that we need to solve before the next bull market?
I think one thing is it's not something we do build. I mean, I could tell you all sorts of answers around this question, but the biggest challenge I think for most is unlearning what they know. And I say that because it's not so much how complicated, say, even starting with Bitcoin and then Ethereum, and then you keep going like most people do. It's more like they know nothing about the US dollar, yet they're in this system. Like most people I talk to don't know about money printing. They just do their daily thing. They do their job. They have a good life. They go home. They have kids. They take them to soccer, and they don't educate themselves on what the Federal Reserve is doing. And so I think that's first and foremost the biggest thing that I see. It's not a crypto problem to solve. It's more of a macro narrative and education issue. So that's the first thing. But I'd say if we're getting specific, it's more around making things easy. When you talk to people that are maybe out of this space and you say, hey, go sign up for this DeFi platform. Okay, what you're actually telling them, you're like, hey, go set up a wallet, add a browser extension. They're going, what is that? Don't lose your password. Oh, you have to go buy some ETH to use it, or you can't participate in that app. Oh, then you have to buy this other token to use that one app on this other exchange that's going to charge you gas fees that are crazy. They're already done. And so I'd say like the UX problem is first and foremost, I should say it's secondary after learning why crypto is important and that the fiat currencies of the world have problems. So I'd say it's more of an education followed by a UX problem. But I'd say another element beyond that is interoperability is a major issue. We locking all these ecosystems are locking users into one chain, and then the user wants to do something over here and they're bridging to 19 different places. They don't even know where their tokens are half the time. And I think that's another issue. Users should never even be exposed to that. They should just use the application and it should just work. So really, I think we have, as an industry of crypto professionals, we should focus on UX and make it as easy as possible to onboard those new people. And that's a really big theme that we see a lot of. Because honestly, the other piece that we also look at, when you look at a lot of these dApps, most of them don't really have a lot of users. And I mean actual users of the application. And I don't mean Twitter followers. I mean, like when you look at transactions on chain and you look at people actually using stuff, and there's these big old marketing messages and these videos and all that stuff. And then you go, wait a second, they have 2,000 users total. And that doesn't work. And that's because it's too complicated.
John, are you teeing this up for me to plug OKCoin?
Yes, OKCoin, the easiest to use crypto exchange ever made. Yeah.
Well, that's what we're all trying to build here, right? Like easy UI. So we here as a more professional or more crypto native platform, we abstract away a lot of the complexities and interacting with different protocols, different blockchains, and give our user what they want, easy to use. And I think it's great that all of us are very dedicated in building that. But I would say another, I think, hurdle for us is unfortunately on the regulatory side. I think we want to do things right, but I think at this point, a lot of the regulators in different markets, different regions are just unsure, unfamiliar with what this is. So I think hopefully in the next year or two, we're able to see a lot more clarity in terms of regulation in major markets as well as in a lot of the regional markets that can let us really be the bridge between traditional finance, be the fiat on-ramp gateway into and port more people into crypto finance and to build the digital wealth. But right now, it's actually quite difficult to be able to offer services that we do. We have probably 20 different licenses going on in different regions, and within the United States, as well as 50 different state licenses. So it's not easy.
Yeah, I always talk about it. Our lawyers have lawyers. It's incredible. I've never been into a place with so many different compliance and legal teams. But I think these are all really interesting. So we talked about UX, talked about education, we talk about interoperability. We've been talking about those for some time, but arguably they've gotten better. We've definitely been able to bring more people in this bull market. 2020, 2021 is a lot different than 2017. I'm very curious to see from those challenges as they start to evolve, where do we find the next 1 billion crypto users from, and what will be important to them? Annabelle, you're on a great roll if you want to lead us into this one.
Yeah, well, I think just piggybacking on what we discussed, right? Once we are able to solve a lot of the UI, UX education and even regulatory issues, then really it's anyone. So next billion or next, the next billion users, it's anyone who want to own their crypto, anyone who want to use it as remittance or payment methods, anyone who want to have their profile picture, NFT profile picture. I think it shouldn't be limited to whoever is actually, I think we are all the early adopters now, and we work through a lot of problems. Used MetaMask for first time years ago and having to worry about that. But now there are going to be a lot of more platforms like what we're building here on this panel to make it easier for them. So I think that's next bull market or next wave of adoption definitely should come from there. And what's important to them, I think it's different for different regions. Like I said, in the US, maybe it is something funkier like the NFT market as part of their social status, social identity, or in Latin America and Turkey and other emerging markets, it could just be that they're replacing their own fiat and really embracing crypto wealth and digital wealth. So yeah, I think it's just super exciting. I think it's up only for us, so we'll see when that time comes.
Sounds like it's an eventuality at this point that this is coming in. So Haider, I'm very curious on your thoughts here. I mean, in your role, you are probably every day thinking about where this is coming from. Where are we going to get the next billion users? What's important to them? What do you guys see? What is in the inner circle?
Look, I'll echo Annabelle's thoughts here. There are three other areas that I want to point out to. One is I think we expect largely this growth is going to come from areas where bank accounts aren't a commonplace. We're going to see more populations like El Salvador where payments haven't been digitized. They'll skip the digital banking system, and which essentially takes 3 business days for a transaction to go through, and they'll go leapfrog directly into decentralized payment systems. So I think that's one area that we're watching really carefully. The second area is, this is my second crypto firm. I was the head of growth at blockchain.com. And there's between these two experiences, one thing is common. There's about 90% male investors and 10% females. This was true at blockchain.com. This is true at okcoin.com. I think the intention to change that is there for us. And what you're going to see in terms of our marketing is we're going to go very deliberately out there and not worry about the Tom Brady's of the world, and try and see how we can bring in more public speakers that inspire women and make them feel that this is not just a crypto bros culture. There is a platform that welcomes them. It's not too late. It's still pretty early. And these are the insights that we're gathering through surveys of what is the resistant points for females to come in. Unfortunately, Annabelle just left. I really wanted her to hear this. And then the third area, I think, is a personal strength of mine. Annabelle, you left at the wrong time. Glad you're back.
No, I wanted to say I strongly echo that. And even just look at, not even on an investor's point or user point, and just for the pure number of women that are in this industry. I came from a math background, finance background, and kind of used to this ratio. But here in crypto, it's, I think, even worse, especially in terms of like leading female or thought leaders in the space. And I think that probably is what's lacking. I think we need more female within the industry speaking and appearing publicly. That'll encourage more, I think, female users to come join the space. And it might seem crazy, but it's not. Like Devin said, once you're in, you're in.
And I think from our side, we are excited. We're going to be announcing 2 public figures who are going to be females, who are inspirational to not just women, but also to men. And look, I think this is in the backdrop of OKCoin, where the CEO is the only female CEO of a global crypto platform, Hong Fang. And so I think that's one area where our personal appetite to bring in part of the billion users, from inspiring more women to come in and feel like this is not a crypto bros culture. It's not an echo chamber. There is a platform for them and such. And then the third area I'll quickly wrap up with is a position of strength that I think is missing in crypto industry. So if you look at fintech brands, if you look at big consumer brands, they do amazing storytelling. And I think with crypto platforms or crypto in general, what we've done is build phenomenal technologies and created these amazing ecosystems, but we've failed. And I'll say that very directly. I think we've failed at really amazing human storytelling. And I think what you can expect from OKCoin is we're going to do just that. We're going to invest in that. And our hope is that we can inspire a really broad spectrum of people to look at our work and draw some inspiration and get those emotional cues that help people understand the utility, the urgency, and the fact that there is an alternative choice now to the traditional financial system. So that's, in a long nutshell, that's our hope of bringing the next, or at least impacting the journey towards the next billion crypto users.
That's awesome. I mean, fantastic prediction. Just bringing in the other half of the population would be a major milestone. John, I'm curious from your side, do you see similar breakdowns demographically from male, female? Do you see that maybe a little bit different in your data? Is there something that we're not talking about where we get the next billion crypto users from?
Well, it's hard to follow up, Peter, because I loved every bit of what you just said. And we definitely also see in our data. I mean, look, we have users in 213 countries, and they're typically men between the ages of 25 to 43. And it varies, it fluctuates, times move. We are seeing a stronger female population on our site over time, but it's still small. And so I think, yes, there needs to be a much broader, like a broadening out of messaging, of information that resonates to everyone. This is for everyone, not any one group of people. And so I think that's what's really exciting is hey, that's another opportunity. That's another really amazing opportunity for everyone. But another thing that I want to talk about that hasn't been mentioned though is, we interview different projects about 2 or 3 times a week right now. And some of the things that are being talked about are the things that are coming soon. And the things that are coming soon, a lot of it revolves around speed and interoperability. And that's a major, major deal, because what's going to happen, the next billion users aren't going to come from something necessarily net new that we build. It's going to come from the things that people are already doing. And so, when you go to your grocery store, you're going to be using some sort of blockchain, some sort of crypto wallet, some sort of whatever, then the gas station, then the fundraising thing at school. And then, when you have to go to a baseball game and pay for your ticket, and then you're going to go home and watch TV and play video games. And as you're playing those video games, there's going to be real-time blockchain transactions that are confirming you just don't know it. It's just you're playing your video game like you always did. And so what's happening is we're going to start seeing sub 1 second confirmations across the board on some of these blockchains, some of these newer generation blockchains that are working on this. And you're going to see interoperability, so that when you go from retailer to retailer, you don't care what they're using. It's just fast and works. And then you start to get to an interesting point with all this where, okay, everything's fast and it works and it's all, it's all decentralized. It's in my possession. What is the place for the banks? The banks have to reinvent themselves. They're stuck somewhere between crypto and CBDCs, and the banks are going to really need to fight their way to be relevant in some places of the world, especially. And so I think just to echo what I'm saying, like between speed and interoperability, I think it changes the UX so much that we haven't even begun to see the benefits of crypto yet. And that's where I think the next billion users are going to come from.
Wow, super interesting. Devin.
Yeah, so I agree with John. Earlier in the call, he had highlighted some of the frictions, the pain points of actually using it, of having to download MetaMask or whatever wallet you're using, fill it with ETH, fill it with all this. It's just too much. So I don't think you're going to get a billion people to just know how to do that. That's moving in the wrong direction. The reality is most of these people are not going to even know that they're on blockchain. So he just described a couple of use cases, video games, sporting events, things like that. They're not even going to know that it's blockchain that's powering these things. There's energy web, there's all sorts of other things that are going on that people are going to have no clue it's blockchain related, but it is. And so it's an on-ramp. It's one of many on-ramps to get people on, and sort of sticking with that theme that I talked about, that once people go on, they don't go off. The other thing is, generally when it comes to any sort of motivation to do anything, people don't change until the pain of staying the same exceeds the pain of changing, right? So everything that John just said is, or not just said, but earlier in the call, he talked about MetaMask and all these issues that you got to deal with. But if the pain of staying the same exceeds the pain of learning those things, then you're going to make the change and learn those things, right? So there's going to be multiple sets of motivations that help people. So for example, if you find, and I used this example earlier, and I'm getting nearly 30% on stable coins as a yield, and you compare that to a bank account, and that's my lowest performing account, right? So when you look at like how much better you can do as a return, I would say that that is a big motivator to deal with the pain points that you're talking about. But that's not a billion users, right? That is a large number that are going to be motivated by that, but it's not a billion. To get to a billion, you have to do the things that John was talking about, which is the subconscious. It's just happening, and it becomes normal, right? Like that's part of the adoption cycle of any new technology. So when the iPhone first came out, lots of skeptics, lots of whatever. My grandma has one. She's 90, right? It took her a few years, but she got one. And so she didn't get one until everyone she knew had one, and she wanted to communicate and send iMessages and do FaceTime and these, things that everyone else is already doing this, and I'm missing out. So the pain of staying the same, I'm missing out, exceeds the pain of, oh man, I got to learn how to use an iPhone for a 90-year-old, right? It's a pain. She still calls me and asks how to do things, but the pain of staying the same exceeded that. And so we're going to see the exact same thing happening within crypto, where people are saying, wow, I'm trying to save for college for my kids, and I'm getting nothing in terms of returns. It's a 15-year time horizon. Why don't I do something that compounds at a much higher rate? And so that's going to be sort of the motivation to get people to do things where they're dealing with the pain points John talked about. But the majority of that billion is going to come from the subconscious, or from the subconscious.
Interesting. And so speaking of pain, and speaking of driving people in, it's said that everyone buys Bitcoin or gets the Bitcoin at the price that they deserve. I want to curious here, what do you think happens regarding price to bring Warren Buffett or Peter Schiff to the party? How much pain do they take before they get involved? And I'll open up for whoever wants to grab this. All right. And Devin?
Yeah, I'll jump in. I don't think either of them are going to get in at all. And so if you look at Warren Buffett, rule number 1, don't lose money. Rule number 2, don't forget about rule number 1. And if you expand onto that, it comes down to, if you don't really know what you're doing, he's pretty old. I don't know that he's going to go through all the hoops to really learn it. Maybe he starts to see like some of the things I'm doing and others are doing and seeing like, oh, this is actually feasible. This is something that we could do. Then maybe that would get them in, but it's not a certain price of Bitcoin, right? It would be the desire to have more Bitcoin, right? So if the price tanks, then they can use that as an argument and say, oh, the price tanked, that's my justification for why I shouldn't have gone in at all. They're not necessarily going to look at that and say, oh, buying opportunity, let's, let it go up. So I don't think the other part of the question, at least written, I don't know if you mentioned it here, is Peter Schiff. And I think he's got enough confirmation bias. Like I have a lot of respect for Peter Schiff. I listen to a lot of his stuff. I his book on how to grow an economy and why it crashes. I recommend that to everyone, even now, even though he's been wrong on so many things. That basic book, like it does teach you economics. Like it's a really good book on that. And so I think he's got confirmation bias at this point. I think that no matter what happens, he's not going to buy in. Even if it goes to $1 million a token, he's going to say, well, I missed the boat. Maybe he'll admit he's wrong. I think he's too much of an ego for that. But I don't think there is a price that gets either of those two figures to enter the market. I think that they're just not going to do it. And that's fine, right? We've got enough people that will do it. But those two, I think, are going to stay out.
How about
I want to add just, like Warren Buffett, it's not a price. It's not a price that gets him in, but I could see him saying, hey, I've already got, so much stock in Wells Fargo. Why don't we convert Wells Fargo into some sort of custody solution for crypto? And we'll charge them a monthly fee. And he's like, it's more about picks and shovels, and he owns railroads and things like that. I see him building, if he were to even get involved, I don't think it's him just directly going out and buying Bitcoin and hoping it goes higher. I think he would want to play in a sustainable way where he can continually make money for his, to add to his legacy. He doesn't care if Bitcoin goes from 500 to $1 million, 500,000 to $1 million, what, to make more money? And then what? Then he can't sell it either. That's not his game. And so I think that's the only play I see him getting in. And Peter Schiff, I don't know. I still think he's trolling all of us, but we'll see.
Yeah, so he's going to backdoor in, is what you're suggesting. Backdoor into some equity position. I do have my next question here, and I think here, Annabelle, would be pretty interesting to hear from you. Is there's a lot of discussions around the current bull market. Do we think it's going to extend? Are we going to have an extendable market, or are we following similar patterns like 2013, 2017? What are you kind of seeing here from your customers, or your opinion here?
So I guess from the flows we're seeing and discussions we've been having, actually, there are two camps. One is that we're going to be in this bull run forever. It's never ending. And one on the other side, I think, and I'm with this side, is that I think we've seen a few of the cycles. There is certain cyclicality in this market. And now because the market cap is over $2 trillion, it's gone a lot of the traditional money coming in. So it actually has a more of a correlation, or it reacts in a more sophisticated way towards what happens in the macro economy versus probably where it was 8 or 4 years ago, where it's more of an isolated asset class with, fewer players kind of within its bubble. But now, right, a lot of the traditional players are in it. So you're seeing the Fed is, having these taper talks, rate hikes happening soon. And that definitely plays into the inflation trade narrative of Bitcoin. So I think some of the people, or myself included, we are expecting that once that does happen and play into the crypto market, then we might head to some of a more subdued. And right now, the sentiment is to be honest, is very close to what we're seeing in 2017. It's hyped up, like NFT took over Times Square in New York, and that's that's what we're seeing and experiencing right now, and I'm not sure if that's sustainable. And to be honest, I think maybe we're all ready for some of another period of time where we focus on building the product as opposed to really focus on pricing and having all this moon memes. So I think personally, again, not like financial advice or anything, I think over this year we had probably the more bullish news coming out from the US with Coinbase listing earlier this year and the ETF being approved just more recently. So unless they're like very, very strong catalysts towards it, then I think with where it's going, where it's headed in the global macro market, then we might start to see some sort of consolidation next year.
Interesting. And Haider, what's your thoughts here? Are we at peak euphoria, or are we're riding this one out for a lot longer?
I think the current run or the current market conditions, I personally struggle with comparing it to 2013 or 2017 because I think the environment is very different. Look, I think we consider Bitcoin the foundational layer of crypto markets, and Bitcoin is in a much more position of strength than it historically was in 2013 and 17. So there are more new speculative markets like NFTs and metaverse and new assets that are that the retail is chasing after. Yes, that could experience a dramatic pullback, but if there was a dramatic pullback on Bitcoin beyond like the 40,000 lows that we saw 30 days ago or so, or a few weeks ago, I think there's enough demand in the market that that price point wouldn't stay there for too long. It would probably get gobbled up, and we'll see the price recover very quickly. What happens to altcoins? I'm watching that really, really closely because of the speculative nature of meme coins and NFTs and such. So that's my general view. I think 2021 or going into 2022 is a very different environment than 17 and 13. And my hope is that it's not going to have the sort of Armageddon pullback we might have seen in the previous cycles. And one last point I would say is, I know we had some really thoughtful answers on, where might the next billion customers come from. I would be really surprised, and maybe we'll laugh at this in a few years when it's a meme coin that drives most of the billion users. It might actually be something as simple and silly as that than the sophisticated products we're all hoping people will engage with.
Yeah, well, that's what our friend Alon talks about as the most ironic outcome potentially being Dogecoin. Very interesting. John, do you have any thoughts here around bull market, extend, top?
Probably a lot of them, but I'm going to also agree with Haider because I'm going to say, when Dogecoin had its big run to 73 cents or whatever that was, I was sitting in a coffee shop and there was 4 mothers holding their babies, talking about how they're all in on Dogecoin, and when it hits $1, they're buying a beach house. And I think you can guarantee that they were not like, it's a driver of new people coming into the space. It gets people talking that weren't previously talking about it. And I think that's really important to note. Fun is so incredibly important in this space. And I think people have fun with some of these meme coins, and they bring up another important point, because when we're talking about like what are your bull market predictions? Like, what's your price target for Bitcoin? Aside from throwing a number out there, I think you have to look at, like, in general, where's the money going? Is there capital flowing into the system to build the next generation applications, or is there not? Is it shrinking? Is it growing? You're seeing Binance throw in $1 billion into a fund to build. You're seeing Solana raised how many hundreds of millions of dollars not long ago. We're seeing exchanges advertise on Major League Baseball, right, at the World Series, and every umpire. Like, there's major celebrities getting in now. The money that's coming into crypto is not built for what's already here. It's not even out yet. The teams are still being formed to build those future things. And so I think if you just follow that in general, I think it tells you that it's going to be a long while until there's some kind of top. And I think, I'd say if you look backwards, finally, we're starting to get just a tad of historical data in crypto, because it's no longer like 3 years old. And so we're seeing things that are like, if you would have just been patient, and just bought Bitcoin and held it forever, didn't matter when you bought it, didn't matter any day, you're in the money. You made money. All you had to do was be patient. And so I think, we could have had this whole conversation a year and a half, 2 years ago and said, oh, the market's in the toilet. It's awful. We're in this bear market. Reality, you should have just kept buying Bitcoin. You should have just kept buying Ethereum. You should have just kept buying some of your favorite coins, and you're in the money. And so I think it's not so much is there a bull market, is there a bear market? There's a market for the impatient, and the impatient always lose. And if you have confidence in what you're building, you just have this kind of longer term mentality, you win. It's that simple. And if you're going to day trade, eventually you're going to lose.
Long-term value.
Yeah, I love it. Zoom out on your chart. Zoom out on your chart. And a very, very interesting discussion, folks. I think it was awesome. I want to thank each of you for preparing and coming out here and sharing all this knowledge with us. It's been a phenomenal discussion. I've learned a lot, and I look forward to following up in these conversations with each of you. So thank you each for coming on, and appreciate all what you did.
Don't think you're an investor? We make investments morning, noon, and wait, what time is it exactly? We make short-term investments, long-term investments. We diversify our interests, realize our gains and losses, and try to keep the big picture in mind. You don't need to become an investor. You were born one. Robin Hood.
Some really interesting insights there. A huge thank you to all of our panelists. Now coming up, we have Zementra's Ziv Keegan with insight into privatizing securities, a conversation that we've heard a lot in 2021, and we think it's going to continue for the next few years. And following that, we do have some discussions on Robinhood, so make sure to stay tuned.
So thank you for the kind introduction. We launched Symmetria about a year ago, near the time of the LA Blockchain Summit, and it's really exciting to be here. Many things have happened since then, and I'm really happy to be here again to share. We are a digital securities market. This past year, digital securities technology and CBDC has been on the rise, but this is going to be kind of a strange talk in that respect because we're not going to speak about digital securities at all. What we are going to speak about is something which is pain for many companies, and we think that it is an opportunity to address. So I'm from Israel. Israel is one of the largest tech hubs in the world, with over 70 unicorns. The battle for talent in Israel is raging. We have 13,000 tech jobs currently open. Over 60% of Israeli startups are struggling to recruit talent. In fact, the sector continued to flourish and investment increased. The talent shortage is becoming even more acute. Over 15 billion was raised in the sector in the last 8 months alone. Those companies are tripling the number of job openings. As a startup, you are not only competing with other startups within your industry, but also with global players such as Google, Amazon, Apple, and recently named Meta. A real-life story has been emerging even within Symmetria itself that we decided to share. We have been looking in Symmetria for a new product league. We met several great candidates who were excited to join Symmetria, including a person named Jamie, an alias name. She's the talent that we were looking for. We really liked the company, and she had the skill and experience we were looking for. And in parallel to Symmetria offers, she had other offers from 3 major banks. JMP competing offers from banks included equity exercisable into cash in form of RSU, something which for us is really difficult to compete with. If I was to compete with this offer, I had to offer Jamie additional salary, which would eat into my budget and eventually lead to competition to up their salary, sparking a salary war, and they would still have that added bonus of equity that they can offer that is exercisable into cash. No asset is more important to the business than its people. the talent, dedication, the ideas is the driving force behind the company's success. So how do you win this war? How can private companies still win competition over talent? My conclusion is in order to compete over Jamie, I would have to offer Jamie compensation of equity that is exercisable into cash, not only a bonus that she may or may not encounter in the future. From our findings, most employees prioritize the speed of encountering with money when determining the next employer. Symmetria launched a year ago with a very clear and straightforward mission to become a private market that provides liquidity to private companies. What we have learned since through our intensive dialogue with the market and private companies are encountering an even greater problem when it comes to hiring and retention of employees due to the lack of liquidity and overall compensation of their talent. The best example that illustrates the inefficiency of the private companies in that respect is employee equity compensation. For the company, equity is the most important and valuable asset together with the employees. Nevertheless, the opaqueness surrounding option grants and their potentials, since there are no actual liquidity of opportunity throughout the employment period, employees tend to mistakenly undervalue or entirely disregard the inherent potential value of the stock option. This isn't a good result for neither side, neither the employee nor the employer. When we started Symmetria, we said, let's make the company's success feel tangible even before the IPO. We take the secondary sales process, do it often, mimic the liquidity of the open markets. First, we make it easy. No more finance department dedicating 6 months to execute a single secondary sale. We make the secondary sale process so easy, you could scale and repeat it if needed. Second, we help our clients make sure that the process is fully compliant. Secondary sale process has many different aspects such as tax, securities regulation, and privacy. No company wants to have mishaps in its secondary process. Symmetria ensures that, even when it comes to multi-jurisdictions that the company operates in. Third, we introduce a marketplace where investors who are your clients, vendors, and fans can use this opportunity to take a stake at your company without diluting the current investors. In February, we obtained a regulatory approval to operate a DLT secondary market solution out of Israel. During this year, we raised financing from top VCs and entered into partnership with global technology partners. Those VCs include Draper Goren Holmes, which is hosting this event, CoinIX, the public trading fund, Alzarouni Consensus, and one of our early investors, the Swiss Bluefolio. We built a team to include both technology experts and top regulation experts. We further build our product, and we are now ready to launch. The world isn't what it used to be. Quantitative easing is pushing more and more capital into the markets, causing competition over talent to rage. Are you ready for this? So we're going to see right now a short demo of one of the two flows that we have where employees can actually exercise their options. This is Jamie. You remember Jamie from the presentation. She can see her ownership details on a DLT. This is going to Alzarouni Seeker to see like her details directly on the DLT. While it uploads, I'm just going to explain. She has 24,000 vested options. This is her current balance. This is the last share price and the estimated value. Jamie can just accept one of those bids of investors directly, or she can propose one of her deals by herself. This is here. You can see how much she's holding, and you can see her holdings in shares and in digital currency. So in this explanation, in this demo, Jamie is accepting this bid and choose to sell 1,000 shares, and the exercise cost is $5,000. The total value is 17. So after tax, she's going to have $9,000 into her account. Let's confirm this. This transaction is actually registered on a blockchain. So you see, this is why it takes a little bit of time to be updated. But then, yeah, this is registered to the blockchain. And you can go to the DLT transaction page and actually see the transaction is being updated on the blockchain. The transaction is actually executed automatically via a smart contract that exchanges the digital money with the digital shares, and the transaction is actually executed. Jamie can also decide to post an offer of her own. She can decide to offer 1,000 shares at an 18 or let's say $20 per shares. Okay, and then press the sell button. Okay. Now the transaction appears at the investor page, and you can see here this is 1,000 of Jamie's shares at $20 per share, and she can and the investor can actually buy those shares right now directly from Jamie. And again, the transaction is registered on the blockchain. It's going to take a second or two, and it's done. So this is our demo. Thank you very much for participating in this call.
Well, now we're taking a look at blockchain technology, centralized and decentralized recruitment and retention strategies with Ziv Keenan from Dementra, Judith Gard from Robinhood, Warren Anderson from Discrete Labs, Konstantin Richer from Block Demon, and Daniel Ice from Charge, and Michelle Newell from Cryptonomic.
Hi, everyone. Thank you, Ziv, for all of the relevant information you shared and success that you've had with the current market. That was very insightful, and we're really excited to dive in and learn more here regarding hiring best practices for this space. Hello, everyone. I'm Judy Garb. I'm part of the engineering leadership recruiting team here at Robinhood. I support engineering management, hiring, and crypto-related roles, and I've been with Robinhood for just under a year, and I've been in the recruiting space for 12 years. Today's discussion will focus on how we can better serve recruiting for the crypto and blockchain industry. Our goal is to brainstorm some ideas collectively and to have an inside look on how companies are thinking and evolving due to crypto hypergrowth. Before we jump in here, I'd like for all of the panelists to introduce themselves and give a quick 1-minute background on themselves and their company. Any volunteers to go first?
I'm happy to kick it off. My name is Daniel Ice. I go by Dice. I've been in technology for 20 years. I got into crypto in 2017 with the ICO bull market, built an ICO platform, raised $200 million for a dozen clients, distributed about $2 billion in assets. Currently working at decentralized technologies at NAX, which is New Asset Exchange, and Charge is one of our products there. Combines wallet, exchange, and shopping all in one app.
Thank you. Konstantin, would you like to go next?
I do. Hey, apologies, was muted there. I'm Konstantin Richter. I'm the founder and CEO of Blockdaemon. We're the largest node operator in the crypto space. We run nearly 20,000 full nodes across 50 protocols at this point in time. We're 120 people at this point. We've recruited nearly 100 people this year. Thus my presence here on this panel. Our audience and customers are mostly institutional exchanges, custodians, financial services companies who are looking for really reliable and simple connectors into the cryptoverse on the core infrastructure. We're non-custodial and fully regulatable, aka we have a chief compliance officer. We publish financial auditable accounts. And so forth. So we're sort of a nice little bridge from the craziness and open source nature of crypto to the more closed loop world of finance. But we come from the crazy open source world of crypto. And so that's where we're at home, and yeah, excited to be here.
Thank you so much. Vishak, how about you?
Hi. Yeah, great to be here. So after studying machine learning at Columbia, I worked in finance for many years, so over a decade. So I worked at Bear Stearns, JP Morgan, quite a few adventures during the great meltdown of 2008, and a few other interesting events. It made me predisposed to crypto when it started really taking off. So since 2017, I've been part of Cryptonomic, and we're pretty active in the Tezo space. And given our background in institutional finance, we're also active with several financial industry partners. And finance and blockchains, very, very promising. So along with my co-founder, I think pretty sure we did the first ever financial derivative on the Ethereum blockchain. These days we're a lot more focused on Tezos, but always interesting in the crypto world.
Thank you for that, Vishak. Warren.
How's it going? My name's Warren, I'm VP of Product at Discrete Labs. Discrete Labs, about 50 people spread over 5 continents. We've grown from 8 people at the beginning of the year, so we've grown pretty fast. We are building secure, scalable privacy systems, including Findora, which is a layer 1 public blockchain with programmable privacy. So you can think of it as like a more programmable version of Zcash. A little bit of background on me. I got into crypto pretty early as a miner, a Bitcoin miner in 2011, actually. Started what is now referred to as one of the first DeFi platforms on Bitcoin in 2013 called Hedgie. It was a OTC derivatives platform to allow miners to hedge their volatility with institutional investors. I spent 4.5 years working on the product team at Ripple, and then joined the Discrete Labs team in March. So excited to be here and talk about our journey on recruiting.
Awesome. We're excited too. And then Ziv, would you like to go?
Yeah, so Ziv Kina, CEO of Symmetria, private market, launched out of Israel. My background, I started in 2017. I started the security token lawyers. It was a law firm that was specialized in the DLT project and the combination between DLT and securities. And then I did some interesting work with eToro. I worked there with about 2 years. We launched together the Good Dollar project, a DeFi project with social impact intention. And later I was COO for Ownera, which was presenting here earlier. Then I spun out of Ownera and created Symmetria with the aim to be a private market. As a private market, we're looking for inefficiency within the capital market and trying to solve it. And the speech that I gave before was about one of those inefficiencies.
Great, thank you. Thanks everyone for the introductions. So we'll jump in. Companies in the crypto space have lamented that they can't keep up with customer demands to find enough suitable employees to satisfy their needs. The lack of experienced talent is particularly problematic with the turbocharged crypto community. And companies need highly specialized professionals such as software engineers, compliance, legal, risk, management, marketing, sales, recruiting, to manage and scale their businesses. Crypto firms find it tough to find the appropriately skilled candidates for thousands of open roles across the world. This sector faces a number of challenges recruiting people. And since it's still an emerging area, there aren't a large number of job seekers with 5 or 10 years of relevant experience for the specific nature of most of the job openings. So my first question to you panelists is, we know that the crypto space is super hot right now, but the talent pool is lacking in terms of direct crypto experience, given that it's a newer market and highly competitive. What has been your experience with hiring, and what challenges have you encountered? Anyone to take that first?
Yeah, hiring's become progressively more difficult, if I'm being honest. There was once an almost arbitrage opportunity because crypto was still an emerging domain. So there were always people who were highly qualified that wanted to make that pivot, wanted to make that switch. So it was relatively easy picking once upon a time. But as the competitiveness has increased and the geographical arbitrage is also sort of almost non-existent now, it's become a lot more difficult to not just hire, but also retain, obviously. This is a good sign for the industry, obviously. It's a huge endorsement for the direction in which things are going. But yeah, it's causing a lot of practical problems, and it's a necessary growing pain for all of us.
Definitely.
Yeah, I think, I've been doing tech for 20 years, and it's a common problem that, a new tech comes out and everybody wants 5 years of experience in it. So that's kind of a story as old as tech, that everybody wants 5 years of experience on something brand new. What I think is more interesting and more difficult to solve is the fact that the economic incentives have not changed with technology cycles in the past beyond us moving to more of like a startup culture, startup industry. Everybody had a very clear economic incentive around equity, the cap table, the vesting system, and trying to recreate that on chain with instant liquidity for most of these projects is probably the hardest game theory problem out there. And I think that it's going to force, people as they hire to be a lot more inclusive in the upside of the company. And but as a serial founder, it's a real tension that I feel in my heart between I'm taking massive risk to create this thing, with my time, with my energy, with my emotions. And I do want people to work on it, but I don't want people to just kind of come in, take some value out and move on. Like the current startup model does really create like a refining process so that by the time that the liquidity events happen, a lot of value has really been accreted inside of that entity. But, I do think we have a very difficult game theory problem to solve there.
I think I totally agree with Daniel. I think another thing that we need to notice, and I touched upon it in my keynote, is that we have banks now entering this space. So when I'm trying, once I used to interview people, and they had experience, they worked at a few startups before, but now they have offering from JP Morgan, from large institutions. I don't want to name any more names, but like all the big banks are moving into this space, and they're looking for talent as well. So for us, we need to compete with those major players that are moving in. And going back to what Daniel says, this is like what we're constantly thinking with our experts, with our we employ all kind of experts in this field, trying to understand how broken the compensation market is, and how can we solve it, and how can we make it more efficient. Because I think like if there's something which is sure, that is the innovation would come from our type of companies. We would reinvent the compensation model and win those talents.
Hey guys, I thought they're all super interesting comments. I think first off, I would say that the problematic looks different for different types of companies. I'm not necessarily, I don't know yet if the traditional model of cash and options. I don't think that's obsolete. Like it really depends on how things are structured, right? Like obviously in Silicon Valley and things, people are very, this is a very common issue, and so there's been a lot of evolution, I think, in how you can structure it. For us, and obviously we're VC backed, sort of, let's say a VC blue chip, right? Like we're very VC backed. Like we have folks like Sapphire Ventures or SoftBank or Goldman Sachs on the cap table, and so we're very traditional in that way. But we actually have a very defensible valuation and option pool, right? And so for us, the great thing in the current market, yes, there's a lot of scarcity around great talent, is that also obviously the ability to provide compelling liquidity and best-in-class compensation is huge in this space, right? So companies like us, I mean, at least, like everyone can raise a ton of money. And valuations currently are really on an upward trend. And so it means you can offer very competitive packages. And so the way we've approached this is more structurally. And so I think the most important thing I would recommend anyone do who's in crypto and works at a crypto company is hire a head of people. The sooner you do that, the better, because it takes time to really refine and learn how to think about recruitment as a sales process, right? And so you want to build a funnel of candidates. You want to work on conversion rate. You want to make sure you have really streamlined tooling. And so for us, putting in place an organization that solves that particular problem efficiently was the most important thing. And we've been very fortunate to half coincidentally fall into this category where early in the year we started to put that, we've started to put a team in place, and then also work with a selected group of recruiters. And then ultimately, came to the conclusion, one of the things we do is, even though we're a remote first company, we allow developers to work wherever in the world. We pay Silicon Valley prices wherever you are. And so that's a reflection of the competitiveness of the landscape. So for us, obviously we're also staking, we have a lot of yield earning parts. It's easy. The business makes more money than we can reasonably spend. And for us, that's an opportunity to take care of our employees, right? That means I don't care where you sit. If you work in Palo Alto or you work in Barbados, we're going to pay you top of the market as if you were a blue chip engineer we hire anywhere in the world. And that's been a real, and that's a budgeting exercise, right? And so that's a exercise in understanding how do you see your cost base evolve, and then how do you capitalize the business for it. Right now it's easy, right? Because you can get capital at such aggressive rates and valuations with businesses who often also are cash flow positive. And so there's very low risk in it. And so I think so there's a compensation side where crypto companies can pay probably more competitively than a JP Morgan, because those companies have bans. It's super complicated for them to hire folks. For us, obviously, it's super easy. The big challenge then, and then on the equity side, it's really a structural and educational purpose. It really varies on how you're structured. A lot of crypto companies can't offer reliable equity. What I would say to any engineer out there is don't take equity from a company that doesn't have a board that consists of outside stakeholders. And so one of the things I always find really interesting is when I talk to friends and stuff, and they're, oh, I'm joining this company. It's, oh, great, yeah, that's awesome. And who's on the board? Like, oh, I don't know. And it's like, well, so if it's a founder-run CEO who controls the majority of your shares, there's very little control that he'll ever convert or allow you to exercise and earn money on these options, for example. And so I think it's really important to understand what's the governance structure of the entity look like, because there's so many examples in this space. And I don't want to, two of the largest players in this market are very famous, and there's a lot of disgruntled ex-employees who said, hey, I worked there for 5 years and left, and I was always promised option, but it never happened. And the one similarity in these companies is that they're run by really strong, great founders and super strong individuals, but who also avoided, having external investors and governance where people actually enforce them to also honor these type of agreement. And so I think the complexity is, and then it gets complicated because once you become an entity that has that sort of regulatable structure, then you're in the land of onshore, kind of like Judy, what you probably have in Robinhood. You got to deal with normal complexities and regulators, and suddenly you're dealing with that whole universe. But so I'm sorry, I'm going on too long. But so what I'm saying is, I think the game theory right now is fairly easy because we have so much capital at disposal as crypto companies, right? And it's easy to convert it into USD if you want to.
Yeah, as in the spirit of panel discussion, I actually may quickly take the opposite path and say, I think hiring in crypto and blockchain has gotten easier. Now, given I've been working in full time in the blockchain space since 2013, when back in the day, maintaining a bank account was actually a challenge. Making payroll was actually a challenge. The market traded less than like 10, 20, $30 million a day. Now it's $1 trillion market. There's a lot more money out there. The talent pool has actually gotten bigger. I no longer have to explain to new candidates what blockchain is or what Bitcoin is. There's like a general understanding of how these technologies are. even people that don't have like backgrounds, necessarily, they have a rudimentary understanding because there's so many educational materials out there that people can, just look up and read and watch. There's certification programs and can kind of get more into that later. But I actually think, it's gotten, to some degree, it's gotten easier. But on the flip side, it's gotten more competitive. There's more players in the space. There's more money in the space. I think a lot of blockchain crypto companies are competing against, the I guess we used to call them fangs, but now they're mangs. What is it? Manga, whatever. The mangs of the world. But companies are actually being able to do that for a lot of the reasons Constantine, measured. Like the balance sheets of some of these companies are pretty healthy. And people want to work in crypto. It used to be back in the day where the only people that were really attracted to the crypto space were they had physics backgrounds. They were dropping out of their physics lab, the math department, saying what's cool in the industry. Oh, blockchain's cool. I'm going to go work on that. Unless you had experience at some low level programming language that you could work on a protocol, there really wasn't a fit, for you. I had to kind of wedge myself in as a product person and just pick up and learn things very quickly. But now there's actual, there's places for people to go that don't necessarily have a background in that. There's more user interfaces for designers. Being a designer in crypto in 2015 basically only meant you could work at Coinbase because they were the only ones with an actual design. Every other company or project in the space didn't really have much design elements. So, I think to some degree it's gotten easier, but it is getting more competitive. I think the talent wars are definitely coming in facing in crypto, which is great. I kind of say game on. It's if you're at the right company and you're working on the right project, I think the talent will continue to flow.
Thanks for that, Warren. That is a good segue into our next question. There are many people that want to get into this space, but they don't yet have the crypto background. So if you all could share, what are some creative ideas that you recommend for those that are trying to break into the crypto space for a full-time career? And is there a way for any of these individuals to stand out?
Yeah, I think if my background software development, so just speaking from that, there are probably a lot of ways to work in crypto. There's some very high quality coding tutorials on YouTube now that I wish existed back when I got started. Just sit down, watch those, actually type out what they're doing, get yourself some live projects on some test nets, and really build a resume of deployed and shipped and verifiable code. And that's the DIY. I'm just going to learn this thing and kind of go that route. I found some of my best blockchain engineers by looking at projects that were done out of pure passion. I needed some help on ERC20s. I found somebody that wrote an amazing ERC20 tracker. His link was in the footer. I followed it, reached out to him, found that way. So if you start writing open source software, or if you start building a verifiable and demonstratable, blockchain is a public thing, just get out there, ship some code, show that you know how to think about this stuff.
That's great insight. Anyone else want to chime in about some ways for individuals to stand out?
Sure. I think there's two ways, right? There's also the question, how can you stand out as a company, right? And so I think obviously if you're a talented engineer, participate in a community, you'll drown in job offers, exactly as Daniel said. That's the way to do it, right? Is we try to train our community leads to look out in the discords for people and developers that seem really smart, and find out, hey, are they actually an individual developer or someone who's actually working for a company? And so that's a great way to do it. The other thing I always actually tell our new hires and folks coming in is, what I still love about crypto, and we're probably at the last generation of that, is you can go to LinkedIn even and look around in your area. You can kind of search by where you live on crypto enthusiasts and meetups and stuff. And I always recommend going to that. And I've actually really proactively reached out to a lot of people. I find people in crypto are very communicative. So if you're knowledgeable and interested, and you're like, hey, I live not too far from you. I'm super excited about Project X. I saw you commented on Twitter, let's have a coffee. People will take you up on it. Like, there's a lot of folks who are super passionate about it. For us, one of the key things outside of publicly trying to support protocols and really align ourselves with foundations and contributing to the communities is really important. So we try to commit resources and pay open source developers to develop a good brand within the respective communities. And then, we convert, depending on the roles, we have sort of a pattern. For engineering, we like people who did a lot of DevOps, data center type work. And then we have a course for them when they come on. We call it the Block Demon University. It's probably sounds a little fancy, but we can train them with a fixed program in a month to be fairly proficient in the methodology in which we run certain core components of infrastructure, for example. And then the same is true for example, for someone who has a sales background. There's a little bit of a different program. And so what we've learned is, and there are certain types of people we like. We like people who worked at Salesforce or Stripe, so we kind of have lists of companies where we say, hey, people and activities, and if we find there's a pattern there, we create courses and an onboarding experience that takes advantage of it. But you do kind of have to convert people externally for sure. There is definitely, but I actually agree with Warren. I think it is easy. There's a lot of people who want to work in crypto, and getting them efficient quickly is then also the really big thing I think you need to think about. But yeah, and so the onboarding experience and how they get to work, how the company is even structured. Like, we always debate, do we want to train experts? So you're a guy who works on Polkadot and you just know Polkadot. A lot of engineers like variety, but then for the company, it's like, oh, I really want an expert. And they're like, well, I want to work on these 3 different protocols. And so you got to sort of meet people halfway and then give them the opportunity ultimately to work on cool shit, right? Like, I mean, that's what everyone really wants to do here. Everyone can make a lot of money in crypto at this point. It's really how you get people enthused about what they're working on.
Yeah, I totally agree. Similar to what Dice, I like that. So what Dice said, as a software developer, most of these technologies are open source. So, and there's always GitHub issues that you can cherry pick across every project. A lot of them are smaller and bite-sized. There's even documentation issues that you can contribute to. So having, if you're a software developer, having a pretty healthy contribution on GitHub, where even if you're doing nights and weekends, to kind of build up your portfolio of GitHub contributions, I think is huge. When we go to hire, software developers, is one of the first things we look at is, how does their GitHub profile look like? How active are they? What projects have they worked on? What's the diversity of projects? And that's just like, it's kind of getting into the door. If you're non-technical, you have a BD background, you have finance background, you have marketing background, Constantine kind of hit it on the head. And this whole space has really evolved out of crypto meetups, and they're so fun. I remember going to a few where there was maybe a dozen and like a bunch of pizzas. Now they're being hosted at the top of the market, in these beautiful luxury buildings and places. So the bar has gone up for a lot of these meetups. But, just the other day, I was at a meetup just during the week, and someone, showed up and said they didn't work in crypto, they didn't work in blockchain, they just had questions. And, like Constantine said, most of the people in crypto are very open. They're willing to share. Most overshare, in fact. You always know when someone works in crypto because they won't shut up about it. So I'm one of them. So, just talking with people, do a little homework before you go. Have a little bit of understanding, but then just listen, because they will talk. Like, people will talk, and you'll learn a lot.
More often than not, though, these days we're working with a lot of people who come in with no background, right? So they've heard of crypto because it's big enough now, but they don't come in with a practical sort of understanding of crypto. So what we've observed is across roles, across seniorities, across ages, across demographics, one thing that really helps is just for the first week, 2 weeks, 3 weeks even, just have people engage with crypto. It doesn't matter what their role is, right? So in 2018, we started by just giving people a little bit of ETH and telling them to just go play with CryptoKitties for a week or two. Sometimes people got a little bit too addicted. But now there's such a sophisticated ecosystem, right? You can bring someone in and you can say, make yourself a wallet, give me your address, you send them some crypto, and then you can give them a bunch of different tasks which are really engaging. So in just a few days, they can cover DeFi, they can cover NFTs, they can cover playing with wallets. So you get this. So all these people that you bring in, regardless of the language they speak or their age or whatever, they're able to really concretely engage, which wasn't possible before. And that's a huge bonus that we have today in terms of just onboarding people. And one of the things that we do is, we have a pretty diverse team, and some people that we work with, they have a lot of infrastructure challenges. So, in the United States, we barely think about electricity or or broadband or whatever. But we do work with people in certain parts of the world where it can be a challenge, and it's interesting because through this onboarding experience, you can see from their eyes what some of the foundational UX or the infrastructural challenges with using crypto are. So this whole onboarding process of being immersive, it actually provides us with a lot of intelligence about how to fine-tune products, how to fine-tune the professional experience of working in crypto that's compatible with people in every corner of the world.
All very good points. I think someone mentioned geos too, and obviously that's really important and comes into play now when thinking about hiring. With that, I think Konstantin, you mentioned that you Warren, you have hired in 5 different continents. So I'm sure you have a lot to say about balancing different time zones, especially for international folks. So how does that work, internationally and even just domestically?
Yeah, sure. So there's a saying in crypto, crypto never sleeps. It's a 24/7, 365 network, and the market follows. So as a result, if you're a company that's working in crypto blockchain, you likely have employees that also don't sleep as a result of them being in multiple time zones. So we are spread out, like I said, over 5 different continents. We try to basically double up as many things, company-related things as possible. So if we have certain mandatory syncs, we try to make them available, twice for, one half of the globe and another for the other half. It's a challenge actually onboarding. There are some countries that make it very difficult to operate, to set up an operation. And they actually require you to have a full-fledged company, based in the country of that the employee's operating out of, and then the steps and the hoops to actually create that company is multiple years. So that becomes, there's some countries you just, unless you have some other method of being able to employ them, it's nearly impossible, which is really a travesty because I think talent is in every country, right? Especially with this technology. So payroll is also very difficult. Crypto, ironically, makes it a little bit easier because now you have people are willing to get paid in, for instance, in stable coins. Where the process, the payroll kind of becomes a little bit easier. But generally, it's if you're running a multinational company in crypto, it's going to the sleep is going to be a challenge, that's for sure.
I just want to add that I agree with everything that that Warren said. So for these reasons, historically, Europe or the sort of EMEA zone was seen as being optimal, right? Just because it kind of lies in the middle. And one thing we've realized is there's actually, unsurprisingly, in retrospect, there is a lot of talent in Africa which is actually pretty crypto native in comparison. And there are companies such as Novustack in Africa that are doing a lot of great work bringing in this talent, highly educated people from engineering colleges in Nigeria, for example, giving them a crypto background and making them available for hire. They take care of the infrastructure, they take care of the payroll challenges, the payment challenges and so on, and they make it really easy for a blockchain company like ours or anyone else's to just focus on the work, and the detail gets taken out. Once you take the detail out, it makes it much easier to work with people in markets like Africa and South America. Is also there are people who have smelt the opportunity. They make it very easy to connect with crypto-enabled talent. They take care of all the regulatory and legal aspects. And for us personally, it's made life a lot easier, especially in a sort of multi-continent workforce. So I think I would encourage anyone who's listening in, anyone on this, anyone who watches this later, places like Africa, South America, there's so much potential. There's a absolute nuclear arms race already in North America, in Europe, in India, all places that we used to really focus on before. But now we're really enthused about the quality, and especially with these intermediary companies like Novustack, just being able to seamlessly hire from there.
That's great. We started to kind of talk about this, but I wanted to see if anyone else wanted to dive a little bit deeper. Has anyone, had some really creative ways to overcome this smaller talent pool, or any other challenges that they've seen? What have been some like successes and wins that you can almost shout from the rooftops?
Well, I think one way to do it, which I'm not overly proud of, but is we actually, we always worked with external recruiters, and I'm going to do a lot with for the recruitment industry here. But one of the things we've done is actually call them all up and tell them that we want to be the first person they call if they meet an talented individual, and that we will give them a signing fee on top of our current fee structure to them. And so it's a really simple thing, but obviously very powerful, right? Because all the recruiters, for example, in the space work with 20, 50 companies at the same time. And so the question is not also, how do you stand out to the recruiters so you can make sure that, every time someone talented comes across their desk, the first phone call they make is to Blockdaemon, right? And so we have incentive mechanisms for that as well, right? And so, and I think that for us has been one of the reasons why we've been so successful in hiring so many talented people with experience also in the space, is that we build referral fees and signing fees at a multitude of what we pay traditionally. I think I can give you one interesting metrics is, I think if you look into buy a company in the crypto space that has a crypto engineer working on a product that works with experience, it's like $5 million per engineer. Like the old adage in Silicon Valley was like, it was 2 million per engineer. I feel at this moment in time, if you look at the market and the insane valuations, like if you were looking to buy a company and there's 10 engineers on it working on a product that actually works, it's a $50 million business. I mean, it's insane, but it's the way it is. And so I think a lot of folks don't think about the cost of capital associated to hiring someone with a lot of talent. And so I always feel like that people think way too little about it and are way too greedy around certain bits, like, oh, $5,000 or $10,000 and here and there, and how does that work? And it's like the actual cost of a quality crypto contributor is so beyond that, that understanding that and baking a different way of thinking around it into your commercial model and how you address that is for us was always very easy, because we tried buying companies in the space and we were always floored around like, wow, if I could recruit the same people, if I would apply the same funds to recruiting, I mean, that's insane. Like you could do a lot of different things. And so you gotta assign a larger budget to it, I find.
Yeah, we actually pay employees $10,000 per hire that they bring in. And that has been so successful, and that's the best money I think ever spent. And as a result, we actually haven't had to use that many external recruiters, because the employees are the best advocates for the company. They want to work with talented people. They want to work with their friends. So we are happy to pay that, every time. And, and it's been really successful, I think, as a program. And I would much rather pay, our employees that money than an external recruiter. Love the external recruiters, nothing against them, but I'd rather pay, our employees. So I think that's
I would
a great
actually pay
example.
employees a multitude of that. So for
Yeah.
our internal referrals, just so you know, like we pay them more than we pay the recruiters, and we also pay them a lot more than the 10K, because we think that's the right answer. Is like ultimately these folks are so deep in the space, but we are really very careful in describing to people who we're looking for and also incentivizing them. And so and you know, and that's what I meant, not like that makes sense, but those are the traditional referral models, right? Like it's always like 5 or 10K, for example, which is like sure, but in crypto land, you know, you have a kid working on sushi for a weekend, and it's like, oh, I made $100 million on paper, and my NFT just sold for 180,000, and then you're trying to kind of, okay, how can I structure something a little more real worldy that motivates that person to seriously think about this? It's complicated for sure, but yeah, you can. I totally agree that there's a lot of incentive, like a lot more that can be done with businesses putting cash where it needs to go for talent.
Good. Thank you for that. There's also, we touched upon this a little bit in our conversations here, but in terms of getting creative with ways that we're acclimating people into blockchain and the crypto industry, has anyone tried training programs, apprenticeships, you know, anything that kind of, you know, brings people within the company of I'm going to give you an opportunity to try out this space, or even like, you know, internships, but maybe not directly from colleges. Has that been something that any of you have thought of or have achieved?
Yeah. So I think a number, like Konstantin mentioned with the Blockdaemon University and stuff like that. I work with the Dreyfus model of skill acquisition, which basically walks you from rules to intuition. There's 5 levels of leadership there. And what happens is people that have high degrees of rules tend to go from that level 1 to level 2 very quickly. And then over osmosis, you go from level 2 to level 3. Getting beyond the level 3 talent's very hard. And so the danger that a lot of crypto projects encounter is they bring a lot of talent in, they train the talent, but the talent doesn't know about the really hard parts. Like they're a little weak on their Solidity contracts, or they have a bug in the protocol. And those are things that can kind of blow up the whole project. So just balancing and having that experience in the room, and not just like wanting to hear what you want to hear. And I know this is a crazy word, but taking things a little slower in the blockchain space, making sure that the tech you're building is really, really solid, I think is really critical in kind of balancing new and incoming talent, because there is an overconfidence bias, especially if you have people who've been in software for a while, where there's a lot of undos. You know, there's no undos in a lot of these blockchain, you know, problems.
Anyone else want to chime in there? Or should we move on to the next question?
Well, really quick, the youth are the future, of course. We've had, maybe it's because of the pandemic, but we've actually had a bunch of undergrads sort of working part-time. It's pretty low stakes, obviously, but it gives them an opportunity to slowly imbibe sort of our company culture as well as crypto. And very often it's worked out really, really well. So I don't know if it's just a generational shift that undergrads especially have so much free time to work on crypto and within a crypto company and hang out in the chat, but it works out, and I'd recommend it.
Awesome. Well, this has been a really great discussion with all of you. Thank you so much for all of your time and for just this deep dive in what we're facing right now in the talent market. It was so great to meet all of you, and I appreciate you know, getting a chance to hang out here. Thank you so much.
Thanks, Judy.
Thanks, Judy. Real pleasure. Bye.
Can you imagine trying to listen to a million opinions at the same time? It would be chaos. But that's what happens in social media every minute. We have to decide what to turn up and what to tune out, which is a problem for anyone interested in crypto, because social has huge influence over the entire market and individual cryptocurrencies. So we created Lunar Crush to bring order to chaos. We listen to every single drop of information across social and distill it into bite-sized, digestible data. This means that you can zoom out to see and hear it all before making investment decisions. And in this brave new world of opportunity, Lunar Crush is leaving outdated ways of doing things behind. No monthly subscription, no bombardment of adverts, no selling your personal data. Because we believe there's a fairer, better, brighter way to fuel this journey. It's called Lunar, a utility token that rewards you for the work that you put into Lunar Crush. All that's left to say is, keep your hands inside the rocket at all times. Let's go explore. Lunar Crush, social intelligence for crypto.
What an amazing set of conversations we've heard so far. We now turn our focus to digital asset custodianship with Decrypt's Jen Benson and his panel of experts. Following that will be a keynote presentation from Acru founder and CEO Mohsin Masood.
Hi, I'm joined here by 5 wonderful panelists. We've got Glenn Barber, who's head of sales and business development for the Americas at Copper, which is a global digital asset custody firm. We've got Douglas Borthwick, chief business officer at INX Limited, and that has crypto and securities trading platforms for institutions. We have Yael Tamar. She's co-founder and CEO of Solid Block, an asset tokenization platform for real estate. We also have Oleg Kurchenko, founder of cryptocurrency exchange Binary X or Binarix, depending on how you want to pronounce it. And last but not least, we have Brian Korn. He's a partner with Manat, Phelps & Phillips, where he specializes in securities laws and broker-dealer compliance. Welcome, everyone, to the LA Blockchain Summit.
Thank you.
Hey, Jeff. So the title of this panel is Digital Asset Custodianship. And so I thought that we could start by breaking that down. And there's 5 of us, but let's try to have a lively conversation instead of kind of going from question to question. So if you feel the need to jump in, just jump in. But let's start by breaking down what we mean by custodianship. So we're hearing a lot about institutional investors getting into crypto in record numbers, but who exactly are we talking about? Who are custody firms holding cryptocurrency for? Is this big companies, hedge funds, venture capitalists, a little bit of all of the above? And what are the reasons why these institutional investors are getting into crypto? Oleg, could you start us off on that?
Yeah, of course. Hi. Yeah. First of all, thank you for invitation, and I'm really appreciate and really glad to be here. So on answering on your question, the reasons of the institutional investors are interested in crypto assets, and right now the amount of those investors are become bigger. It's there is like few main reasons according to our survey what we have in Binarix. So, and the first main point, this is the inflation and money printing by US government because of about 20 up to 22% of money was printed in 2020 year. It's more than it's more than $9 billion, and all of them, like all of those hedge funds and VC funds, are scary about the inflation. So this is the reason why they are investing in Bitcoins. Of course, we need to say there is a good potential, a capital to increase the long term and growing the confidence in crypto as an asset class. And of course, that helps to improve the regulatory environment on the cryptocurrency market. And this is the reason why they start looking additional markets where they want to invest in. So there is the main reasons why they invest in money in crypto.
So Glenn, you're head of sales and business development for the Americas. Copper is based in the UK, but it's a global firm. Is what Oleg's saying, is this primarily like a US driven phenomenon in terms of institutional investment and really the rise of custodian firms?
No, not at all. It's a global phenomenon, just like blockchain and crypto is, right? We see all kinds of institutional engagement right now, and it's obviously something that we've all waited 2 to 3 years to really come in. But everything prior to over the last 12, 18 months was dominated by crypto native hedge funds, arbitrageurs, and other investment and trading houses that really saw the potential for the asset class earlier than most. Now you're seeing this migration from traditional financial firms, and you're talking about hedge funds. You're seeing news of pension funds making the first asset investments, not only into the VC community, but also directly into Bitcoin. You're seeing endowments take a hard look at it, and you're seeing asset managers realizing that they have a new product offering that they could potentially give to their investors. So, and that's not just limited to the United States. You have a very friendly regime in Switzerland. There was just a conference over the last couple of days. Crypto Valley is very well known for incubation, and that includes large banking institutions, private wealth managers, and the like. And then you have a huge amount of Asian firms, and that includes protocols, because obviously these treasury amounts are increasing into the tens, if not more, billions of dollars. So all of this combined is really, really creating the wave of institutional engagement that we've been looking for over the last couple of years, and it's just going to get even bigger.
Well, and then, sorry, Yala, you want to jump in there?
Yeah, so the original question you asked about the institutions on custody. There's two sides to this picture, on the side of the user and on the side of the provider, right? So a lot of institutions have gotten into crypto for the reasons that the previous speakers have talked about. But then yet some other institutions that have all the licenses necessary realize that there is a great opportunity to start providing custody of digital assets on top of the custody of traditional assets. But, just very simply, what is custody, right? What do we mean by somebody providing custody of digital assets? Well, number one, the most basic service is storing the keys to the wallet on behalf of the user, right? So the biggest fear in the crypto world, because the asset is digital, is once you use the keys, you lost the asset, right? So in some cases, in some centralized, systems, you can restore the ownership, and but in most cases, you lost the asset. So that's a very important part, that individuals are so used to institutions holding their assets on their behalf that they're ready to trust a bank or a hedge fund or an investment bank, JP Morgan, Morgan Stanley, especially if they already have custody of their other assets, stocks, bonds, other types of private investments. So it's easier for them to just put their crypto or other crypto assets in those wallets, right, provided by those institutions. So that's why this industry has grown so big that almost every institution out there is using either their in-house, some are developing their in-house custody solutions, and some are using these custody tech providers. So that's what I wanted to know.
Yeah, and I definitely want to circle back to the security issue, but something else that you touched on was pretty interesting there in terms of that's just the tip. That's the most basic service. But right now, we're getting beyond just firms wanting exposure to Bitcoin or maybe a bit of ETH. We're talking about firms potentially getting into DeFi. And so I'm wondering who's getting into decentralized finance, to what extent? Is this about just holding maybe a little bit of comp, or are institutional investors demanding to take part in staking and governance and other areas? I mean, Douglas, can you take that?
Well, I can talk a little bit about that, but why are people getting into DeFi? Because that's where the money is. And let's face it, I think we all know market makers that are making 30% a month just by sitting there and doing, let's say, an arbitrage between Bitcoin and maybe wrapped Bitcoin. There's so many opportunities there right now, and there's a lot of money. Now, we all talk about custody here, but the little guy in the street, I guess the younger generation doesn't really trust the custodian. And I think they prefer to just hold it on their MetaMask wallet. And so they'd actually prefer self-custody. And that's something actually that us as an exchange, as a regulated, with FINRA and the SEC for our securities exchange, We do self-custody, where we allow someone to custody their securities on a MetaMask wallet. But we've also solved that problem that you have with crypto, where you can lose your crypto. It could be stolen, or it could disappear. You lose your keys, by using something called the ERC 1404 standard, which allows us to revoke tokens from a lost wallet and reissue them in a new wallet, because you can't lose your 401k in a boating accident. And there's a lot of securities that we have now in our pipeline coming down that are going to be ERC 1404 standard. And so you don't care about the custody so much, because now you can't lose it. And it can't be stolen, because the only way you can own the security or move it from one wallet to another is if the wallets are whitelisted. So only a monkey's going to steal a security token from one person and put it in their wallet when I have that person's phone number, address, email, passport, and driver's license, because we've done KYC and AML in the whitelisted wallets. So custody that we talk about today is very much a legacy type thing. And that, yeah, we're used to that for stocks and bonds. But on Reddit, the GameStop guys, they don't want to have their stocks custodied. They want to hold it themselves because they don't want rehypothecation. They don't want to buy GameStop and then have a hedge fund borrow it and short it.
Right.
And with security tokens, self-custody, you sort of fill that void and you take care of what the GameStop folks were talking about on Reddit.
I think that there's a real separation between the crypto investors and the DeFi investors. A lot of people who are reluctant to, even a couple of years ago wouldn't have touched any of this because, there's a 15% chance that it's not real or worthless. I think that world has kind of gone away. And I think you're now seeing institutional buy-in. You saw major corporations and major investment houses all but endorse the model. Tesla moved a bunch of cash into Bitcoin, and Schwab and Chase and a few others. That starts to add up after a while. And, what we call the mainstream stock market has been more volatile than the crypto market and has been outperformed by nearly every single token that you could buy on Coinbase. You could throw a dart at your phone and you go to bed at night and you wake up and something's up 5%. That's a major move for a Wall Street stock. And so this community, the institutional investors, but even before the institutions, what we're seeing is the smaller investors, family offices, people who don't have as strict of an investment mandate from their LPs, from their investors, are starting to move more and more of their allocations into crypto and into tokens, simply because of the returns they're getting. And now they're comfortable with the form factor of some of these custodial wallets, where they can say, okay, I see that I have cash in here. It has a link to my other accounts. It's not quite DTC transparent, so I can't put it all on the same screen. But it's not a series of 18 hash numbers where it's on some website where I may forget the website. We don't live in a world where if I lose my PIN number, I've lost all my money. We live in a centralized world. Mistakes are correctable. And what was off-putting about this industry for a long time was kind of how ruthless it was, and all of the horror stories. The guy lost his laptop in India with everyone's tokens. The people who lost a ton of money because they were hacked because they used the wrong wallet. I think that as capital moves into the custodial space and into the infrastructure of this industry, you're going to have a lot more of the not early adapters, but the middle of the road adapters. People my age are moving into this stuff big time, and it's not just for people who are in their basement in college or doing other things.
Can I mention something real quick, Jeff?
Of course.
All right. So I think over 50% of all DeFi transactions last year were done by so-called institutions, and the way they calculate that is by taking large transactions, 10 million and higher. Now, what's really cool about this is that you see a lot of acquisitions by DeFi companies, because they make so much money, they buy their own custodians. So Celsius just bought GK8, which happens to be our custodian at Solid Block. And why they bought them, one of the reasons is I think JK8 announced that they work with a few institutions, so they're trustworthy, right? So Gemini bought another company, I think they're called ShardX. So literally in the last quarter, a bunch of DeFi companies bought custodians. Why? Because they're getting a lot of institutional investors onboarded, and whatever wallet solution that they had is not sufficient for institutional investors because they want more security and they want more institutional features.
Yeah, sorry, I'll just jump in last.
Go for it, Glenn.
I think that it made a really good point. We are kind of the front lines as the custodians in terms of seeing the businesses that people are interested in. And I will tell you that on average, I would think that 30 to 40% of our institutional conversations around people looking to get excess return in crypto is centered around DeFi and how to access it, right? I mean, for example, Copper just happens to have what we call Copper Connect, which is an institutional grade version of MetaMask. And that is an extremely popular product. So I think that people that have at least a mild comfort with exposure or investment into digital assets, one of the major topics is definitely DeFi.
Right. And Brian, as companies wade into these new markets, you're the practicing lawyer of the bunch. So what are the minimum sort of legal and regulatory safeguards that are present and required of custodians? What makes people feel safe putting their assets with someone else?
It's actually a really interesting question because the custodial world around crypto is not by and large as regulated as one might think. There's a custodial regulatory regime around securities transactions. And if you're holding tokens, which might be securities, you have to ask yourself the question, do I need to be a broker dealer? Am I offering secondary trading on my platform? Is this something where I have to have an alternative trading system designation? Do I have to have a qualified custodian license, which is an enhanced broker dealer, which requires more capital? Do I need to be a qualified clearing firm? Clearing is really something that's more for the centralized world. Most of the DEXs and the other exchanges and other houses that hold this asset class are in the decentralized space. We're not looking to clear through a central node. We're looking at a multiple to multiple exchange. And, kind of to the chagrin of a lot of the regulators, most of that's not regulated. Now, what is regulated is your ability to take cash from somebody, your ability to swipe and ACH someone's account, your ability to swipe someone's credit card, your prohibition on doing business with people who are on prohibited terrorist watch lists and other SDN lists from the Treasury Department, and from the equivalent of that list in virtually every country that will have crypto investors. And so FATF has really kind of moved the ball here in terms of trying to set up a global exchange where people are going to subscribe to a similar set of rules with respect to KYC and AML. But KYC AML is really your biggest issue in terms of regulatory compliance. The easiest thing to get busted on, the easiest thing to get picked up, and really the biggest concern of most regulators, not just with the FBI and the SEC, but Interpol and other agencies around the world, is the prevention of fraud and the prevention of hackers and people using the blockchain as a way of furthering crimes and ransomware attacks and that sort of thing. So, to the extent that you can screen your platform to the extent possible, have a robust KYC AML platform, you're really going to go a long way towards being in compliance. And then, as we heard from the SEC earlier today here, there really is no plan, and they can't even have lunch together without. I kind of knew that rule, but it was interesting to hear them say it without having a public meeting. That's a recipe for nothing getting done. And the security status of the token. So if you're on a site and some of the stuff is securities and some isn't, the SEC coming in and saying this is a security, this isn't, that's really an application of the old Howey case, which is a Supreme Court case, an act of Congress. So Congressman Emmer is really in the driver's seat in terms of changing the rules and providing regulatory clarity there, but not the SEC. So I know that's kind of a long-winded answer, but there's very little in the way of real structure around crypto custodianships in terms of what you really have to do.
So, I mean, in the absence of that, as the sort of regulatory frameworks are still being formed, as people are kind of figuring out what's going on, it seems like that's going to be left mostly to the industry players to kind of set standards and infrastructure. I mean, Oleg, can you speak to a little bit of the kind of infrastructure that's necessary for firms to set up to protect and serve the investors?
Mm-hmm. Yeah, actually, the few weeks ago, I was on Money 2020 on the panel discussion in Amsterdam, and we talk about infrastructure and what kind of rules the major crypto players in this area must define. And the first of all, they need to make the standards for the providing services and protection of their clients' funds. When we're talking about crypto custody, we don't need to. We need to remember that there is no any clearing house for all companies who has their own custodies for accessing to liquidity very quickly. And this is not solved question at that moment. But when we talking about that kind of things, when we're talking about infrastructure, I think there is a need to create, first of all, the asset hub, liquidity hub, where one central liquidity hub have access to the major exchanges and give the possibility to the crypto custodies or the custodies of some companies to access to that hub, and they have an access to liquidity on the market, on the crypto market. And also need to remember about the regulations, because recently CAS approved the first Bitcoin ETF on October 19, and that ETF traded on CME. And why it was approved? For CAS, the fund is quite understandable because futures trading has opening and closing times just like other financial markets. And what do we need more about regulations? Despite large numbers of cryptocurrency investors and blockchain companies in the United States, the country hasn't yet developed a clear regulatory framework for the asset class. So CAS typically view cryptocurrency as a security, while the Commodity Futures Trading Commission calls Bitcoin a commodity, and the Treasury calls it a currency. So first of all, they need to be sure, and all of authorities should agree about how they regulate the crypto. And only after that we can start talking about the cryptocurrency infrastructure development.
We've mostly been talking about cryptocurrency. And there's a tendency to use cryptocurrency and digital assets sort of interchangeably, but they're kind of different. And Yael and Douglas, I wanted to bring you guys in here because so Yael, you're dealing with tokenization of real world assets, actual real estate. And so I'm curious about the fundamental difference between, custody of crypto assets, custody of security tokens, and custody of like real world assets. Yeah. And then Douglas, after that, I'd like to talk a little bit about where you see the market going in terms of NFT custody, because that's like the next hotspot.
Also, I have a question about the digital assets, but after Douglas will talk, I will ask that question because he's related with that market.
Okay.
Yeah, actually, what I was going to say is something like segue into what Douglas will say. And basically, the difference between the crypto assets that are not securities, right? Non-security tokens, whatever they may be, either cryptocurrencies, or they could be ERC20 tokens or other types of tokens that are used in different systems. So all of those non-security tokens, in terms of custody, they're different licensing requirements, generally dealing with securities broker-dealer as We've been actually, sorry, I have to backtrack. Yeah, so mainly security concerns, right? And if you are storing security as in cyber security, if you are custodying digital securities by the name of security, which is an instrument, a financial instrument, then there's different set of licensing involved and also different requirements, right? So I think that Douglas probably can talk more about those requirements, but basically that's the main difference. And sorry, just one more thing about a difference between securities and non-securities is that, when we're dealing with securities, it's usually representing real world assets. It could be somebody's real estate, and NFTs even representing your apartment and so on and so forth. So we have to create a new set of rules because, one must not lose their real estate, right, together with their keys. So there's definitely a difference there in terms of user experience, especially inexperienced users must not lose the real world assets. So there's different tech requirements and user experience requirements between the two. Yeah. And I'll leaving it to Douglas to explain what one needs to become or to custody digital securities.
Thank you, Yael. First of all, I'd say that people that say that there's uncertainty in the regulation are the ones that are in trouble with the regulators. And I'll say this because there's plenty of exchanges out there that trade crypto that, as Gensler said, are listing hundreds of tokens that they see as securities. And I think we would all see them as securities, guys that did ICOs, that raised money and just went at it. And now they say, oh, we didn't know. In 2018, when we put our prospectus into the SEC for the first time, and we did the first ever IPO of a full registered security on the blockchain, we listed every cryptocurrency except for XRP, because at the time we said XRP is a security. This wasn't a secret. We weren't the only ones thinking this. But you know what? Some exchanges were making 20% of their profits by having people trade XRP. They did pretty good on it. So they said, you know what? We'll just put the blinders on. But if you list Nike, a security on your platform, and you're not a registered broker dealer or ATS for digital assets, guess what? That's illegal. And if you looked at Coinbase's risk factors in their IPO, they said we may be in a little bit of trouble because we listed XRP and it maybe sees a security and maybe others. So I'd say that first of all, I know what a security is and what isn't. Guess what? If it's registered with the SEC as a full registered security like INEX, then that's a security. If it's an exempt security, a Reg D, Reg S, Reg A, guess what? That's a security. If it's not, well, unless someone from the NYDFS tells me that it's not a security and that it's just a cryptocurrency like Bitcoin or Ethereum, I'm probably not going to list it. Now, there's protocol tokens too. I'll probably list some of them because I can see that they are actually not securities. But there isn't really that much of a gray area. I think we can all point to a number of different coins that trade on different platforms and say these are securities. Now, having said that, there is a breakdown. I've got a crypto trading platform. For that, I need MT licenses in every single state all across the United States. And I have to get licenses in different countries as well. And then, but the custody of that's pretty simple. You don't need a qualified custodian to have Bitcoin and do custody of Bitcoin, which is why you have all these banks coming out there saying, hey, we'll custody Bitcoin. Even Fidelity will custody Bitcoin. But what they're not saying right now is we'll custody digital securities. That's because there's not really a qualified custodian out there. And so we came out there, we did the first ever IPO in the blockchain, full prospectus, INX Limited, did our IPO at 90 cents. I think today it's at $2.60. That would be the second best performing IPO in 2021. But then we went around to custodians, we went around to institutions who said, would you like to buy our security in our IPO? And they said, look, we'd love to, but it's not packaged in the right way. It's not packaged in the right way because we can't hold digital securities. We can hold currencies, commodities, fixed income, and equities. But we can't hold digital securities because it's not on any of our prospectuses. And there's no qualified custodian that could actually hold it for us. I said, well, that's not so good. So then we went out and we talked to folks like MetaMask, who just came out with like MetaMask Institutional. It sounds very much like the Copper solution as well, where institutions are finding a way where they can custody things themselves because there are no qualified custodians out there for these types of digital assets. Now, but people only worry about the custody issue if they're worried about losing their keys, for example, or something that they're always told you need a custodian. But if you actually package the security in such a way that it can't get lost or stolen, then the whole question of custody becomes sort of like null and void. I believe in the next 2 years on my phone, I'll have a MetaMask wallet or something very similar that's going to hold my NFTs of my driver's license, my COVID vaccination, my passport, and they'll be sitting there. I'll have my cryptocurrency on there as well, digital currencies in the dollar and GN or in Bitcoin, Ethereum, whatever, all on my phone. And I'll probably also have my securities in digital format on my phone, and I'll actually do the custody myself. And I'll know who stole it because I'll be able to go on Etherscan and see, oh, look, it was this wallet here. Let me call up the issuer and they'll tell me who stole it. And law enforcement's going to go there, knock on the guy's door and bang him on the head. And I think that that's something that we spent 950 days with the SEC really going over this, and that we had to make sure that if there was no custodian, how can you guarantee that someone can't lose, as Yael says, your real estate in a boating accident? Well, you put it on an ERC 1404 token and it's not going to happen. And so how you package something could be in such a way where the custody becomes less of an issue. And custodian, if you talk to anyone, by the way, the average age of people that bought in our IPO was 42 years old. And so it's not just young guys that are getting into digital securities. It's sort of like, it's a broad spectrum of the US and internationally. But I would say this, that if you can package something in such a way that the younger folk these days that are trading Bitcoin, Ethereum, all the other stuff, they've got no idea who Fidelity is or Morgan Stanley or E-Trade, because they're buying on selling all this stuff and they're essentially holding it on their cell phone. So to them, this is custody. And the guys that are going to be getting all of this baby boomer wealth, the baby boomers, they want custody of Fidelity, but their kids and their grandkids couldn't care less about Fidelity and custody.
All right, I want to bring Glenn in on this one, because Glenn, are you about to be out of a job, or is what you do as a custody firm, is it going to have to evolve and change to meet the needs of new consumers?
Look, Douglas is absolutely right, but he's approaching it from his market, and that's totally understandable, right? It's a very different ballgame when you manage institutional money on behalf of other clients. When you're managing other people's money, you don't have that choice, at least not as defined by traditional financial regulations or best practices, even in digital assets or crypto, right? Look, if I'm an individual investor and I buy something on Robinhood or Voyager or anything like that, yeah, I'm pretty happy with a non-custodial arrangement because it's my money and I can choose what to do with it. I can still download it, my assets onto a ledger or a Trezor or any hardware device I want to. That's perfectly within my choice. Institutional investors and those especially managing other people's money don't have that choice, right? So what they need is something to say, look, I'm going to date myself, and it may not play to all the audience, but they want to protect themselves against fraud, against hack, against someone pulling a Bernie Madoff and making off with their stuff. And, if that's the case, there's always going to be a place for custody in the institutional market. Will it evolve over time? Absolutely. Will it change the dynamics? For sure. But right now, the biggest thing that institutions worry about is tail risk of hack, theft, and fraud. And the custodians out there with the best technology and the best architecture are best placed to safekeep those assets in the best way possible.
Well, can they do all that while still kind of, maintaining access to their keys? And what are the trade-offs to that?
Yeah, of course they can do that, right? I mean, Copper, for example, has a unique process where we actually avoid single points of failure, whether at the custody level or at the client level. We use MPC technology to shard keys, but we require that 3 different entities have possession of each of the 3 pieces or the shards of the key, right? So what does that mean? That means if Copper were to get hacked, it's not a great outcome, but the hacker only gets 1 shard and does not have control of those digital assets because you need at least 2 to sign and verify a transaction. Same thing for a client. I mean, wouldn't it be great to be able to go to your investor base or your client base and go, hey, guess what? If someone hacks into me and I'm a big asset manager and I've got this huge pool of assets that are, obviously targets for hacking, But if they break through my firewall and my security protocols, they still don't get your assets, right? That's a pretty powerful message.
Yeah.
Right. And so, you're talking to a guy that went through the Lehman bankruptcy. And what we are at Copper are trying to do is basically even evolve custody itself to mean more about how can we best safekeep assets on behalf of institutional customers in a way that might even be better than that's deployed by traditional finance. And so we're pretty excited about that. And yes, I agree that the market will evolve. It will not stay the same because that's just the way that crypto and digital assets go. And as the new global economy evolves, we will evolve with it.
I want to kind of clarify. Sorry.
You can build a really safe hen house, but if you make a chicken that can't be stolen,
right?
Who cares about the safe hen house?
Look, what? That's not for me to decide. That's for the market to decide. And the market, the market has decided that there are multiple ways to safekeep assets. And there's also, as you pointed out on the regulatory side, there are very required ways to safekeep assets. Until that changes, we're in pretty good shape, I think.
I want to kind of clarify something that Glenn said and maybe add to it in terms of MPC, for example, multi-party computation, where you're not storing the keys anywhere. Technically, they're kind of pieces of keys in different places, and then they're connected into one. And other solutions that are similar, they found that the combination of cold storage, cold wallets and hardware wallets works best for security, and for hot wallets for even though multi-sig solutions exist, a lot of times they're not scalable or usable by individual investors. So if you don't use custody, and you have your own money, like Glenn said, then that's something that could be usable and so on and so forth. But if you're managing other people's money, definitely custody offers a lot more in terms of security. But from what Douglas said about having an asset that can be stolen, I think that there could be some technological innovations that embed security actually in the asset itself. So I think that that's something that will be developing within the next 2-3 years, probably rather rapidly, is to make an asset that cannot be stolen. Why can't we put MPC inside the token? So there are different things that I think could be done, and we're going to see in the market.
So Brian, when folks are coming in and you're setting up, you're putting investors into crypto assets, how does that conversation start? And what are they telling you that they want? And how does that conversation then end? How does it evolve?
So it depends. First of all, Doug, it sounds like your lawyers made a killing. So I'm sorry that wasn't us. But it depends on what the end goal is, right? Usually there's a friction point between safety and functionality. Clients usually come to us and they say, we have a new token. We're minting it now. We want to sell it to as many people as possible. We don't want restrictions, and we want to list it on Uniswap and SushiSwap. We want it to people to be able to earn yield and borrow against it and provide liquidity. The world today is different than it was 2 or 3 years ago because of all the enforcement cases. Everyone's on notice that if you take the view that something's not a security, you better be really sure, and you better have a lot of backup and be willing to fight not just the SEC, but the CFTC and various states who have unlimited budget and unlimited time to go to war. And so most of the time what happens is there's a bifurcated model where an offshore entity will be developed somewhere. Currently it's BVI, but it was Cayman before. It's been other places, Mauritius. And there'll be an offering of tokens to non-US persons with which is in compliance with something called Reg S, the offshore offering exemption. And eventually the tokens could list or trade on an exchange with the applicable time periods expiring. When we talk to investors, I think the biggest issue is do they want a custodial solution or do they want one that's not, and how comfortable are they with the technology and with the ability to track value, to trade in and out, what's going to give them the best liquidity. And most of the time, just like what Glenn was explaining, they're not really in charge of what they can and can't do with the funds and the funds they're managing. If they're institutional investors, they're going to have specific trade mandates, and they're not going to be able to buy certain things. They're not going to be able to put the money into certain wallets or certain accounts where there isn't enough backup or asset support. So, it's really an interesting question. It's kind of, we have a one size fits one policy because everybody comes in with a different idea, different question, different set of challenges, and different rules. A lot of people do want to still do the blowout ICOs and, put us on that list of 100 where we're in a gray area. There's a great use case because we're using it in this game we're building, but most of the people buying this token are not gamers, are not going to play the game. That's a difficult set of facts.
All right, so we're coming to the end here, and it looks as though we need to start wrapping things up. So I was hoping to just do a quick rapid fire and do maybe 30 seconds each, explaining maybe one of the biggest misconceptions, or if you can't think of a misconception, a challenge for digital asset custodianship. Glenn, do you mind starting us off?
Yeah, sure. I mean, I think I'll echo some of the things that Doug and Brian mentioned, right? My biggest fear in the regulatory environment for custody is sort of what I see as a brewing war between the states and the federal government, right? Where you have jurisdictions that are well known, such as Wyoming and New York, coming out with their own regulatory environment in terms of banking licenses, trust licenses, BIT licenses, followed by, states like Texas and Nebraska. And, you still have the federal government sort of dragging their feet and deciding what, or if anything, they're going to do. Is it going to go SEC? Is it going to go to CFTC? Are they going to play nice in the sandbox? Should we actually create a digital assets commission of some sort? And so, I wonder on a daily basis how far the states will go. And is there a point of no return that's really just going to be pretty poor outcome for the U.S. compared to its global competitors?
Brian?
I think that there are a couple of things that are misunderstood. The DeFi world, which you alluded to before, where people are putting real world assets into NFTs and sending those into trusts or foundations, it is a world that a lot of people have faith in because the last 15 deals worked. But I do think it does need structure. When people are lending crypto out as a liquidity provider, that's not the same type of recourse that you have when you're actually lending somebody money in the real world. Somebody asked me if they could bring a lawsuit to sue for breach of a smart contract. There is no such court, right? This is unsecured finance, and the only reason it works is because it worked last time, and there's coercion of the structure of the system. That people don't want to get blacklisted or anything like that. But I think that the technology and the innovation is ahead of not only the regulation but a lot of the safeguards. We haven't heard the last of DEX regulation and whether these are securities or not from the broker-dealer FINRA perspective. We haven't heard whether a company that lends out tokens needs a lending license. These are things that I worry about and, questions that we deal with a lot.
Yeah.
So two things. Number one, something we already mentioned, the trade-off between usability and security. On the one hand, you don't want to burden your users with cold storage and wallets and, things like that. On the other hand, you want to give them the best user experience possible. And I think that's just a general cybersecurity dilemma. But another issue that we haven't talked about is actually the liability. I'll give an example. A while ago, Fireblocks was sued by some sort of a gaming or a staking firm that lost $75 million. In a hacking accident. So who's to blame, right? So they blame Fireblocks as their provider But in reality, I think that court case was tossed out by the judge because they've done something that their custodian didn't recommend, and on their end, on the front end, that's where they actually lost the assets, right? So I think that there's still a lot of jerry rigging in terms of insurance, third-party liability, and things like that in this industry, especially where integrations occur. So that I think is going to become even bigger challenge because there's so many different applications now. You have lending and borrowing, you have staking, you have all kinds of new financial instruments, derivatives, ETFs, indices, stuff like that. So that's something we have to watch out for.
And then real quickly, Oleg and then Douglas.
Yeah, hi. The first of all, like my concern that is like regulator can I'll explain a little bit more about ourselves, what we are doing right now. We're in the middle of the process to sell the equity of some edtech company in our country. So we're working with the regulator right now, and I'm concerned about how they offer to work with the equity tokens. So we would like to sell the equity tokens and allow to people transfer the tokens more easily between each other to create more fuel for economy. So we would like to make the transactions faster, but the regulators say to us that we need to work with those kind of tokens, like with the securities. And I'm really concerned about if they stop that process in the middle when they don't allow to companies to give possibility to send the tokens easily between their clients. And they say to us that we need to issue that token on private blockchain, but there is no trustability to that token if we issue it on the private blockchain. So this is also my question, if we will have time, and maybe somebody have an answer on that question, if the regulator if there is any possibility that regulator gives the possibility to issue that kind of token on public blockchains and allow to people to send it between each other easily.
Right. So we're wrapping up. So that's going to be a hanging question for after the panel. But Douglas, can you take us away with the last word?
I'll give you a quick one. I said in plain sight on the Edgar database, you look up INX Limited, and you'll find out that actually regulators have given a point of view. The point of view is they haven't ruled on whether there's a qualified custodian yet, because they don't have to, because what they have ruled on is the only registered public security that's on the blockchain, which is INX Limited. And they said that it's because of the ERC 1404 that we're on that essentially made it so safe that you don't need a qualified custodian to hold it. And we've got lots of institutions holding us. We've got 8,050 holders of our security token. And it's because we've made the chicken so safe that it doesn't really matter what the chicken coop and how safe the chicken coop is.
All right.
I think it's changing. It's changing where it's going to be on a self-custodian basis. Smart contracts will make it such that your security token will be so safe it's unstealable.
All right. Glenn Barber, Douglas Borthwick, Yael Tamar, Oleg Kurchenko, and Brian Korn, thank you so much.
Thank you very much.
Jeff.
Thank you.
Thank you.
Bye.
Next up, fractionalizing real estate assets and really maximizing the benefits of commercial real estate investing. A huge pool to get into and on a global scale. So let's take a look at what is in store. And joining us to host the conversation is Accru keynote presentation by Accru founder and CEO Moshe Massoud.
Good evening, ladies and gentlemen. Thanks so much for having Accru present at the LA Blockchain Summit. We really appreciate Draper, Goren, Holm having us here. My name is Moshe Massoud, and I'm the founder and CEO for Accru. Accru was launched last year right after the LA Blockchain Summit. I was at a panel where I was talking about how we were about to launch the company, and it was under a different brand name. Since then, we've gone long ways, and we've developed a product where we've got great traction. We've got lots and lots of investors and assets on the platform, and people taking full benefit of how the platform works. I'm going to walk you through where we've been, what our journey's been, and how we're affecting commercial real estate and what really Accrue is doing. So Accrue, our mission is to democratize commercial real estate investing. What I've told you about so far about myself is I'm just the founder and CEO. But one thing that I have not told you is my background is purely real estate. It's not technology. I am not a tech expert who's come together to build this platform or who's putting all the energy in this. I've lived and breathed real estate all of my life. I grew up in a real estate family in Islamabad, Pakistan. Went to York University for my undergrad, managed our family's real estate investments globally. We had investments in Asia, Africa, Europe, Middle East, and I expanded that into the US. Set up my own shop, syndicated deals, and had over close to $100 million of assets under management before I had an aha moment where someone was explaining to me what blockchain really is. At this point, it is very key, the differentiation that we created between blockchain and cryptocurrencies. That's a big aspect. All blockchain is not equal to cryptocurrency. Crypto is a subset of blockchain, is our core belief. And we really believe in using blockchain as the underlying technology. What everyone's been talking about today, what people were talking about on the previous panel, what Doug talked about at the end, with every digital asset being self-custody because of how smart contracts are built and how smart contracts are done. Just like INX has developed using the ERC 1404 standard, that's how Accrue went ahead and developed a multi-token architecture. What we did is we created security tokens representing investment within a single direct asset. We created utility tokens representing funds, your funds, sitting in a bank account, a licensed bank account, which is secure and at your disposal. We created an identity token that helps us ensure compliance. We know we can ensure for the regulators the full KYC, the accreditation verification, AML and transaction monitoring, the whole 9 yards. And we created a governance token. Now, this is not your traditional crypto governance token. This is very focused towards the governance of each specific asset. Real estate requires decision-making by all members on the asset level. And that's what our governance token is there for. It lets us decide who's allowed to vote on which matter, up to what extent, based on their holdings and based on their level of investment. So what did Accrue develop? Accrue created a platform for fractional real estate investing with investments as low as $1,000 per token. Unheard of before. Now there's others that offer lower minimums, but they don't offer the flexibility and the liquidity that we enable. We created a secondary marketplace, which is all fully integrated, all into one single dashboard. And that is how we're democratizing commercial real estate. Next, I'll show you what kind of attention we've gotten so far. And we've grown quite a bit since we launched. So we formally launched as Accrue at the Security Token Summit earlier this year, March 25th. Since then, we've had over $750,000 worth of tokens transacted on the platform. Over 150 active accredited investors on the platform. We've got more than 1,500 non-accredited investors on our wait list. As soon as we open up the platform to retail investors, we have a massive list of people ready to join in and move forward. We've got 14 assets that are confirmed for the platform. 3 of them already listed, fully funded, or raising money for right now. There's 11 more coming real soon, all either demonstrating opportunity zone assets or direct investments, stable cash flows, giving you quarterly distributions in the form of rental income, and all the stability and growth that you need. Most importantly, we've got funds sitting on the platform with investors waiting to invest as every deal comes on board. And while we've done all of that, it hasn't gone unnoticed. Every big media outlet out there has noticed what we've been doing within the industry, and we really appreciate all of that. This is how Accrue functions.
We use technology to cut out the middlemen, management layers, and portfolio downside risk to provide lucrative and secure direct investments. Accrue.
Not sure if you guys caught the audio on that. We might have faced some kind of technical issues on that front. But let's hopefully we'll catch the audio in the future ones. What are the key benefits of tokenizing assets? There's two sides to this marketplace. There's the investors and there's the asset owners. You have the institutional investors and the individual investors. You have the institution asset owners and the individual asset owners. Single biggest benefit is direct investments into assets of your choice as an investor. You can maximize your returns as we eliminate all the costly intermediaries within the transaction. Liquidity at your fingertips. We're truly enabling liquidity where you can list tokens as you want and people can place offers on it and you can sell them as soon as there's a buyer who's willing to buy them at the price you want. That's instantaneous transaction the minute that the match happens. We've got the security of a public blockchain. The investment threshold is down to just $1,000. Imagine that. $1,000 that you have sitting in your savings account could start help you building your wealth from one security token to the next. And investing is as simple as a click. This does not happen anywhere else. With a single click, you can go ahead and you can purchase your security tokens just like you would within your capital markets, your Fidelity accounts, or your Robinhood account. On the asset owner side, there's multitude of benefits. Some of the key benefits include asset owners are able to recapture gains that they're not previously able to, unless they go for that 10-year cycle on refinancing an asset, or they completely sell the asset. They get to retain full control of the asset, even after fractionalizing it. And the true value of the asset gets unlocked. Now, you have to realize, when talking about commercial real estate and valuations of commercial real estate, the biggest factor affecting and bringing down the value of the asset is the discount on marketability of an asset. And on large scale or institutional commercial assets, that really plays a major factor. Now, what happens is when we're moving the asset from a private market to a semi-public market of sorts, when we're allowing for that liquidity and when we're enabling that liquidity, when we're letting you transact those tokens, we're actually unlocking that true value. We're getting you closer and closer to that true value of that asset. And what we like to call is we're adding a liquidity premium on the value, on the market value of that asset. Tokenization or fractionalization of the asset allows for a permanent capital structure. As an asset owner, you never have to worry about redemptions. You never have to worry about that capital structure moving around. Compliance and investor management are always an issue. You know, I've gotten phone calls when I was doing real estate from some of my investors. Why did you make that $100,000 upgrade to that building? My brother-in-law could have done it for $50,000. Well, not really. Is he in the Ohio market? No. Is he a commercial contractor or is he a residential contractor? He's a residential contractor. Well, there we go. It's a completely different ballgame. You never have to deal with anything like that ever again. It all happens through a single portal. And then reporting, year-end, documents going out, all of that is such a hassle. And those quarterly distributions or semi-annual distributions that asset owners have to do, well, it all happens with a single click, just like investing. So what kind of assets do we list on our platform? We're focused purely on core assets and some core plus assets. Some of you would be wondering what that means. That means stable assets which are income producing. We want to make sure that you get that quarterly rent check in your accrue account, quarter after quarter after quarter. We want to make sure that you have all the data available. And that's why those are the kind of assets we go after. We do bring on some value add assets on the platform currently as well. Those assets are going to be taking a very small chunk. Now we understand that everyone wants to make money on real estate. And we know HGTV and all these flipper channels have boasted the energy in us for, hey, we buy it, we fix it, and we sell it, be it a house or be it a building. But those are the riskiest deals out there. And so those are going to be the last to make their way on our platform. What's our expansion plan? The areas that we serve, we're currently serving the Midwest, so all Midwest and part of the mountain area. So all the areas that you see in the green. Up next, we're going to go in the South and the Sun Belt. Followed by that, we'll be going opening up the platform to the coast. And guess what? We don't just stop there. We intend on going global. Over the next 3 years, we intend on launching not just across the US, but also across the European Union, including the UK, LATAM, as well as Asia. We've got some great new features. You know what? A platform is only as good, or an app or anything is only as good as the features it has and as the happy customers that they have. Not only have we already brought on board our premium accounts, allowing for investors to make larger allocations, but we've also allowed for investors to create multiple entities under the same account. Whether you want to create a joint account with your kids or your wife or your partner, or you want to create a trust account, or you want to just invest through multiple different entities for whatever reason it may be. You can do all of that and make all those allocations the way you want. Now, a lot of us rely on our financial advisors and wealth managers to make investments on our behalf. We have our savings and our investment portfolios managed by someone else. And we listen to what you had to say. We created a wealth manager's portfolio. We allow your advisors and your wealth managers to create and onboard you as a customer on our platform and make investments from your part. We provide all the risk analysis tools needed for that. And guess what? Everyone wants to maximize leverage when investing in real estate. We completely understand that. We don't want you to be left out of that. That's not just something there for the top 1%. That's why we brought on some great banking partners and great lenders on the platform. And we're going to be launching our margin trading on our platform here within the next quarter. What that's going to let you do is you would not only have to sell your token or sell your piece of the asset to get some kind of liquidity. You could borrow up to 50, even 60% in some cases on some of these assets, and you could really maximize your returns and realize the gains that you have and access to liquidity. And we're only as good as the partners who we have. And we're proud to say we've got some great partners from the industry, some industry leaders who are providing all the data, the information, the financial backgrounds, and the security of your funds. Data is something that is only as good as the integrity that's behind it. So we've partnered up with Inventing, which is the single source of truth for all of our data. Not only do they verify the data, they also record it on chain. So you can always see if there's ever been a change in that data, who made it and under what circumstances. We use Dwella as our payment partner. Compliance is key, whether you're talking about KYC, know your customer, anti-money laundering monitoring, accreditation verification, all of that is absolutely integral. And most importantly, managing broker-dealers in the case of offering securities, or unregistered securities for that matter. So we partnered up with MBD Solutions for managing broker-dealer. We partnered up with Accurate, global leader in providing KYC and AML monitoring for larger financial institutions. We partnered up with Early IQ for providing accreditation verification for us. And guess what? You don't have to only invest your savings or your IRA dollars in your mutual funds and your bonds. Those are not the safest or the only safe investments out there. You can actually invest them through a self-directed IRA in real estate, no matter how big or how small an investment you want to make. It's not just something for larger IRA holders. We've partnered up with Auto IRA to enable investors on our platform to utilize their IRA dollars and allocate a part of it in fractionalized commercial real estate. So now with that $50,000, you don't have to buy that just one asset that you could allocate into. You can actually invest in 50 different assets if you really wanted to. We're lucky to have great investors, just like the producers of this summit. Draper, Goren, Holm has been our lead investor for our seed round, and we've got some other great investors from across the country. Milwaukee Venture Partners, Wisconsin Investment Partners, and Queen City Angels are some of our largest investors. Here's a short clip to tell you how you can get started with the crew.
Complicated? A crew lets you focus on what is really important. Life. Invest in premium commercial real estate for as low as $1,000 without hassle and worry. A crew, making the exclusive inclusive.
So that's exactly it. We're here to make the exclusive inclusive. We want to make sure that everyone has access to this investing class, which previously they did not have. We want to make sure that everyone across the globe, everyone across the U.S. has equal opportunity, and everyone's able to invest in commercial real estate. Having said that, we're only open to accredited investors at this time, and we're working diligently with the regulators to open it up to retail investors. Thank you so much, and we couldn't have done this without all of our partners, our investors, and everyone here at Team of Crew. Thank you once again. My name is Mohsen Masood. I'm the founder and CEO for the Crew. If you want to get a hold of us, feel free to call us, reach me by email, or contact us on our website, www.acrew.co. Thank you.
Boom. Very interesting conversation there. Now next up we have Crypto Babes Ashley Wright to explore just how blockchain technology is able to ensure a more sustainable future with her panel of experts. This is one I've been looking forward to, and let's see what's up next. Let's see what they have to say.
Awesome. Welcome everybody. I'm super excited for this conversation. I've literally been waiting all day to be able to jump into this and be able to, of course, be with this amazing panel. So welcome everybody. Today we are going to be talking about how we can actually leverage blockchain for a more sustainable future. So it is going to be very interesting, and I'm very excited to dive in. For those that are hearing my voice for the first time, yes, my name is Ashley Wright. I am an entrepreneur as well as one of Canada's top women cryptocurrency educators. And so I'm really excited to dive in. But before we do, I also want to give a chance for our amazing panelists to also introduce themselves. So let's start and go ahead with Mark. Welcome, Mark.
Hi, everyone. My name is Mark Cranack. I'm one of the founders of Acrew Capital. We do early and growth investing in a range of different industries, all of which would intersect with blockchain and Web 3.0 in interesting ways. We're focused on security, fintech, data platforms, and consumer. And we've been investing in blockchain since around 2017. A couple of notable investments. I led an investment in Trace, which recently was in the news, got acquired by MasterCard. And a couple other projects like Scale and Definity, more recently BlockFi and Avant-Garde Finance. So that's me.
Awesome. Thank you so much. I'm going to pass it over to Austin. Welcome, Austin.
Hey, Ashley and everybody else. Great to be here. And big thanks to Draper, Goren, Holm for hosting us, and all the sponsors and speakers that made this possible. It's been a great couple of days. So a quick snapshot on me and then pass it along. So I am the co-founder of Community Electricity, which is all about decarbonizing cities at scale, benefiting the community first, and reducing the carbon footprint overall. So I'll get into that during the panel. I'm also a co-founder of some other technology ventures. So I've been in the blockchain space for a long time. Actually been working with Draper, Goren, Holm over the years. Saw Josef recently in Dubai, and really big supporter of the team. So I'm excited to be here and great to chat with everybody.
Thank you so much. We're definitely excited to have you. I also see we have Dr. Vin. Welcome. How are you?
I'm good. Thanks, Ashley, for having me here. Thank you, everyone, for taking time to join this panel as well. And I would like to introduce myself as a serial entrepreneur. So I've been into the tech business for the last 15 years. And since 2015, I've been working on blockchain and trying to create an ecosystem, which includes exchange, some of the DeFi projects, some of the funds, etc. And recently, the exchange business, we went public in last July in one of the OTC markets in US. So yeah, so that's my background, and we are trying to enhance our base by providing a lot of activities around sustainability area, especially working very closely with the UN SDGs Blockchain for Impact initiative. So since 2016, we have been trying to create how blockchain or Web 3.0 can create impact on the UN SDG goals.
That's amazing. I'm actually really excited to dive into that as well. So thank you so much. I see we also have Alex. Welcome, Alex.
Hey, how's it going, Ashley, Austin, Mark, Chantal, Dr. Vin? Great seeing you. My name is Alex Nascimento. I do two things. I run a blockchain investment company and advisory called 7cc Blockchain Investments, which we've been working on the field since 2016. And I co-founded the UCLA Blockchain Lab, which is now Blockchain at UCLA, where we teach students across campus about the different applications of blockchain. My personal focus as an academic is on security tokens. Shameless plug, we wrote a book called The STO Financial Revolution. And that's a little bit about me.
Get it on Amazon.
Yeah, get on all proceeds go to UCLA.
Perfect. Definitely, we check that out for sure. And of course, we also have Chantal. Welcome. How are you?
I'm well. How are you?
Excited, definitely.
Yeah. Thank you so much, Ashley, for having me, and Draper, Goren, Holm as well. I'm very excited to be speaking with all of you and just saying hi to everyone. So my background is from blockchain technology and actually GIS and tracking from the University of Waterloo. A couple of years back, I founded Crown Bits Rewards, which is my company, and I'm also the CEO of it. So our focus is mainly, it's a digital rewards platform. So we focus on rewards for shopping for consumers, but at the same time, we also offer out payment processing for businesses and consumers as well when they shop on merchant sites.
I love that. That's really, really exciting. And I also have to shout out, you're also from Toronto, which I am as well.
I am, yes, Toronto.
Yes, definitely, definitely. But yes, everyone, thank you so much for those amazing introductions. I'm really excited to dive in, hear a little bit more about your perspectives, of course, for today's conversation. So yes, being able to kind of dive in, of course, how we're able to leverage blockchain for a more sustainable future. Right. I want to take a step back, especially for those that are still really new to the blockchain space, maybe aren't too familiar with the technology. And really to start off by asking, what are some of the key characteristics when it comes to blockchain technology? And I'm going to kick this question off let's start with Alex.
I would say that you want a general overview of why blockchain is important. I think that it's more of a concept of embracing different players, right? So something we always go over in class is like the world as we know today has been a centralized environment where a few players control all the data and how the data transacts among different users in different industries. And I think that the thing that it's interesting about blockchain is this distributed ledger technology that allows multiple players to participate, right? And then by doing so, you bring all the buzzwords that we've been talking about for years: transparency, mutability, trustworthy, and participation of people that before didn't have a chance to participate. Great example, DeFi's.
Yes, Perfect. Thank you so much. I'm also going to pass it to Austin. If you wanted to add anything as well in terms of, some of the key characteristics that make, blockchain so unique.
Well, to bring it to the simplest level, I think that what Bitcoin did and what blockchain does is it allows people to have the world's greatest barter system, right? For peer-to-peer transactions, there's been no way better until now to do it. And going back as far as glass beads and shells, those became very easy to counterfeit and to trick people and trade them the wrong thing. But you can't do that with Bitcoin. You can't do that with any real crypto. Certainly you can scam somebody with an ICO and raise something that false promises. But with any real cryptographic transaction, it can't be defrauded. So I think what it did is it gave people the world's best barter system and the world's best time clock, and those two things are very important at the base levels of any transaction, any time stamping or logging of data. So yeah, I think it's pretty important, and it's what got me excited in the early days, and it's why 90% plus of everything I do is related to blockchain. I'm a startup guy at heart. I like building companies, and most of them are in this world. So yeah, very important, I think, for humanity. It's a piece of the tech stack that kind of leapfrogs us, just like the phone did, the computer did, cars did, the mobile wave, all that stuff. I think the crypto is a kind of another leapfrog moment for us as humanity.
Yes, I definitely agree with you. And I think majority of people, they hear about cryptocurrency and they think that's the only application, but that's literally just one, right? There's so many different applications to it. So, as you start to think about, of course, today's topic and sustainability, what does sustainability really mean? I want to break that down first as well. So let's kick it off to Dr. Vin. Would love to hear from you.
See, basically, if you look at any other centralized activity, there have been a lot of influence about how the things needs to be done. But if you are talking about the decentralized activities or decentralized scenarios like blockchain or any of the cryptocurrencies or even apps, decentralized apps, so there are a lot of things which is managed on a democratic level. There is no central agencies are included, so you can create a lot of sustainable activities around this technology and you can roll out together. For example, just to give you some initiative, in 2016, we created this initiative called Blockchain for Impact with the support of Public Foundation and UN SDGs. What we were trying to do is trying to create all the blockchain service providers or potentially those who were at that time active in the ecosystem, try to create impact and leveraging the 17 Sustainable Development Goals of UN and how we can, as a blockchain initiative or as a blockchain entity, how we can deploy these and achieve the UN's goal of 2030, achieving all the 17 goals. So how we can contribute as a ecosystem, as a blockchain ecosystem. So we have created a lot of initiatives around that. That also includes like Web 3.0 blockchain-based application, where one of the groups from Asia came out with providing education, insurance, healthcare insurance, medical and health for free. So that is right now, they're doing pretty well and they're providing almost 2 million users, literally medical and health insurance for free. That is achievable because blockchain as an underlying technology, trying to understand the data insights which they are receiving from the policyholders and giving them credits in terms of tokenization, that the token economics comes into the picture, and that credits can buy you into or redeem for your insurance policy, premium renewals, etc. So these are the activities where the real usage of blockchain can come into. So we are also understanding that there is another education, blockchain for education also coming in. So yeah, so that's what sustainability for us. Blockchain as a technology, how we can add value to it.
Perfect. I love that. And I'm so happy you also gave some examples as well so we can really get an idea of what that looks like. I also want to pass it to Chantel to also share, what does sustainability really mean and what does that look like currently?
Yeah, I mean, I think that blockchain has proven its way throughout the years to really show examples of how we can use this incredible technology. And for instance, like if I wanted to get money to China tomorrow, I'm not going to go through a bank. I'm going to be using Bitcoin or some sort of cryptocurrency, right? So I think it's really been helpful to a lot of different industries in a lot of different ways. And it's only getting more and more innovative as we go on, because we're figuring out new ways of using it, new implementations of it. So I think that it really has potential to be even bigger than what it is right now.
Yes, I definitely agree with you. I think there's a lot definitely that can definitely be done in the future for sure. And I think there's a lot of potential. Mark, did you also want to add to that as well?
I mean, I think you have to think about it in both ways. What does its energy usage look like, and how are those equations changing? And I think early days wasn't that great. Proof of work is very power hungry, but I think it's actually, in my view, kind of counterintuitively, it's had a really positive impact in some ways. There's a few companies out there that are finding ways to find really non-traditional sources of energy that might be wasteful, like gas flaring. There's a company called Crusoe Energy that's going and putting facilities where otherwise gas would get flared, so probably creating more greenhouse gas, still burning the gas, but using it to mine Bitcoin and maybe other protocols. So I think that is a really unique sort of turn on the tables on energy usage. But then I think what a lot of other people are talking about is the potential to align incentives around the new use cases, whether those are supply chain use cases or energy use cases or what have you, is really, really amazing. And so you can think about changing the way people think about sustainability because you can incent them differently. And I think that's really where the potential for blockchain kind of globally essentially lies, in my view.
I love that. You actually said something really key that I actually want to elaborate on a little bit, which is talking about some of those use cases, right? So even when we start thinking about sustainability and what the current structure looks like, what are some of the current problems that we're facing right now in some of those different industries that you just mentioned?
Well, I think energy the consumption of energy for mining is one that I think is getting addressed pretty well, and it just comes down to proof of work. Another approach to that is to change from proof of work to other consensus protocols, and there are a bunch out there that are competing. I think probably proof of stake will show up on Ethereum soon, and a bunch of other protocols that will make the energy consumption a lot lower, which will help on that particular thing quite a bit. I actually think also another great use case for blockchain that's still pretty early days is supply chain. There's all kinds of supply chain problems in the world today, partially I think caused by COVID and partially caused by other breakdowns in the system. There's a big opportunity to manage that better and optimize the usage of resources. And ultimately, when you do that, you're probably working towards something more sustainable.
I definitely agree with you. I also want to pass it over to Austin to kind of share, some examples of some other, problems that we're also facing right now that, blockchain could actually solve.
Sure, yeah, and just touching on kind of something Mark, sparked in my brain really quick regarding sustainability. I think in our modern world, sustainability is using technology to make our systems more efficient, right? Our energy systems, our networks, everything that we do in our daily lives, because most people aren't going to go live in a village. Like, that's true sustainability, living off the land, not polluting at all, but most people don't live that way in the modern world. So, in the early days, coal was, what started the earliest industrial revolutions. And then we realized actually crude oil is more efficient at storing energy and transferring it around the world than coal. And then ultimately gasoline, which you mentioned, is still flared off in some situations if it's too far out or unusable to some degree, was predominantly flared off overall until they realized they could use it for cars. It was a very efficient fuel for cars and other systems like that. So I think sustainability in our modern world is using technology to keep advancing and making our systems, reducing the carbon footprint. So one of the ways that I'm, focusing on that in the real world is we received and working with the California Energy Commission, a large grant for a 28,000 resident community in East Los Angeles called Basset Avocado. So you can see that on our website and everything. And there's a team currently, Felipe and others are in Glasgow at the COP26 announcing a lot of amazing things working with Global Carbon Parks, which we can touch on later. But in Los Angeles, the 28,000 resident community is the largest advanced energy community of its kind, using blockchain to create an efficiently managed network that gives people incentives. So full disclosure, I'm also a co-founder of CrownBits Rewards with Chantel. So we're going to be integrating some of those reward systems into these communities to really, I mean, that's how the world works. If you give people value and an upside, they will do the things that align with that, behavior. If there's no upside, people are going to keep polluting and doing the bad things that we're currently doing. But I think we're obviously in a conscious shift overall, especially with what happened the past couple of years and what we saw the impact of what happens if traffic stops for a day or a month or a year and flights slow down. It has a big impact, but it doesn't have to stop. It just needs to get more efficient. So yeah, I think that's one of the biggest ways, is creating these types of communities, learning from them, because they're not perfect from day one, and they are subsidized, luckily. So by the government, people have to opt in though, right? Like, we have to do a lot of community outreach to get people to participate in these programs. Can't force people to do it, but the incentive parts are really the most interesting things to the people and to the big companies, right? Because all these big companies are traditionally buying carbon credits, but what if there's better ways to do it than just buying and greenwashing and kind of slipping it under the rug? Like, actually create communities from the bottom up that are decarbonized from day one. So I think that's what we're going to start to see all around the world.
Yes, I am very, very, very excited about that. I think you touched on quite a few different points for sure, especially when it comes to the energy aspect there. You definitely said it perfectly, right? There has to be some sort of incentive to get people to want to move, which I'm happy that you, of course, are also collaborating with Chantel, because I think there's a lot of opportunities there to get people to actually focus on it, to actually care enough to want to make a change, right? So I think that's really, really crucial. I also would love to hear from Alex as well in terms of, what are some examples of some of the problems as well that we're facing right now when it comes to sustainability?
Well, I think that one of the key things that you have with sustainability is really validation of what's being done, right? So carbon credits generation, there's about like 3,000 different carbon credits. How do you validate those 3,000 different types of assets, right, in this new asset class? Where are they being generated? How are they being treated? How are they being negotiated? So as we roll into this first era of ESG, widely supported by the Biden administration, I think that blockchain, especially into carbon credits, is going to be a very elegant solution on how to create an order for a new asset class that it's frankly very scattered.
Definitely. Yes, definitely agree with that as well. And kind of leaning towards my next question, actually, and I know Austin touched on it a little bit, which is, how do we get, businesses as well as millennials to actually be encouraged to decrease, their carbon footprint, right? How can we have, once again, some sort of incentive or get them motivated to do so? And I'm actually going to pass this question over to Dr. Vin. Would love to hear from you.
So basically, for all of us, right, especially when you see the new generation, crypto, Bitcoin is becoming sort of like the in thing, right? So deploying the motto, the ESG sustainability or the creating impact motto via cryptocurrency or via blockchain, creating some sort of an impact token, so someone to give more incentives to be part of these cool things and to use blockchain as the core medium for any kind of transactions activities. I think that's the best way for getting millennials to access. And if you look at it right now in terms of the wallet numbers or the adoption rate, they are the one who is actually leading the race. So I believe that putting that into the the same lingo and putting that into the same kind of high level, I think we can achieve that.
I love that. I love that so much. Thank you so much for sharing that. I also do want to pass it over to Chantel, because of course you mentioned rewards. We'd love for you to kind of dig in a little bit deeper and explain exactly how you are, creating that incentives for individuals to really be more encouraged to do so.
Oh yeah, so I mean, and that's exactly what we do. We're on the business end as well as the consumer end. So mainly what our focus is making it very easy with users, like consumers, to already use the habits that they have, businesses that have already a process and operations in place. We want to incentivize those to make it more sustainable for them. So how you do that is you incentivize it, right? You're incentivizing it with rewards. You're incentivizing consumers to, let's say, purchase certain products that are green for their households, or for businesses, certain products to use that are more energy efficient, right? So that's how we're sort of establishing a rewards network around being sustainable for users, consumers, and also for businesses. So we really want to help each business in a variety of different industries on how they can become more sustainable and help them with their vision to be more green. So that's the key. That's the key to getting the millennials into becoming more green, to really get that message out there. And you got to really market it correctly, right? So we're working with a bunch of different environmentally friendly companies. For instance, just like community electricity right now. So we're really working together closely to figure out these solutions.
I love that. I'm definitely going to be looking into that some more, because I feel like that's perfect, right? When you have such a really great a lot of great incentives for people to want to purchase products that are more green, that are more, of course, sustainable, then that's beautiful, right? So I'm definitely excited about that as well. I would also love to hear from Mark as well. Of course, I know that you've been in this space as well. Would love to hear, what are some things maybe your organization is doing as well to be able to encourage and incentivize people as well.
Yeah, well, I think I think we're focusing a lot on what I would say seems kind of U.S. centric or maybe developed world centric. I think one of the things that blockchain offers is in other emerging economies, access to something that's a lot more like banking. There's a ton of unbanked population around the world, and a lot of times not having access to the financial ecosystem makes it so that you don't really have choices about whether to be more sustainable or not. I think one of the things blockchain has been doing in a lot of other economies outside of the developed world, it's giving people access to a financial infrastructure so that they can do things like save, where they may not have ever been able to do that before. They can participate in a payments ecosystem, and it changes their options. And I think it can really lift up some of those developing economies in ways that really haven't been available before. So I think that's a pretty exciting thing. So we invested in a number of organizations that are trying to do some of those things. Usually they're focused on remittances and payments, because those are probably the first really two early financial use cases for those markets. But it's a gateway into much more financial inclusion. And that's something I think can really, it's not directly talking to sustainability, but I think it indirectly can really make a meaningful difference in the world.
I love that. And you're touching on like the key areas of where we can actually start to see some of those results happen. So that is definitely really key. The other quick question that I have for you guys as well, as we start to dive in a little bit deeper, of course, we talked about a lot of great ways for us to incentivize a lot of people, but of course, it's going to take some time before we really start to see a really big impact, right? So my next question for everyone is, when can we actually start to see Bitcoin being leveraged in sustainability on a larger scale, right? To the point where we can actually start to see a little bit more of integration, a little bit more of an impact as well. So I'm going to kick this off and kick it over to Austin to start the conversation.
Sure, yeah. I mean, well, I think it's already happening is the answer. So first of all, I think Bitcoin gets a bad rap for its, proof of work intensity. But if you look at the economics, the money printing business and banking system of the world is much more inefficient than something like Bitcoin is on average. And Bitcoin is also the buyer of last resort. As Mark mentioned earlier, people are finding flared gas instead of burning it, using it to power mining operations, whether it's Bitcoin or any other crypto. Energy that's wasted in grids, energy that's not being used is typically what Bitcoin seeks out, because that's the most efficient way to mine it and get the most hash power to win the rewards. And most companies, Blockstream, all the big mining, RSK, all the big mining companies around the world in the pools are focused on, integrating sustainable mining practices. I've been involved with some solar mining operations in California in the past, and it is very economically incentivized to move in that direction. So I think, the future of Bitcoin mining is renewable. It'll never probably be 100% renewable until, well, I can say never say never, until the world is 100% renewable, then Bitcoin mining probably will be as well. So that's a good goal to have. But in the meantime, creating those incentive structures, as Chantal mentioned earlier, for the miners and the mining pools, and working with corporations around the world to find alternative solutions. So one of the things that the team that was just in Glasgow with Community Electricity and Global Carbon Parks announced was that I think it was, I forgot how many hectares, but it was a very large amount of land in Latin America that was basically set aside at the subnational level with contracts and agreements for the next decade at least, and ideally that'll just keep getting renewed to be kind of the lungs of the planet. And then those are going to be basically a new way to tokenize all that land and create a new type of standard or credit system that is measurable and that will never be developed in theory, right? That at least won't be developed for a very long time. I mean, because most of the biodiversity in the world is in Latin America. So the more we protect those forests, no matter what, the better as the lungs of the planet. So that's one way, it's one creative way that Global Carbon Parks team just announced at the UN summit in Glasgow yesterday, actually. So I think there's going to be all kinds of innovative systems like that are emerging and creating those incentive structures. And like I said before, instead of just buying carbon credits that are kind of produced from thin air, you've got measurable forests and measurable things around the world that can be surveyed 24/7 by satellite, and you can show that it's growing instead of shrinking, right? That's the most important thing. The wetlands are very important. I think you'll see wetland projects that will be becoming more and more a thing. Instead of building walls around cities, wetlands protect cities much better and help to sequester carbon and also help protect from hurricanes and things like that, for flooding, because flooding is the biggest problem from these big storms that we're seeing lately. For every 1 degree of Celsius of temperature rise, on Earth, you see about 7% on average more precipitation in the air, which means bigger hurricanes, bigger storms, bigger droughts on the flip side, bigger fires as well. So, the Earth's going to do what it wants to do, whether we, like it or not, but we shouldn't be fueling the fire at the very least. We should be doing our part to minimize our damage, which we haven't in the past 100 years, but now we're starting to turn the tide a little bit, and we have to. I think if we have 2 degrees in rise of temperature, I think the storms and the floods and the fires are going to get so bad, it's just going to be, look what happened in Australia a couple of years ago, right? And Australia, unfortunately, keeps getting public. Now they're all on lockdown and most people can't leave. So I think we're pretty fortunate in certain areas to be able to move around a little more. But yeah, I think definitely coming up with creative systems is the way forward.
I definitely agree with you. And I'm glad that you shared some of those amazing updates that you heard about from yesterday. But yes, being able to measure, our results and be able to measure a lot of that is what's really key. And that's how we're going to be able to actually track our growth and track our success with this, as well as our impact. So I'm really happy you brought that up as well. I also want to give it over to Alex to be able to add to that as well.
Yeah, no, I think that what you're going to see if you're talking about like integration of these Bitcoin mines, and I agree with Austin, if you look at the data shows that already 56% of Bitcoin mining is done through renewable energy or quasi-renewable, nuclear and hydro. And you also have other things, right, that is an evolution. You have geothermic energy, like in the case of El Salvador, that's now being used to mine Bitcoin. All the energy from renewable sources like solar or wind that cannot be stored are now being piped into Bitcoin. So we're seeing like Bitcoin, to your point, Ashley, becoming this like third evolution of Bitcoin, which now is a store of value of energy, right? So people that have energy or players that produce energy and that not necessarily can store that energy or sell it can now store it in Bitcoin. So I think it's an evolution of the asset class.
I love that. I love that very much. I do want to also give Dr. Vin a chance to add to that conversation as well.
Right. So maybe, I will just add to Austin and Alex comments on renewable energy and how the Bitcoin. So recently these, I'm quite surprised to see that, we have something called green coins coming up, and that actually fetching pretty much premium from the Bitcoin price, from the market rate, mark-to-market rate. What's happening is basically at least 98.5% renewable energy mined Bitcoins in the OTC market is actually categorized as green coins, and that is fetching a premium. So these kind of, and most of the funds like, private equities or the family offices who is actually focusing into ESG and impact in a big way, they really want to make sure that, they are investing into something which is more renewable or they are green. So these are the audience for these green coins. So I think that kind of initiative is actually making, creating that two classes within the Bitcoin mining part as well.
That's amazing. Thank you so much. I do want to say thank you to the panel. And I also want to be able to give you guys the opportunity to let the viewers know how can they connect with you, how can they hear and learn a little bit more about what you're working on as well. So I'll start with Mark.
You can find me online, LinkedIn, or at our website, acrecapital.com, and just get in touch with me there. Happy to hear from anybody.
Awesome. And what about yourself, Austin?
Yeah, best way for me is Twitter, AE Davis. Just shoot me a message there. Happy to connect anybody and talk about, doing some cool things together. And then websites, communityelectricity.io, and of course, Chantel's website, crownbits.io.
Perfect. I was actually just about to have her, of course, go ahead and share as well. Yeah. Go ahead, Chantel.
I was going to say LinkedIn for personally myself, just Chantel Borelli. And then, of course, the crownbits.io is the website.
Perfect. And go ahead, Alex, definitely let everybody know how they can connect with you.
Sure. So you can find me, Alex Nascimento, UCLA, on LinkedIn or Instagram, or our website is the same handle, 7CC Invest. Happy to continue the conversation in any of those platforms.
Perfect. And last but not least, Dr. Vin, feel free to, of course, share.
Yeah, so I'll be easily found in LinkedIn, Dr. Vin, or Twitter, say Leah, VIN.
Perfect. Thank you so much. And of course, you guys can connect with me through Instagram or any social medias at The Right Success. But nonetheless, I do want to thank all of you so much. You guys added so much value and really made this conversation super valuable. So I really appreciate that. And I want to say thank you everyone as well that's been tuning into this conversation. I hope this brought a lot of insight into how, of course, we can actually leverage blockchain to make a more sustainable future. So I look forward to connecting with all of you, and thanks everyone.
Thank you.
Thank you so much, Ashley. Thanks, everybody.
Okay, bye-bye.
Bye-bye.
Cheers.
A great panel discussion there. Now it's time for our next keynote of the day, Digital Marketers, the DMs you want to slide into, with Sam Yamut from Federal Reserve.
Hello, I'm Sam Yamut with Residual Token Incorporated on Federal Reserve, and I'm here to talk about digital markers for licensing software within our organization. To start off a little bit of an intro, the Federal Reserve, Residual Token Incorporated, is a fintech SaaS technology company. We are specializing in fintech software developments. The software utilizes blockchain and standard programming languages, tools, and databases to unlock efficiencies within financial services companies and lending markets. Our company and its affiliate operate in the decentralized finance, that's DeFi, fintech subsector. We empower centralized CeFi entities and democratize finance by allowing companies as well as individuals to be the bank. The company operates as a SaaS enterprise and is developing commercial-grade programs for the licensed to qualify entities. Now, let's get into the start a bit on where does a license come into play for Federal Reserve. Federal Reserve technology powers reserve funding. That is a traditional alternative investment marketplace for crypto holders. For this service and software, reserve funding pays a licensing fee to Federal Reserve. Reserve funding is a liquidity channel for underserved tribal banks, SMEs, non-bank lenders, as well as those that are in need of, who are underbanked in need of a more cost-effective source of capital. What it allows is retail crypto holders like you and myself to earn passive income without incurring a tax event. In order for me to traditionally invest in uncorrelated assets from Ethereum, I'd have to sell my crypto, which is a taxable event. Even if I'm just selling stable coins, I'd have to ACH it out and route it in to get traditional finance. Within our ecosystem, if you can see on the reserve funding diagram, it's as simple as clicking into a vault for the crypto user. So on Federal Reserve, we have provided rails into traditional investments with higher and non-Ethereum correlated returns. And these investments are the qualified entities licensing on Federal Reserve's software. So if you see within our vault right there, the initial one, Atipana, a non-bank lender, would be the licensee of those utilizing our software. We, as with other investments or defaults that have been made available through reserve funding, the investment vehicle is going to have to pay the licensing fee since they are getting access to new customers that come with our rails. Our rails are all fully regulatory compliant, AML, KYC. So we also pride ourselves on being one of the most regulatory compliant companies in this space. In inventing the procedures and technology to track active subscriptions, we can rightfully also claim to be inventors of another blockchain application. That is licensing as a service. Just through them executing their typical payment connected via Fireblock system, we have also Circle, Paxos, and Plaid. We leverage Chainlink oracles to aggregate the proper pricing data, and then we use Dune analytics to keep track of each licensee status. With that, we, the vault, are able to publicly show available and provide the customer a complete picture of the overall ecosystem. Now let's go back to how it all functions today. The granting of a license consists of 3 types of information. That is identity, payment, and term. The license grantor, aka the licensor, needs to know the identity of the person or entity using the good or service. The licensor also needs to know when the license fee has been paid, the payment, and how long for which it is good for. That is the term. Now, what is a licensing fee? The overall definition, the term licensing fee can be used in several contexts. It is also most commonly used to describe an amount of money paid to an entity for a certain right or ability. A licensing fee can be an amount of money paid to an individual or a business for the privilege of performing a certain service or engaging in a specific line of business. Licensing fees can be paid for trademarks, copyright, or patents, among many other things. And licensing fees can also cover different time spans or terms. Some lifetime licensees are one-time payments and provide limitless use of the application. Other licenses allow access for only a few days or hours of usage, namely in the form of ski resort lift tickets, a Disney day pass, or a parking pass. If you look at the diagram right here, you can see there are 4 parties involved in establishing a license. There's the licensee, who approves the payment to the licensee bank, who then sends the payment to the licensor bank, who then confirms the payment to the licensor, who then either approves or terminates access to licensee. So the licensee sends a store value, it's usually an ACH or wire, to the licensor, and separately the licensor stores identity information on a centralized data server to monitor and govern permissions. This is a very cumbersome system that can be greatly improved utilizing smart contract technology. In this case, we are using the ERSDL token as a digital marker to track identity, payment, and terms in one permission style token. So that's identity, payment, terms, and it's all in one token. The wallet that the token sits in is owned and governed by the licensor and not the licensee. This ensures that the licensee doesn't sell their access to the software to a non-compliant third party. However, existence of the token in the public space allows us to develop dashboards, tools, and utility that any holder of the licensing token can enjoy without risk of corrupting the token's original use case. Licensing fees lend themselves to digital markers. The beauty of smart contract language is its power to store identity and payment information and contractual agreement information, in this case, the term. 2 parties commit to what's in the code, and the cost of the license is reflected in the count and market price of that token at the time of the licensor's acquisition of that token. In essence, our code, which simply asks, does this licensee have ERSDL in their wallet? By the licensor buying the token out of the market and storing it on wallets designed for each licensee, we can track the first two pieces, that's identity and payment, in one place. One could then use the wallet itself to program the term of the license. In our case, if the licensor or vault or other product fails to provide a return through our pipes, once the ERSDL runs out of the wallet, the customer access to the vault ends and the licensor loses the acquisition and onboarding channel. The workflow is pretty easy to use. Rather than forcing our customers into buying a crypto token or wiring money to renew a subscription, our licensors perform business as usual. It's their normal everyday business of accepting investments and making distributions that the license is perpetually renewed or canceled through obsolescence, one or the other. I'll show a little sample here in the following table. So it is illustrating how the licensing fee would work with respect to the number of tokens outstanding. This is just an example, so these are not pro forma estimates of actual expected open market purchases, nor the estimate of the value of the token itself. But those boxes in red are cases where the existing supply is not sufficient to purchase tokens out of the market. The buy pressure would likely remedy this. Or if the company extracts all the tokens out of the market, an alternative method or amounts would need to be considered. So in conclusion, because the smart contract is a store of value, logic engine, and can carry with it key contractual terms, we can tie the identity information on chain. We can place the store of value payments and set the term, the third thing, with the license. So we've cut out 3 processes and 3 systems down to 1 function and 1 system. And that's utilizing blockchain technology for more modern efficiency. We are taking the digital marker from essentially cobblestone roads and smoothing it out into asphalts. So in essence, to go back to my original title of, these are the DMs everyone will inevitably be sliding into. That's all, folks. Just for more information, you can visit us at www.unfederalreserve.com. I appreciate the time and have a wonderful day.
Don't think you're an investor? We make investments morning, noon, and wait, what time is it exactly? We make short-term investments, long-term investments. We diversify our interests, realize our gains and losses, and try to keep the big picture in mind. You don't need to become an investor. You were born one. Robin Hood.
Well, to cap off today's outstanding session, and a huge thank you to all of our speakers that have taken part so far, we're going to turn to Cointelegraph's social media and marketing manager, John Ricker, to explore the role of media plays in crypto with some of the foremost influencers in the space. Let's see what they have to say.
Greetings, universe. Thanks everybody for joining us at the LA Blockchain Summit and sharing your time with us on this panel. I'm John Ricker. I'm excited to be extracting the information from our very valuable guests as we talk about the role of crypto, where the media has gone as crypto is assigned to it. So let's go around this 2D square and let everybody introduce themselves, what they do with their days, and the work they did to put themselves in the position they are currently at.
Sure, I'll start. My name is Alejandra. I run a community called Crypto Babes, where we teach over 20,000 women learn about crypto. A little bit about me, I actually got into cryptocurrencies in 2016. There was a classmate in my university that was mining Bitcoin. I thought it was super interesting. I started going into the rabbit hole. Then, you know, started trading, doing all these different things. And I realized there wasn't a lot of education that wasn't very technical for women. So me and my business partner decided to create a platform that wasn't technical at all. That was just a space for women to interact, talk to each other. And we just grew really rapidly in Clubhouse. Now we're moving into Twitter Spaces. So yeah, just an exciting time to be in crypto.
Awesome. James?
Lovely to meet you all. Yeah, James Bowater. Forgive the husky voice. I'm actually in Bangkok, and it's already the 4th of November, so I'm a day ahead of you. About 3.5 years ago, 4 years ago, I created something called Crypto AM in partnership with London's business newspaper called City AM, which is a 16-year-old newsprint publication that's distributed in London around the square mile and all the commuter stations. We have about 600 distribution points, and then obviously the world changed with the pandemic, and we went from being a purely a newsprint situation into a purely online situation. Well, I'm very glad to report that from the 20th of September, which was an auspicious day, the newspaper returned to the streets of London. So that's been it's been a joy to see it back. But yeah, that's been 3.5 years of, and we were the first mainstream publisher to feature crypto. I mean, Crypto AM is a moniker. It catches all the technology. It's really more about AI, blockchain, digital assets, tokenization, and predominantly it was created as a sort of a translator to traditional finance, which is the existing audience of City AM. But equally over time, through having networking meetings, dinners, it's all culminated into the Crypto AM Awards, which were pretty cool. On the 20th of March last year, which of course 5 days later, everyone had to go into lockdown. But it was rather spectacular return. We had a huge awards show in London just about a month ago.
Amazing. So I wanted to start, we can get into the granular crypto part of media. But let's kind of first paint a bigger picture with everybody's personal experience. James, you have some publishing. Alondra, you got some digital. So either from your career's perspective or just personal anecdotes, how have you seen media evolve from the past to where it's at today? James, you want to go first?
Yeah, sure. I mean, look, I mean, I'm not a journalist. I mean, let's get that very, very clear. It'd be incredibly unkind to the professional, hardworking crew at City AM newspaper to say that I was. However, when it came to the creation of Crypto AM, the idea was I'm going to go out and learn and share those learnings with the audience. In terms of my first exposure to cryptographic currency, as it was sold to me at the time, 2014, we were raising money for the 30th anniversary of Live Aid, but it wasn't to be called Live Aid. It was going to be called the Festival of Hope. And we actually went as far as getting a gold-backed token created in the name of the Hope Gold coin. But of course, in 2014, no one knew what we were talking about. Least of all me. Yeah. So the journey has been very interesting, and I had quite an in-depth experience in trying to bring technology, to commercialize a technology in high-end holography. I mean, you know about the Visa Dove on the back of your credit card. Well, we were doing something called volume holography, so full color, 3-dimensional holography. And one of the joys about that is that the film that we exposed it on was see-through, so you could actually see underneath, as well as having the hologram over, which meant obviously, QR codes were an important part of the solution. And it's been fascinating, and again, I keep going to the pandemic as being the ultimate accelerant of in a sense adoption of the technology side, in as much as who doesn't now have to use a QR code scanner for their Apple introduced the direct into the camera. So it made life a lot easier for us all, because before then we had to download a special QR reader and all of that thing, those sorts of things. So everything's become a lot more seamless. And yeah, I mean, I'm sort of waffling on a bit about technology, but it's an important aspect of what we're doing, our day-to-day lives, and how it's affected us and our interaction with the industry that we're all part of now.
Yeah, very much so. Alejandra, you can, even just from a non-crypto media perspective, and you saw James talk about how it's going towards more technology, and this medium is very tied to technology. So how have you seen, just in your life or the start of your career, how people interact and either produce or consume media change into the present day?
Yeah, it's super interesting because I remember, back in 2016, 2017, you will see, media talk about crypto, but it wasn't such in a positive light. A lot of times it was like, it's going to zero, or it's a scam, especially coming from like CNBC, Fox, and those regular mainstream media channels. And I remember, telling my friends, telling my family about it, and they were really skeptical. It's like, well, CNBC told me this, or, all of this. But now you're starting to see a huge shift because millennials, Generation Z, they're not longer believing this mainstream media. And they're saying, you know what, let me go into Reddit. Now let me go into Clubhouse. Let me go into Twitter, right? And that's a different, another topic, right? But people are now trusting social media influencers. They're trusting, TikTok and all these media to take them in their crypto journey. And it's super interesting because now we're starting to see a new form of, influencer driven marketing, right? And it's super interesting, especially in crypto. And now, when we do rooms with or crypto babes community, we hear all the time, oh, I saw somebody on Twitter tweeted this, and is it true? What do you think, right? They're not talking about the article from Fox News. They're talking about what their favorite influencer said, or, a video they watched. And that's a huge shift. And I think it's happening because when you look into crypto, people that are usually into crypto and blockchain, they are looking for, getting out of the status quo. They don't believe the institutions. They're looking for something different. And blockchain crypto gives them that, so it's super interesting to see how it's shifting. And now we're starting to see more crypto media companies growing. I know Cointelegraph has done huge success. And, I've done freelancing before for crypto media companies, and, the number of views in the past year has increased dramatically because people now want to hear about crypto from other people besides, the mainstream media channels. So it's an exciting place. I'm excited to see how social media shifts crypto. I mean, look at Doge and Shiba and Elon, and it was driven because of Twitter, it wasn't because somebody posted it on the news. So it's interesting, and I look forward to see the next projects that are gonna succeed. Of course, there's gonna be a lot of fails, but a lot of it's gonna be driven through social media.
Yeah,
and
exactly.
I find that all quite worrying.
Of it being driven through community, Twitter and social media.
No, I think look. I mean, I'm not. It'd be. I mean, I know I'm of an older generation, but I think that look, when I started the journey of education, for want of a better expression, which is ultimately it's providing information, so that people who don't have a clue what an ICO was or whatever, got to understand things. But I think one of the things that slight, as I said, worries me a bit is that, as Alejandra mentioned at the beginning, is that 3 years ago, I mean, cryptocurrency itself was very much sort of derided as the vestige of Silk Road style drug deals and buying guns or whatever. I mean, it's an absolute sort of, well, I'm going to not swear, but in English I'd say it's a load of bollocks. But anyway, there was no question that there was all of that. But then we saw an awful lot of I think quietly, I think there was a huge amount of jealousy from Wall Street that this huge market, which is still nascent and small compared to the traditional markets of real estate and TradFi itself. I mean, we're a microcosm. I mean, how many companies are actually worth almost the same as the market cap of the entirety of cryptocurrency? I think so. Legislation has played its part in as much as, you know, these sources of capital couldn't enter the market because they were sort of prevented from being part of it. So there's been a huge amount of regulatory change, and a lot of that's been forced. I mean, I love them or hate them. You know, when Facebook announced Libra, and now DM as it's called, you saw a huge scrabbling from unexpected sources. So now we have something called CBDCs. You know, I'm like, what? Where did they come from?
Sure.
And then the other aspect of change that's been remarkable has been the emergence of the DeFi protocols.
Mm-hmm.
And I think caught everyone napping. I'm very lucky in what I do, and that I get to meet. I mean, I travel. There's a friend of mine called Loretta Josef, who's a sort of legislative whirlwind genius, and she's always going on about, you know, just show up. Wherever it may be, and you know, in the depths of Nigeria or wherever. I mean, and actually, ironically, Nigeria are the first people to, I think, properly adopt. I know the Chinese have done it, but I mean, you know, the Ownera has come out now.
I think it might be the second.
So it might be the second, right?
I think
China, they flip flop between needing energy and not needing energy. Banning. I think we're on the 6th ban of Bitcoin already, aren't we?
In that vein, I know, James, you kind of have a position in a legacy model of media in publication, and Alejandra kind of, you know, you're in that digital space as well, and so you're both at different areas of convergence of media and crypto media. So
yeah,
what do you think? So James, first, let's say, what do you think your company and your role in one media? So you gotta have two areas. Crypto media and media, or
John, it's actually a really interesting point, and Alejandro, just to give you the benefit of some knowledge that he might have already. I mean, we literally were a die in the tooth newsprint organization. All right, so you know, a newspaper that's handed out to commuters from the city, Canary Wharf, the commuter belts, and you know, when I launched Crypto AM, it was a 2-page PDF online that had no links ability. You know, there was nothing live about it at all.
What year was this?
2018.
Okay.
June the 18th, 2018 was the first edition of Crypto AM. It was a double-page spread. It was a Monday. We actually moved it to Tuesday eventually, which was great because then people would actually read it. But again, for us, the pandemic changed everything, because I mean, even though I'd, you know, clearly been saying, look, my community is predominantly digital, you know, there was no method of interaction other than to read the PDF edition online. And even then, the articles themselves, you couldn't interact. You couldn't, you know, click on the button to go and visit the company that you were reading about. So for me, the change has been brought about, and that's why I do bang on a bit about the effect of the pandemic. You know, look, paper isn't dead. Actually, people love still the tangibility of a book, of a magazine. You know, actually, ironically, on that topic, I'm launching Crypto and the magazine, so that's cool. But that will be online, and all the articles will be interactive. But you know, the point is, the evolution of what I do has and actually, therefore, the newspaper has pretty much been born out of the need to change. And I mean, our online audience grew pretty much. Yeah, I mean, it went from about 1.2 million to peaked at about 3-point-something million within a very short space of time. Unique people a month. I mean, you know, we are not a big organization in that in audience terms, but it's you know, it's not bad either. But the transformation has been a huge learning curve, and we all had to adapt very fast.
Wonderful. So Alejandra, in that same question, what do you think your role in crypto media and media in crypto in that space?
I think what I will say is help people make informed decisions, and obviously never serve as financial advice, but rather inform people of the dangers as well. You know, I think when it comes to crypto, a lot of people hype it up. You know, everybody's like, oh, you're going to make a lot of money and all these things, which you can, you know, it is possible. But there's not, and I'm super happy there's influencers out there that also tell people, hey, you need to make sure you're using proper risk management, never invest more money that you can afford to lose. Make sure you're looking out for crypto scams, fake airdrops, fake NFTs, rug pulls, you know. And that's what does scare me from the crypto in media plays, that of course we're seeing, you know, great influencers that are doing their part, but at the same time, you know, look at what happened with the Squid coin, right? Squid Games coin, and, you know, people hyping it up, and, you know, people now getting paid for promoting, you know, crypto projects. And I'm not against you know, paying influencers, but I think it also comes to what is the ethical standpoint of influencers, right? Because some of them do it for the good of the community, but, you know, or sometimes, you know, you might be reached out by a project you think is legit, and then it might not be legit, you know. There's a lot of things. So for me, I want to move in from an ethical way. I want to make sure that I am telling the community always like, oh, this is my point of view, this is not financial advice, but very much informing the community of the dangers of crypto. Especially our community is mostly women, you know, and a lot of the women that we have, some of them, you know, are super smart, they're developers, they're building, you know how to code and all of that. But we do have a big population of women that are very new into the space. You know, they hear somebody on TikTok and they're like, oh, you know, I'm ready to put my money. And you're like, okay, calm down, you know. So knowing what's your population of people that watch your videos and moving accordingly. So really just educating people. That's my goal.
Yeah. So Ben, BitBoy Crypto, you're kind of in that same space. You reach a lot of people. What mindset do you have towards your overall objective towards giving to people?
Well, the mission statement here at BitBoy Crypto is empowering people to find financial freedom to crypto assets. We know that, you know, this is probably the largest transfer of wealth we're going to see in our lifetimes. That's why you've got, you know, 16, 17, 18-year-old kids on TikTok that are now making hundreds of thousands of dollars on NFTs. That's not normal. But you know, so that's what we do, is we educate. And you know, we understand that different people are at different places in their crypto journey. You've got certainly the crypto degens. And for those people, I know that Alejandra was talking about Squid Games, which is a big scam, a big rug pull. We always warn people about stuff like that. But the people that are investing in things like that, they're usually not newer people. They're people that kind of understand what they're getting into. I remember reading a Twitter post from a guy back in the DeFi summer of 2020 who turned, I think it was like 1 ETH into $1 million. And he did it through a strategy of investing in totally sketchy, possible rug pull coins. And over time, he hit more than he lost. And, you know, that is a gambling perspective. But there is a certain, you know, faction of people in crypto. That's what they want. That's what they like. The same people that will put it all on black or red at a roulette table. But then you also have to understand there are newer people coming in. And those newer people outside of, you know, I would say Generation Z, crypto users, most people that are coming in new are in their 30s, you know, late 20s, 30s, early 40s. And for those people, those are risky projects. Number one, they don't even know how to get to them. And number two, that's not what they're interested in. They're interested in the top coins and, using Ethereum or Cardano or Solana, these projects to either build a stack of Bitcoin or build, you know, another kind of portfolio. That's what we push people towards. We, of course, do cover smaller coins on the channel from here to there. We certainly do promotional videos, all 100% disclosed, because there are people that want that. There are people that want that 100x gem or whatever it might be. And those do exist. I mean, look at Solana. Solana, I think, has done, I think it's like 5,000%.
16,000%, isn't it, Ben?
Well, yeah, so it's ungodly how large that percent is. So these coins do exist. We were certainly talking about Solana near the beginning, but you know, it all obviously is kind of a more respectable project than some of these that are lower. You have to understand, like, when people are putting money into meme coins, they're just gambling, and we have to be okay in crypto, I believe, that people like to gamble and that's what they want to do. And we can lead people to, you know, lead the horses to drink, you know, so to speak, all we want, but eventually some are going to go wayward. And it's up to us to present the entire picture to these people and then let them decide where they fall in that continuum of crypto investors.
Remember that age-old adage in stock market in the old days that the minute you're getting stock market tips from the shoe shine guy, then it's time to probably get away from it for a bit.
Yeah.
Something that's very interesting recently for me, because I've been traveling quite a lot. I'm in Bangkok now, but I was in Dubai yesterday, and I was in London obviously a week before, and I had occasion to go on the tube train, between where I live in Canary Wharf and having meetings in Mayfair. So it took me on two legs of the tube, and I started seeing literally crypto ads on the train. And one caught my eye was Flocky. No, I'd seen Flocky on the tube train. I saw Flocky in the airport in the UK, but leaving Dubai, they were running a Flocky ad saying get in the best, and I think that the one in London, the print one, was Miss Doge by Flocky, and then at the bottom it's got this tiny disclaimer saying cryptocurrencies are not regulated in the UK. Are you seriously telling me that's your only disclaimer that you're not going to get? But it's actually true. Advertising Standards Authority is the governing body over that. Is not the FCA.
So do you think that there is in crypto media either a right or a responsibility to produce media that is different than if you're in another niche of media?
Because actually going to that point, and I'm not going to mention a name, but there was another advert that I saw, and I'm like, I'm involved in some projects in Africa, with solid gold sort of. Not actual gold, but solid background, solid intent. I think Ben, about World Mobile and Meld, and just this thing. I had their PR calling me saying, "Oh, we want to run a story in Crypto AM," and I said, what is this project? And they go, oh, well, we've raised $500,000 or $1 million, and I said, well, how much? Okay, you want to do a pan-African currency with that?
Sure.
Maybe go and have a chat with, Charles Hoskinson or whatever at Cardano and see about how long it takes to build something like that with the necessary framework. So my point here is that I actually, for the first time, was having to question whether or not we would accept money from people who wanted to, in effect, promote themselves through a spotlight feature, which is the commercial element of Crypto AM. It's a spotlight feature, and it says partner content on it. And likewise, as Ben said, if ever I'm writing about something, or actually, if I'm involved in something, I declare I'm involved in it because my moniker is Crypto Insider, so I'm sort of involved in projects. So I just time out myself and let one of my journalists cover it or whatever, or disclaim it. But I think we do have a responsibility if we see things that look suspects.
Well, I think
investigate.
Yeah, real quick, I'd like to jump in because, it's so funny to me how influencers and YouTubers and, people on different social media avenues, there seems to be a different standard applied to us when it comes to the kinds of videos and the kind of topics that we make. Whereas the two largest media organizations in crypto, CoinDesk and Cointelelie, as I call it, they are totally biased. If you look at Digital Currency Group, they own CoinDesk. Digital Currency Group, they own so much of what happens in crypto. And, the CoinDesk themselves, they don't do paid press releases, right? That's their way to say, oh, no, everything here is unbiased and is totally fair. Yet they're owned by the biggest crypto conglomerate that exists that has very specific holdings in their portfolio. And of course, they're very heavily linked to Coinbase Ventures, who is doing the same thing. And nobody stops to ask the questions about what CoinDesk is writing about. There seem to be like this holier than thou, website where you go there and you believe the news. And really, in a lot of ways, it's very similar to fake news we see in mainstream media. Then you have, of course, Cointelegraph, who is the actual #1 media brand online for crypto. And of course, they were started by early Russian Bitcoin miners. This is all true. You can go look at all this. Their CEO is actually an independent contractor. Name me another company whose CEO is an independent contractor, and they do sponsored content all over the internet, and nobody questions them. And I think really a lot of this is misdirection, is aimed in looking at people that are making videos with thumbnails, or somebody that does something on Twitter that's, kind of crazy or whatever. But really, the two biggest media narratives driving this entire space, they're both crooked.
Sure. Alejandra, do you think that, does it depend on who you're talking to, the community that your demographic is? Does it matter if their risk profile, or what have you seen in your space?
So BitBoy mentioned something very important, that is, I've seen it a lot. It depends on age, right? So you have, again, like he mentioned, those TikTok people that go into very risky, usually, Generation X, they're the ones that go into this risky coins, get rug pulled, go all of this stuff, right? But when I talk to older people in their 30s, 40s, they're usually, hey, I just want to invest in Bitcoin, or I just want to do Ethereum, or like, oh, I heard about this new project, Solana. What do you think? I don't know. I haven't read that much about, they're open to all coins, but they're like, need more information. Usually coming from that more, usually when I talk to investors, now that I live here in California, I do get a lot of people that say, hey, you older, right? I want to invest, but it's not regulated. If I lose my money, nobody's going to, and that's a concern, right? But something that I've noticed is that it depends on the risk, right? So I think we get people that are new, they're not that much into risk, but we do get a lot of women that say, hey, I want to go into liquidity providing. I want to do a lot of the more, not risky, but, it takes more knowledge, more technical knowledge. So like BitBoy did mention, a lot of people that do enter a lot of these scammy coins, they are high return, but they're high risk. It's people that have a little bit more technical knowledge, or even if they don't, they might just be doing it because they saw it on a Reddit poll and then they explained it to you, they're doing it. But we get quite a few, but I have noticed it has to do a lot with age and their background, right? If they've done investments in the past, the people that have not done any investments usually are the ones that are very like just Bitcoin, just Ethereum, that's it. That's what I've seen. But we get, those gems once in a while, those 40-year-old people that say, hey, YOLO, but rare.
You might be insulting people by saying
really
30 and 40 years old.
I'm feeling really old now.
Yeah, I was going to say, you might be.
I made it to 50 and I'm like, yes. Anyway, but actually it's quite funny that I was with the LA Blockchain Summit and you're in California. But I mean, obviously filmmaking is another perfect example of there's no rhyme or reason to sometimes having a successful movie, is there? So that's why you have a portfolio approach, and you probably do 10 movies, and one of them, probably the one that you least expect, made for the less money. These money is 1,000x that they rely on. I don't think there's anything wrong at all with speculative approach, as long as you do know what you're doing. And I think that although regulation, you got to ask yourself, why are they regulating? I mean, I very much got into the space because I'm quite passionate about fractional ownership and giving the man in the street the ability to access the sorts of deals that were the preserve of the cabals of hedge funds and insurance funds and all that kind of stuff. And I think a lot of the resistance to crypto and digital assets, so particularly, which I think is the next. I mean, it's not the next. It's huge, obviously. I mean, the ability to digitize assets and seamlessly transfer them at a fraction of the cost is a massive opportunity. There's a lot of a lot of self-protectionism that comes with the regulatory frameworks, but I think that there have been a lot of good strides being made now by in the US you got that wonderful lady Senator Loomis, Cynthia, who's doing great work. You got Caitlin Long, who's just been amazing about getting the messages out there, but you're doing it from within the traditional world. Okay, and to an extent, that's why I've got a responsibility, obviously, but the traditional audience that we have within the City of London, obviously these guys are inherently, governed and only used to regulatory frameworks. So I like to think that we're heading now in the right direction, but an awful lot of that's got to do with the fact that they've played catch up.
Yeah. So it is kind of a theme of the community that you are talking to. And I do want to talk about fractional ownership, especially as it comes to businesses and communities. But let's kind of start generally just from a business or brand perspective. How important is it, especially in the crypto community, in the crypto niche of media, to be building a community? Do you leverage most of your community with your business? What are your thoughts on that, everybody? Alejandra, you want to start?
Yeah, something that I've noticed a lot when community, right? When it comes to building a community, I always see it as a give and take, but more give, right? Always be adding value. So, for example, the best influencers I've seen out there that do crypto, they're the people that, yes, of course, they have to monetize, they have to make money. I'm not against that, right? But they're the people that are always constantly giving value. They're the people that people are talking about them and asking questions about crypto. They have articles out there. They have interviews. They're always doing things to help the community. What I will say is something that has helped Crypto Babes grow is having this community, because again, we get all types of women, and we realize that a lot of women that don't come into crypto is because, they go into this, boys club in crypto sometimes, and they're just talking very technical. And I remember being that person, and I'm like, I don't even know what to ask, because I don't even know what they're talking about. You don't know what you don't know. And we created this community of there's no such thing as a dumb question, and people coming into the room of like, hey, like, what is a smart contract? And what is Bitcoin, right? Like, people will come and ask us, what is Bitcoin? When you will go into other communities in Clubhouse at the time, right? And you will go, hey, what is Bitcoin? And they're like, what do you mean you don't know what Bitcoin is, right?
I think there still is that barrier. I think there is. And actually, at my recent summit, we had a panel called Educating the Grown-Ups in the room. It's not just the kids who don't understand what the hell we're talking about. It's the grown-ups.
Usually it's the opposite.
The advisors. And when I say advisors, I'm talking about the professional advisors in terms of law firms, accountants and bankers. And they're like, what the are you talking about? I haven't got a clue. So, and I think that one of the joyous things about the explosion in DeFi specifically has been the eye-opening speed at which it's happened. But still, let's not kid ourselves. It's like around about $1 trillion. I mean, it's nothing compared to the traditional markets. However, it is being taken very seriously, and the methodologies there are pretty amazing. They're complex. They're you got quants with brains the size of mountains who are sitting in their little coding bubble. I mean, the most valuable people are the people who are doing the smart contract stuff on DeFi. If you get it wrong, you see what happens. Everyone gets their money sucked out.
Sure. BitBoy, how does your production studio and business as a whole interact with its community?
Yeah, so we have the largest crypto and all the largest crypto community in all the interwebs, as we say. We have over 5 million total followers. We're inching up towards 5.5, 1.3 million on YouTube, or 1.35 million as of today. We have 630,000 on Twitter. We have 330,000 on Instagram. We got 2.7 million on TikTok. Then we have our audio. We've got a subreddit. We have a community text line. We have everything that you really want when in your arsenal. We have multiple Discord servers, Telegram groups. From the beginning when I started this, it was always for crypto. It was always for crypto. It wasn't for myself. It wasn't for some kind of fame. I never thought I would be the largest community. That was not a thing that even went through my mind when I started this channel. It was all about what can I offer the most value. I did multiple videos per day when no one watched. You know, people see my channel now and they're like, oh my gosh, it must be so easy. It was not easy. I will tell you that. I had a video just less than 2 years ago that had 150 views on it. I get that in the first millisecond when we post a video now. And it was a lot to put in all that work and not get any return on that investment. But at some point, something happened. You know, the channel grew tremendously, and that is a testament to my community and a testament to the way that we treat our community. Our community is family to us. I want to see, there is nothing I'm prouder of in the world than when we go to meetups. We've got a meetup on Friday night in Las Vegas at the Venetian. We've done multiple meetups around the country. We always have about 400 people that show up, 300 to 400 people. They come, they want to take pictures, they want to talk, they want to ask questions. We do an AMA. But the thing I'm the most proud of is when somebody walks up to me and they show me more their portfolio. And it doesn't matter what it is. It doesn't matter if they're showing me $3,000. I've had a guy show me $10 million, everywhere in between. Okay. What matters is they are proud of what they've built, because everybody is at different financial levels. To one guy getting several $1 million and being able to retire, that's huge for him because he thought he was going to be working a dead-end job forever. You got somebody else, for the first time ever, they can afford to live on their own, or they can afford to go to college if, that's what they want to do. And those are things that we're really, really proud of. The production level and the professionalism that we brought to the crypto YouTube space that, is at this point, as far as our production level goes, I mean, it's untouched right now, is that we offer to the community a more of a mainstream channel. And there's a lot of people out there that do not like that. They don't like the fact that we're the mainstream bridge that brings people in. In a lot of ways we are, and we do that, but we always wanted to have a place. There's not a difference between our quality and what they're watching on Jake Paul or what they're watching on other famous YouTubers that they're especially for the Generation Z, a lack of production quality today. It's really inexcusable, especially if you've already started building. If you're brand new and you're starting something, then yeah, I understand. But the idea that we have is there's a lot of YouTubers out there. We call them the Lazy Millionaires Club. They never inch up their production because they're not interested in, and I'm not calling out anybody specific, and a lot of these are great people. I'm not saying they're not good people. What I'm saying is they've got no incentive to continue to offer better things to their viewers. And that's what we strive to do. And that's why we have a brand new 38,000 square foot studio that we're going to be opening soon. That's why we have built a gigantic, conglomerate of studios here in our current building right now. This is what we have wanted to do, is to offer the community things that other people just aren't offering them. And it's obviously had an appeal. We're very passionate about that. And I think community is the biggest thing that's caused us to grow.
Yeah.
I mean, just to add something really quick, BitBoy mentions community, right? We have to understand that anything in crypto is community driven. You cannot have a cryptocurrency project blow up if there's not people behind it that believe in it. So I think you can talk about any business, but when it comes to crypto, you need community, whether that comes from, I think influencers are doing a great job. YouTubers are doing an amazing job because that's why, companies are reaching out to them. But having a community where people feel like they can ask their questions, they're creating generational wealth, they can help their pay their mortgage for their mom. Like, those are big things that unite people. And I think that's very unique that, you didn't see in the regular financial world. People don't have communities, Bank of America, or Chase, nobody cares. But here in crypto, people are having names, right? Like, for their Bitcoiners, they're having all these names for themselves. And I'm in so many Telegram group chats where people identifies, it kind of becomes like an identity, and that's how deep crypto goes in community. So I'm excited. I really do see more communities are going to be grown in the space, and I can wait for YouTubers and big shout out to BitBoy and other YouTubers, because it's a lot of work, now that I've been doing videos and even a TikTok, people say, well, it's like 15 seconds. Well,
that's a lot of work.
It's right. 15 seconds that you have to do your research, that you have to, how can I make it engaging? How can I catch people's attentions in the first, right? Because this is the generation we're currently on. And I think that's why, Generation X is going into these scam projects, because they just hear flashy words, right? Like 100x%. And sometimes people feel like, oh, that's what I have to talk in a TikTok. How can I make it more engaging? Because Generation X up there, they're just 2 seconds, 2 seconds, 2 seconds, you know? So now influencers, creators have to find ways to engage in a way that wasn't seen before, you know?
Well, unfortunately, if I can make one point on that, unfortunately, the system is rigged to where you have to do that. If you come on and you make a video explaining why Ethereum is great and you give the best fundamental reasons for it and show the best on-chain metrics, that's not sexy. That's why we always fought the battle on YouTube. Like, you know, a lot of people say we're the clickbait kings, because we understand that what good is an informational and educational video if nobody watches it. And that is a battle that I had very early on, not wanting to make clickbait thumbnails or titles. But if you don't do it, no one will watch it. And so it's kind of one of these necessary evils in the space. When you talk about TikTok, if you can't make it hyped and engaging, no one's going to watch it. You're not going to be able to build something. I think the important thing as influencers is to remember your responsibility and to not get those things confused. To not be like, oh, this coin is going to be super hyped, so I'm going to come and I'm just going to hype it. It's okay to lead with something provocative. It's okay to have a title that's something provocative, as long as you're showing all sides of it and you're giving the pros and cons, and you yourself are not becoming strictly a hype man.
Yeah.
What's interesting for me listening to you guys is obviously I think we've all got different audiences and objectives, I guess, and you speak to your audience, don't you? So I mean, but the one common theme that does exist, in fact, the strapline for Crypto AM is connecting the community. But in my case, it's bridging the gap between the suits in the tower blocks and also the crypto community, because guess what? Going back to educating the grown-ups in the room, it's exactly what's happening. So, you know, one of the most powerful things that I've experienced in London has been having, you know, I mean, we would have blockchain breakfasts at Balthazar. We'd have, you know, crypto networking dinners, and the physical interaction of people is really where my community lies, and it enables people to mix and ask questions directly. But I wouldn't know where to begin doing what Ben does. I mean, or what Alejandro does. I mean,
So talking about that as we wrap up here, maybe a minute per person, what would you do now to better position yourself if you're looking back and saying, I'm going to start this business or start this venture? And in that same vein, what would you say to other people that are getting into media, and specifically crypto media? And go whoever wants to go first.
Yeah, I would say, looking back on the way that I started, you know, the number one thing I think people have to realize is this is not easy. And let me tell you this, right now, it seems like people can't miss. It's like shooting fish in a barrel, getting followers and attention in crypto, but it's not always like this. And so if you think there's going to be some kind of easy journey building a community, it is certainly not. There are going to be ups and downs. There are going to be times you want to quit. There's going to be times you're overworked. There's going to be times that you're not able to see your family as much as you want to. But if you understand you're passionate and you're working towards something much bigger, you know, which is decentralization or helping people find financial freedom, whatever it is, and you hold on to those things and just know that the hard work isn't temporary, but the building process is temporary. And people have really got to understand there's so much hard work. And like Alejandro said, it's not just the time, it's the energy output. The energy output that you have to put into this, you have to give your heart and your soul into becoming a creator in crypto. So, you know, if I were to go back and give myself one piece of advice, even though this is advice I would say I probably took anyways, it's not easy and you got to stick it through. But there are definitely, you know, end goals and an end game that is well worth it.
Alejandro, quickly.
Yeah, I will say stay authentic. You know, in a world of crypto, people feel like, oh, they have to act a certain way, especially on TikTok, right? You see those videos that are being successful, and you feel like, whoa, I have to be that way, right? And of course, when we're talking about clickbait and, you know, things like that, of course, you can do them in your own way, but stay authentic to who you are, because there's audiences that still haven't been reached by crypto. Right? There might be, you know, people that are 40-year-olds and they're looking to get into crypto. They're looking for somebody that looks just like them. You know, there might be somebody that's a 15-year-old that's looking for somebody that looks like them. Stay authentic, but at the same time, stay ethical. That's the best thing I will say to anybody, because the more you grow, you're going to get reached out by a lot of people and a lot of projects that will offer you money, that will offer you things. But you need to know, okay, the community is more valuable than the money I'm going to get. The long-term vision is more, right? So like when you look at these projects that are offering you whatever they're offering you, look really deep, right? So that's the biggest advice.
James, last word.
I think my advice to myself would be probably don't go to as many openings or whatever as possible, because I swear to God, my waistline and my liver has suffered horribly. So that's my humorous look back. But no, it's the downside of showing up is the as Ben said, the amount of travel, the time. You don't build a network, through sitting at home. It's tough. I'm exhausted most of the time, and as I said, quite a lot of snacking on the way. So probably stop eating the pies, James. There you go. How's that?
No pies. Great advice. Appreciate it, Alondra, James, Bitboy, Ben. Thank you for your time. Thanks to everyone watching. Enjoy your night. Enjoy the rest of the summit.
Thank you.
Thank you very much for having me.
Amazing conversations all day. Now it's time to wrap up the day with Superfin's founder and CEO Liliana Russo on the smart platform for crypto. Let's see what has to be said.
Hi, I am Liliana Russo, founder and CEO of Superfin, the smart app for cryptocurrency that helps you invest like a professional. I'm here today to present about Superfin. I'm going to show you a brief video about it. So, you want to buy and sell cryptocurrencies online? Easy. Superfin allows you to invest in cryptocurrencies based on the risks. With our smart automated app and online platform, you have complete freedom and knowledge to invest what you want anytime. I am Liliana, the founder of Superfin. I have 20 years experience in cryptocurrencies, fintech, and investments from JP Morgan, Morgan Stanley, and Deutsche Bank, among others. There are platforms that allow you to buy cryptocurrencies, but in my knowledge, they don't evaluate and recommend which ones. We are here to give you the time and expertise to select the best cryptocurrencies to create a diversified portfolio. Here's how it works. The platform first evaluates a client's preferences for risk. Then it recommends a portfolio of cryptocurrency from our extensively evaluated database. You can invest whatever you want directly through the Superfin platform, which monitors the portfolio with buy and sell recommendations. Simple. Now, this is a small presentation from one of our advisors about Superfin.
In my view, everything available in the market is designed for traders. They know exactly which and what cryptocurrencies they want to buy, but the majority of people don't. With the rising number of people wanting to buy cryptocurrencies, we are seeing a frustration, the lack of knowledge, tools, and the time to evaluate hundreds of cryptocurrencies and select the best. That's why Superfin is unique. It answers a huge problem in this sector and is a vital next step that has been overlooked until now. In addition, it brings financial inclusion, as anyone can buy or sell cryptocurrencies through the Superfin platform.
Recommends a diversified portfolio of cryptocurrencies, which people can buy at a click of a button. The Superfin app offers many benefits. Financial inclusion, because anyone can invest from as little as $100. It allows people to create customized portfolio of cryptocurrencies. So people can choose from a lower risk, medium risk, or higher risk portfolio based on the risk tolerance. Once clients have created a cryptocurrency portfolio, then the app monitors in an automatic fashion the portfolio and alerts clients to rebalance once the risks have changed or once there are new recommended portfolios, and clients can do so at a click of a button. The Superfin app is powered by smart investment risk models. These models have a framework to select the best cryptocurrencies based on market data and blockchain data. Once clients have created a portfolio of cryptocurrencies, they are stored safely through our partners. Currently, our partners for trading and custody through an API are tier 1 cryptocurrency providers, and they will store the cryptocurrencies on their wallets, which are insured for digital hacks. The app offers transparency because once you bought your portfolio of cryptocurrencies, you can see the actual cryptocurrencies in your portfolio. And it offers liquidity because you can withdraw the cryptocurrencies anytime, and you can also liquidate the portfolio and withdraw cash. Because a lot of our clients are interested in learning more about cryptocurrencies, we offer educational events online or live on a monthly basis. The SupraFin app's recommended portfolios have had a great start. The higher risk portfolio has had a 200% cumulative year-to-date returns. The medium risk has had 100% cumulative year-to-date returns, and the lower risk portfolio has had a 50% cumulative year-to-date returns. The app has many solution partners. Gemini is our partner for KYC, banking, crypto, exchange, and custody. And for data, we use CryptoCompare for market data, Coinmetrics for blockchain data. And our partner for emerging technology as advisor is Uphold. Although we are integrated currently with Gemini, in the future we plan to add other partners for the crypto exchange and custody. As mentioned, SupraFin has teamed up with Gemini to act as exchange and custody provider for our clients. And this is a comment from Dave Abner, the Global Head of Business Development in Gemini. We have successfully launched the SupraFin iOS app on September 15 in the US market. The SupraFin app is a customer-centric interface app, very easy to use, currently available in iOS, and in a few weeks it will be available in Android. We have received great feedback and reviews from our clients. They said the app is very simple to navigate, helpful, secure, great app to invest and to trade in crypto. And there is the most helpful app so far in the market. We have an excellent team with expertise in cryptocurrencies, blockchain, investment models, risk management, portfolio management, quantitative finance and trading, complex products trading, and software development. Our expert advisory board comes from tier 1 financial institutions like JP Morgan, Credit Suisse, Barclays, Stonehenge, Fleming, etc. So if you would like to check out the app, I recommend that you download the SupraFin iOS app. It's available now in the US market, and you can start investing in crypto while leveraging the powerful investment models on the back end. You can point your mobile camera to this QR code to download the app, or you can search for it on the Apple App Store in the US market, or you can also use the link below. If you're interested in contacting SupraFin, as you may have questions, or if you are interested in potential partnerships, please feel free to reach to us. These are our contact details. And thank you.
Well, what another amazing day at the 8th edition of the LA Blockchain Summit. Tomorrow is all about the developers among us. So make sure to join in. Keep exploring those virtual booths and networking with fellow blockchain and crypto enthusiasts on the conference platform. And tomorrow is your last chance to join us live at lablockchainsummit.com. Have a great evening. Thank you for tuning in.